Markets just don't seem too fast about higher yields right now. They're focused instead on the soft landing and what that can deliver for the US economy, and more broadly, we see how that plays out for Europe. So European stocks then just opening up, looking for, well, as Guy said, not a great deal of movement anticipated at the start of this trading day. We are expecting US futures are a little weaker, so that could add some downside a little later in the session, but perhaps we get a little upside in the meantime. No, not so, or just flat. The FTSE 100 opening entirely flat this morning. The market taking a little while to get its head in gear, perhaps, for this week. But it is going to be a big week. We're going to get CPI, we get the Fed minutes, as you said earlier on. There could be some interest there. Will we get a slightly more hawkish picture than the sort of benign Powell that we heard post that Fed meeting? So that's going to be something to watch for.
Keeps setting us up, doesn't he? We're going to cut rates soon. We're going to cut rates soon. At some point, you're actually going to have to do it, maybe. Rio is up this morning. So Rio is popping by over 2% this morning on the upside. So maybe that metal story is going to give the FTSE 100 a little bit of traction this morning. The aviation sector is higher as well. Safran, Airbus, both gaining ground. BAE Systems tracking a little bit higher too. On the downside, some of the banks are a little softer, but actually some continuation, I would argue, from what we saw Friday. Novo's a little softer. ASML looks like it's a little bit softer as well. LVMH as well on the downside. SAP giving back a little bit of ground, actually, despite the fact that it's maybe going to be laying off some staff, which usually delivers a positive response on the cost front. But some of those big heavyweight luxury names and chip names are soft.
I think it's interesting, given what we were saying about oil and the way it responded to negative geopolitics on Friday, how it could have responded to positive geopolitics today. This is oil stocks. They haven't. So, you know, just like we were talking about, a lot of the fast money is positioned long oil. You wonder whether, you know, there's a similar sort of thought process going on here with investors who own energy stocks. They're not necessarily selling them at the first sight of 1.7% weaker on Brent.
No, but that comes back to the expectation that at some point Iran is going to respond.
Yes.
That potential doesn't disappear just because we went into the weekend long. We've taken some of that back a little bit. Maybe you do see that coming through, and maybe that we still don't know, so the risk therefore still exists. So maybe you hang on to those stocks. I do wonder as well, there's a lovely Javier Blas piece this morning talking about the fact that maybe BP and Shell could relocate to the States, which would give you a significant
little provocative talking point at 5 a.m. this morning in London.
If people are talking about the fact, I was talking to a fund manager about this the other day, people are talking about the fact that the British government wouldn't allow BP to be taken over, because in some ways BP is a perfect takeover target, trades on a low multiple. You could easily, it's big enough for some of the US guys to consume, but it hasn't happened, which tells you the British government would be happy. How would the British government react if Shell and BP both said, see ya? Right,
yeah, absolutely. And Javier Blas quotes Shell management in that story, saying, you know, there's some frustration that the London market puts this very different valuation on their businesses, not necessarily to do with anything that they do.
Yes, some of it I think is self-inflicted, in as much as they went down the renewables route.
Different choices were made, different regulatory backdrop as well.
It's not just the market on which they're listed. There were some choices that were made as well.
Let's have a look at what we've got on tyre makers as well. Continental was one stock that was gaining this morning. Pirelli is the top European pick for Jefferies. They don't like Michelin much, but it's one of those days, isn't it, where you're seeing some of these reports, reports from brokers having an impact on share prices.
So ironic, because in some ways this is a macro week. But actually on a Monday, with little actually of that macro news to talk about, it's the single stocks that maybe have the bottom-up story that has the biggest impact.
Okay, so that's what we're seeing. Zalando also a decent gainer, getting an upgrade to buy at Citi. So just underscoring that point that we've got those upgrades and downgrades having an impact today. Let's talk about the bigger macro picture, though, and let's start with reflecting on where we've been on the Fed conversation post the payrolls number as we run up towards the CPI print, the middle of this week. After the payrolls report, we heard from the Fed's Michelle Bowman. We know that it's too soon for the Fed to cut rates. We've heard that a lot, and given that we've seen such strong data on inflation and jobs, that's a pretty easy argument to make. But what is the Fed watching for when it comes to that comfort level they want to start cutting rates? Let's listen in to what Michelle Bowman had to say.
Should the incoming data continue to indicate that inflation is moving substantially toward our 2% goal, it will eventually become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restrictive. However, in my view, we are still not yet at the point where it's appropriate to lower the policy rate, and I continue to see a number of upside risks to inflation.
Joining us now is Wei Li, Global Chief Investment Strategist at BlackRock. Wei Li, very nice to speak to you once again. Let's start with your overall Fed expectations. Have they shifted since Friday, since we got that strong on many measures payrolls report as we run up towards the CPI print midweek? What is your current expectation around when the Fed starts to get to rate cuts?
Hey there, good morning, Anna. Well, we still think that June rate cut is likely, although the very strong payroll report last Friday certainly kind of make it more debatable now. We're talking about a labor market that is not only tight, but actually also quite strong, thanks to the 3 million immigration over the last 2 years. And that means the economy could support a higher level of payroll growth, maybe 200K a month, which is double of what we saw previously without stoking inflationary pressure. So we're talking about a reasonably strong labor market against the backdrop of a reasonably resilient economy. And that means, yes, we're still expecting June rate cut starting and 3 cuts for this year. But actually probabilities of that decreasing and being pushed out a little bit more after last Friday's payroll has increased. And this is also on top of the hotter than expected inflationary print in February, both for CPI and PCE.
Wei Li, talking about equity markets and their response to the strength of that data, do equities continue to take the strength of this data in their stride? Do equities continue to say, we like the soft landing story, we're buying that, we're not going to be concerned about any delays to Fed cuts?
Well, right now, equity markets are very much responding to strength of the economy as well as strength of earnings, notwithstanding the fact that we have had meaningful hawkish repricing on the rate front so far year to date, going from 7 cuts at the beginning of the year to 3 cuts, give or take, right now. So I think as long as earnings continue to hold up, the growth story and the narrative of immaculate disinflation will continue to support market sentiment, which is why we remain risk on in U.S. equity markets, leaning into where we have seen earnings growth, such as AI and tech.
Wei, good morning, it's Guy. Do you think, though, the momentum is going to start to slow? I guess presumably it gets harder and harder to generate upside for these equity markets. What do you think the rate of change is going to look like? We've had a very strong start to the year. Does that continue, or do we start to maybe plateau a little bit here?
Well, we're certainly looking at a rising bar from here, given how well equities have done, not just in the U.S., but globally as well. So we have talked about the fact that so far it's been the earnings driving the equity upside, but earnings have been actually revised higher in terms of expectation as well. So we're talking about, for the broader U.S. equity market, 11% earnings growth for this year expected, and the tech sector 18%. earnings expected. And even for the broader market, ex the Magnificent Seven, we're talking about 8% earnings growth expected for this year, which is higher than the levels that we saw in terms of consensus at the beginning of the year. So the bar is rising, which makes it harder to beat as we start earnings season. So I think you're right, Guy, that it's going to be harder to continue the momentum that we have seen so far. Yeah. But we do see this year, which is also why we do see this year as a year of two parts. Beginning of the year, first half of the year, first part of the year, supported by immaculate disinflation, earnings strong, growth strong. But at some point, markets would wake up to the fact that we are in a world of higher for longer, inflation settling at a higher level, and rates settling at a higher level than what we got used to.
Goldman Sachs is out with a note this morning. Their strategists talking about the idea that this year we are going to see, certainly for the rest of the year, Europe outperforming the United States as the catch-up trade kicks in. Do you agree with that?
Well, Europe, in terms of the absolute return we have seen so far in local currency, has already outperformed the US, and that has been supported a little bit by kind of the restart in China, data stabilizing, but also the fact that generally kind of coming from a low multiple levels, there is a bit more room for European equities to kind of deliver performance against a broadly risk-on backdrop. Now, having said that, we are still talking about an environment where in Europe, growth is worse than the US. Yes, it's benefiting from a bit of a global cyclical manufacturing upturn, but in terms of the growth dynamics, is worse than the US and European central banks. ECB is very much facing the trade-off between kind of inflation. Yes, it's coming down faster and surprising on the downside, but inflation versus growth, that trade-off still very much faces the ECB as well. And it's debatable, even though maybe they should cut sooner, if they will cut sooner, right? Because ECB tends to kind of take the lead from the Fed. So because of all of that, we actually still prefer the US equity market over Europe, while recognizing valuation is more attractive for European equities. And certainly there are very attractive selective opportunities within the European equity market universe, such as European banks, for example, which we have liked.
Okay, so the European bank story stands out to you. Can I ask you about, I mean, another crucial factor in the European growth story has been China for a long time. We're watching Janet Yellen, Treasury Secretary in the US, still delivering her remarks and taking questions from the world's media as she makes her trip to her visit to China. She's been talking about not wanting to see China try to export its way out of trouble and actually to try and stimulate domestic demand. Does this have investment implications for you, Wei Li? What are you expecting to see in terms of the balance of demand drivers in China as we go through this year?
Well, for China, one risk, especially in the context of this year, is the big T word, tariffs. We need to kind of think about what the implications could be, as both sides seems to dial up their engagement, which is always good. Talking is better than not talking. Now, the broader context for China is that, again, we're talking about a very low starting point, both in terms of equity valuation as well as in terms of kind of data coming from the very depressed levels that we saw last year. So certainly there is room for kind of a bit of a rebound, bounce higher from these very depressed levels, especially given what we have seen in terms of easing, not the bazooka that would kind of engineer a meaningful turnaround, but certainly a concerted effort to want to stimulate the economy and support the market. So that being the case, given a very low starting point, we could see a bit of a bounce back for the sentiment towards China. But over the longer term, we are expecting Chinese economy starting with a 3 handle by the end of this decade. So structural kind of growth headwinds very much impacting China, aging population, the need for reform. When you bring all of this together, we actually think that we are neutral on Chinese market equities and bonds. There are better kind of opportunities outside of China beyond the near-term rebound from the very low levels that we're seeing.
Yeah. Let's talk about Japan. We're all watching what's happening with the currency, but we're also paying attention to what's happening with the equity market. How much do I want to put in Japan right now? How big a upside do you think that could be? We've already seen a decent run. Kind of give us your sense of the potential there and how big a part of the portfolio it should be.
Well, so far, what has driven Japanese equities has been very much the macro story. The country finally exiting decades-long deflationary mindset. And because of that, we actually upgraded Japanese equities 3 times the last 12 months or so. And we're very much encouraged by the fact that, yes, BOJ is exiting NIRP, negative interest rate policy environment. They're still very much kind of watching where yields are for JGB, Japanese government bonds. Nominally, they dropped the yield curve control, but they actually also then said that they would immediately kind of respond and be very responsive if there is unexpected rise in long-term yields, right? So we still very much think that YCC is implicitly in place. The macro environment is broadly supportive. Earnings are strong, and there are some micro developments from the corporate side, actually, that should drive the next leg up for Japanese equities, which is why we keep our overweight at this juncture, even after the very, very good run that we have seen.
Wei, great to see you. Thank you very much indeed. Wei Li, Global Chief Investment Strategist at BlackRock, joining us. Trying to monitor exactly what's happening with these markets and figure out where we go from here. Do we actually see volatility picking up? But other markets outside the US certainly becoming more on the radar. Let's talk, Anna, about some of the stocks that we are watching. Here are the kind of the core ones that we watch around Europe. Fairly mixed bag, I would say, this morning. It's interesting to see LVMH and ASML both soft, but Novo's turned around a little bit. That's now positive. Schneider's a little positive as well. Nestle, I can't form a clear theme that runs through this.
You're seeing bigger movement in those than you're seeing in the overall indexes this morning. That's for sure, because the overall index moves are pretty slow.
Pretty minimal.
The stock 600 at least is only up 0.1%. The CAC and the DAX do move more, though.
Yeah, I wonder whether there's some of the luxury names maybe kind of turning around a little bit, but we'll keep an eye on what's happening with LVMH. I think that's going to be an interesting tell there. But Nova, yeah, some of the drug stocks are having a better day as well. Some of the other moves that we're watching, keep an eye on the miners this morning. They're up on the back of the fact we are seeing iron ore having a more positive day. To Anna's point earlier, some of the notes actually are causing some movement this morning. So you've got some of the chemicals makers that are moving too. There's a note out from Citi. So you've got, I think Clariant is up. Wacker's also trading higher on the back of an upgrade coming through there. In terms of other stocks that we're watching, Entain is the biggest gainer on the stock 600. Barry Gibson is going to be stepping down. Stella David is going to become the new interim, who became the interim CEO, will become the chair after Gibson retires. That seems to be having a positive effect on that stock. Zalando as well on the move too. That's another upgrade, downgrade story, isn't it?
Absolutely, yeah. Zalando getting an upgrade to buy at Citi on an inflection in growth is the reasoning there. They're saying that the German online retailer should see a return to gross merchandise value growth in 2024. So we'll certainly keep an eye on the clothing retailer out of Germany there. Also focused in on, again, another upgrade story. This is around the tyre makers. So Pirelli named as the top European tyre sector pick over at Jefferies. They're less keen on Michelin, but the whole sector, they're saying, is going to benefit from some structural tailwinds as a result of a shift to larger rim sizes and technology-enabled tyres, which is...
Technology-enabled tyres.
Something we all know we need, apparently.
AI tyres. Now, it feels like people have been looking for where the AI story goes next.
Where do the chips move next?
Yes, round.
That's part of the answer. Coming up on the programme, we have mentioned the basic resources story. Energy also in focus this morning. The oil rally taking a breather despite geopolitical tensions in the Middle East continuing to escalate. We'll get more on that next. This is Breaker.
general advice is continue to seek out companies or people that are maybe one stage or two stage ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
First of all, and figure out exactly kind of what traders are waiting for. So we got a little bit over Uski's Friday. We were waiting for some sort of Iranian response. We didn't get that, but we're still anticipating. So this move lower this morning doesn't feel like a trend shift.
No, I don't think so. I mean, first off, you pronounced my name perfectly, so don't worry about that. Second off, yeah, we're not in a trend shift situation. I think we are seeing prices trend lower, likely because, one, we were in a overbought situation. The Brent 14-day RSI rose above 70, signaling overbought conditions. Second, you also have the comments over the weekend from Israel. They said on Sunday that the country is pulling some troops from southern Gaza, with the forces recuperating, preparing for future operations, including an offensive. So yes, they are pulling back, but at the same time, like you said, the world is waiting for what Iran will do in response to Israeli attacks on their consulate in Syria. So you're kind of in this wait-and-see situation. Oil really sort of tumbled because of that as well. There are a number of reports to wait for from the EIA in the United States to OPEC as well. So that's going to kind of color the week as to how the market is currently shaped.
Okay, and you mentioned some of the geopolitical themes that we're watching. Of course, yes, over the weekend, things that could have happened didn't, and so as a result, the oil price perhaps retreats a little. But there's also some more supply-side driven themes away from the geopolitics, Stephen, that I know are keeping the market focused. Talk us through some of those.
Yeah, I mean, I think it's a wide range of things that have surprised the market, and this is a supply-driven market. Don't get me wrong, right? There is a geopolitical element to this. There is a risk, a war premium because of what's happening in the Middle East, but we are in a situation where fundamentals are driving the prices. So you have OPEC Plus has continued their cuts of about 2 million barrels a day through the end of June. What are they going to do after that? It's not clear, but they're much happier with oil prices around $90 than they were before when it was below $80 Brent. At the same time, you also have Mexico. Mexico is reducing their heavier crude exports to fill their domestic needs. That's going to cut back supply from U.S. refineries. They're going to have to use their own supply. And also, there was this cold, it's kind of interesting how this is all happening together, but there was a cold chill, a freeze in the United States in January, but that cut a bunch of barrels out of the market from the U.S., and they're just catching up. So because of that, U.S. inventories are also a bit lower. As well, we also have, going forward, Iraq is saying that they're going to try better to cut their exports. They haven't been hitting their OPEC Plus targets. So we're probably going to see less supply out of Iraq and Russia as well.
Stephen, product markets have been stronger than the barrel market recently. And I'm wondering whether or not, as the barrels come up, do we see product accelerating further forward, or does that spread start to close? Because none of us buy barrels of oil, we buy product. So what's happening with product prices?
Yeah, so there is a bit more of a crunch on product markets. Most recently and famously, Russian refineries have been hit because of a number of attacks. We also went through a period of refinery maintenance that usually happens in the United States and other places. But yeah, I mean, that is the question, right? If crude prices rise, will that lead to a similar increase in gasoline prices, or will that spread shrink? And that's going to be something that, if I'm Joe Biden, I'm going to be watching very, very closely, because that is the big question. If crude starts to head towards $100 and you're seeing a similar gain in gasoline prices, suddenly the U.S. is calling up OPEC Plus, they're calling up Saudi Arabia saying, hey, can you unwind some of these production cuts? So it's not immediately clear what will happen. There is a crunch with refining capacity, so you could see things rise further, but who knows? The Chinese might be able to come out and really boost their capacity. There are a number of different things that could happen in the market that could solve this, but at the moment, it does seem that there's more pressure, not just on the heavier products, Brent, but also potentially the products like gasoline.
Stephen, thanks so much. Thanks for bringing us an update. Stephen Stapczynski there with oil markets and beyond. Coming up on the programme, India is vying to take China's global growth engine crown as foreign investment floods into the country. We'll get more on our big take story next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Monday, the 8th of April, half an hour into the equity session. Nothing to see here thus far. Single stock stories, there's a few of them floating around. Bond yields are a little bit higher once again. It's a continuation, really, of the theme that we saw Friday. I think we're waiting for the next catalyst, clear catalyst, for these markets to move. One of the stories that we watched back end of last week into this week as well has been Janet Yellen's trip over to China. That's now wrapping up, Anna, but the message has been pretty unequivocal.
Yeah, absolutely. To a number of constituencies she's speaking here, isn't she? She is trying to give a fairly positive take on things, saying that relations are on a stronger footing than they were just a year ago, and we've seen she and Biden meeting, of course, within that time period. She said there are difficult talks on national security, but the ones from an economic perspective that really stand out are the message to exporters: China is too large to export its way to rapid growth, and the message around those banks that might be helping the Russians at this point. Yeah,
that's maybe the new bit that you've been flagging as well. Let's get a take on what exactly is happening here and maybe bring it all together. Bill Farris, Bloomberg's Bill Farris, joins us now. Bill, has the language, has the tone been stronger than we were anticipating? We had the Biden-Xi meeting at the beginning of last week, the phone call. That really didn't deliver anything, and we were wondering whether or not Yellen's trip will be more of the same. It certainly hasn't been.
No, you're right, and I think you hit the nail on the head at the top there. I mean, she did cover a wide range of issues in these discussions. She said in her press conference just now, said she discussed everything from Russia and national security to TikTok, but really the main message, the theme we've hit on almost every day that she's been there has been this idea that China's overcapacity and how that is a priority, not just for the United States, but according to Janet Yellen, for a large number of developed and emerging market economies. There's a lot of concern about how China is trying to bolster its economy amid slowing domestic growth, and Yellen in the U.S. made clear that they think the current approach has to be rethought. She actually used those kind of words. It's not clear that China is really going to shift strategy, but they did signal some openness to talks. There's going to be continued economic talks about what Janet Yellen said would be how to rebalance growth in the global economy.
Yes, it is interesting that she put this in a historical context, didn't she, Bill? She talked about how we've learned a lot over the last 10, 15 years about the relationship between China and the United States, about what China can, how much Chinese export the world economy can tolerate, what damage, if you like, or change or challenge Western economies are prepared to tolerate in the face of those Chinese exports. So there's a lot of history here. What has China's response to all of that been?
Well, there's been disagreement about whether there really is an overcapacity issue. You heard Chinese Commerce Minister push back on that idea. But yet again, I think the fact that there are some kind of talks set to take place shows that Beijing is at least interested in continuing to have these discussions with the U.S. I think Janet Yellen is right in saying that the relationship is on a much stronger footing than it was, say, a year ago when we went almost an entire year without senior level meetings at any level. So there's much to be said for just continuing those talks. Janet Yellen said she is not interested, the U.S. and the Biden administration are not interested in seeing a deterioration in U.S.-China ties. Coming in as a message coming during an election year in the United States, that's saying quite a bit.
Okay, picking up on that, Bill. So the message has been delivered. When are we going to know if the Chinese have been listening?
Well, I think we want to see when these talks actually take place. We expect Secretary of State Antony Blinken to be in Beijing in the coming weeks and months. Are we going to see a big shift in Chinese industrial policy? No, I don't think so. I think it's going to be more about when talks happen, what kind of interim issues can they make some progress on? And we're also going to have to see what the Chinese reaction. I think this will be key to what could be incoming tariffs from the U.S. administration on Chinese goods and restrictions on more high access to high technology. Those are things that we've been reporting for weeks, are under consideration, potentially in the works at the White House. And the Chinese reaction to that will be key to see where this relationship is headed.
Bill, thanks very much. Bloomberg's Bill Farries with the latest on China-US relations. The China growth story clearly looms large over those conversations that Janet Yellen, the US Treasury Secretary, has been having in China. Another growth story, though, very much in focus globally for global investors. India is the subject of today's Bloomberg Big Take story. The nation is vying to take China's crown as the engine of global growth. This, as foreign investment comes into the nation and its government lines up a number of new trade deals. Let's talk more about this. Today's Big Take, then, we will bring in economy and government reporter Anna Roy, who is across this story for us. Anna, very good morning to you. And so in what way is India then looking to take China's crown as this engine of global growth? Because we see varying estimates as to what it can achieve over what time horizon.
Good morning, Anna. Yes, we are talking about how India and China are contributing to the global growth. They are the two main engines of global growth right now. So China and India jointly contribute about half of global growth. India's share is just about 16%, and China's share is 34% of this total world GDP growth. So if India can manage to grow at 2 percentage points more, from just about 7 to 8% now to maybe 9%, then what we are saying is that India will be as important as China as the global growth driver. Maybe in 2028, going by the best case scenario that we have. Otherwise, we are estimating that by 2037, India and China will be the two equal partners in global growth.
Let's just talk about how India achieves this and what are the impediments to achieving this. What does India need to do to make that happen? One of the key areas I keep reading about is infrastructure, but is it just infrastructure? Are there other areas that India needs to focus on?
Yes, so India, first of all, to sustain a kind of growth like 8%, 9%, India needs to work on many things. One is that it has a demographic dividend, but that is good only when they are skilled enough to participate in global manufacturing. So India needs to rapidly scale up its its workforce, its labor force to global standard. So skill development is important. Increasing the participation of female labor force in the total workforce is very important for India. India needs to house this kind of this kind of workforce in urban areas. So urbanization is required. 65% of India's population is still dependent on agriculture or living in rural areas. You need to shift shift them to urban areas. So urbanization is important. For urbanization, you need proper infrastructure. India's infrastructure is improving. It has increased its infrastructure budget maybe by 3 times in the last 5 years to 11 trillion rupees. But it needs to do more. So infrastructure needs to improve. And finally, India needs to bring a lot of manufacturing companies onshore to generate jobs for this population.
Yes. Yeah, I was going to ask you about that because I'm wondering what this means then for India and for the world if India does share space with China as the main global growth driver. I guess that means optionality for big global manufacturers. They can choose China, they can choose India. Take us through your thinking.
That's right. So one is manufacturing, and second is that India can offer a huge market for these manufacturing companies. But more than the manufacturers, it's the producers of commodities who benefit the most, because in early 2000s, China really drove the agenda for the commodity cycle, commodity prices. If they have an option in India as well, India can be one of the important agenda setters for the commodity prices. So it makes you from a price taker to price setter. That is important for India. That is totally dependent on energy, energy import to meet its need. And for producers, that means better price discovery as well. And for manufacturers, you have a ready market where you can set up shop and then you can sell it in the domestic market if exports don't work out.
One of the things we've been watching is the Modi government being quite difficult in terms of the negotiations that it's conducting with other nations when it comes to trade deals. It's playing its cards very close to its chest. Modi has been very cautious, and getting these deals done has, as a result, been very hard. Do you think there is... Does that start to change as India gains more importance in the global economy? How does the Modi government perceive its relations with other big trading blocs changing as it goes through this transition?
Well, any economy will want to see its interest first. So the trade deals that India negotiates with the world, India's interest should come first. And because of India's democracy, and there is a lot of opposition to government policies, etc., so it has to be very cautious about it. However, if you want to be a real global growth driver and want to be a really important player in the world, then you will have to link up more with the world. You will have to agree to the trade negotiations and the terms. And India is actually doing quite well with these kind of trade negotiations, and slowly it will expand more.
Anna, thanks very much indeed. Anna Roy joining us on this story, this huge competition that will shape the global economy in decades ahead. What are we going to do next? We're going to look ahead to Thursday's ECB rate decision. Christine Lagarde, maybe she starts to push the button finally on rate cuts. But is it just June? Is it June and July? How many rate cuts are we going to think are we going to see this year? We'll discuss that next. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up the, we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today, 44 minutes into a European session that has a little bit of upside, certainly coming through from the French market and the German market. The FTSE 100, though, much more range-bound, so that's flat. But elsewhere, we are seeing a little bit of upside. So the stock 600 up by around 0.2%. US futures have actually, in the last half hour or so, turned themselves to flat to positive rather than the flat to negative that we had previously seen. But we won't make too much of that. It is a busy week ahead. Some of the highlights, then, Guy, that we have, of course, coming up this week. Of course, the ECB will be in focus on Thursday. But before that, their lending survey comes out tomorrow. We get central bank decisions from the ECB, but also the RBNZ, the Bank of Canada, the US CPI print will be in focus. And then later in the week, we get that report from Ben Bernanke around, forecasting in the UK.
Yeah, and it'll be interesting to see whether that's about communication or about actual forecasting. We were talking to Kit a little bit earlier on, making the point that data in, poor, data out, poor. That seems to be the story. I think the timing is interesting, though, with the US CPI data Wednesday. If that turns out to be strong, you downgrade expectations of the Fed, and then you get to the ECB on Thursday, where potentially we're upgrading expectations for the number of cuts we could potentially be seeing.
And we don't know how long this persists for, but certainly you're into a period where you've got expectations that the ECB is going to cut, and it's very live, and they're very quite, they're imminent in the sense it's coming in a few months' time. And increasingly, you're asking questions about when on earth is the Fed going to cut, and that we could be in that period for a while.
And how many cuts do we get, and how quickly will those cuts from the ECB become? There's a great story this morning talking about kind of July now being the battleground. It's not we're done with June. Like June feels like it's a done deal. July is now where the action ultimately could end up being.
Yeah, absolutely, and that seems to be where the market's thinking has gone of late. Joining us now for more on this, Bloomberg's Jana Randau joins us from Frankfurt with a preview of the ECB. That decision then, Jana, coming, as you well know, on Thursday. What can we expect then to hear from Christine Lagarde, from the ECB president, come Thursday?
I think what we will get is some sort of a signal on what will happen in June, a confirmation in a way of what has been the expectation in markets among economists for a very long time, that the ECB will first lower interest rates at its June meeting. And that the president has laid out that path at a conference in March. And pretty much everybody has signed on to that timeline. A few policymakers still haven't excluded April, but we think that's more a negotiation position than anything else, and kind of a strict adherence to the data-dependent principle that the ECB adheres to. So a signal for June we expect. Based on the fact that inflation is slowing, it's slowing faster than expected, actually. That the economy is showing green shoots, is coming out of its weak phase, its winter lull, if you want. How far we will be able to look beyond June, that is less clear, simply because the ECB likes to look at data, and a lot of it will come by the June meeting. So I don't think we'll learn a lot more about where the path of travel will take us for the ECB in terms of interest rates this year.
Okay, but you're talking to a lot of people, and economists are trying to figure this one out. The battleground seems to have gone from June, which feels like a done deal, to July. Where do you think the center of expectation is right now? Is it 3 cuts this year? Is it 4 cuts this year? Is it cuts in quick succession? Is there a desire at the ECB to get on with it and get it done and deliver kind of a big impact? Or is it, let's see what an impact of 25 bips has and then we'll move on from there? I'm just kind of wondering what you think the thinking looks like in terms of the sequencing.
My feeling is that they are pretty relaxed about it. So when we look to economists, they expect a move once a quarter. The market is pricing between 3 and 4 cuts this year. And in terms of policymakers, there is really only Greece's Yanis Stonaras, who said he wants to see 2 cuts before the summer break, which is traditionally in August, so a June and July move. Everybody else has been fairly quiet on details, saying yes, we need to ease. There's room to ease, but really saying we need to look at the data. And of course, especially the hawks have been saying, just because there's a June cut, don't expect that there will be one in July, and we need to really look at the forecast. We need to look at wage deals. So my hunch is they will take it as it comes, if you want, looking at the information as it becomes available, and then taking their decision, ultimately saying, well, 4 months or 4 weeks in an easing cycle is not going to change the economy much, of course, because of policy lags. So I don't get the sense that there is a particular urgency at the ECB to now move at every single meeting.
Jana, thank you so much. Thanks for the preview. Jana Randau there with the latest from Germany on what we're expecting to get from the ECB. Well, in focus, the ECB rate decision, of course, this week. Also in focus this week, a report from the former Fed chair, Ben Bernanke. That's expected to be delivered to the Bank of England, and we'll get to see the contents of it. It's going to be suggesting that the Bank of England adopt a new innovation, a flexible set of scenarios in a bid to update its forecasting process and repair its battered reputation. For more, let's talk to Sophia Horta-Acosta from our Markets Today blog, who's gearing up for covering all things UK this week, of course, on that blog. Sophia, good morning to you. Let's start with this Bernanke report then. Much anticipated, nice global heavyweight opinion to add to the conversations in the UK about where policy goes and how decisions should be made. What stood out to me from this was the way that they're asking questions, or Ben Bernanke is going to be asking questions about the way the Bank of England takes market rates and puts them into its forecasts. And that results in some explanations required that maybe are a bit sophisticated for every consumer.
Yeah, and exactly. And the problem is when the market is really kind of expecting something that the BOE doesn't necessarily think will happen. And how do you communicate that to the public versus to the market? And there's been a disconnect between that. And it's not just the BOE. I mean, the Fed, the ECB, they've all had that problem. But the BOE is really the only major central bank that uses market forecasts in its communication. So how do you solve that problem? There were expectations that when Ben Bernanke was asked to review this back in July, that maybe he would go towards kind of the Fed dot plot model, and that's a lot more specific, kind of maps out what MPC members, where MPC members expect interest rates to be. It doesn't seem like he's going to go down that path, and really kind of presenting a range of scenarios does give the BOE perhaps more flexibility as it had during the pandemic, where it could reflect where various MPC members expect things to go depending on where the economy is going as well.
Is he going to recognise that not only does the BOE have a forecasting problem, it also has a data problem? The problem with these big models is that you put poor data in, you get poor data out. It's very hard to forecast. The market rate story is just one element of that, but the labour market data has been really difficult as well.
Yeah, exactly. And obviously, that's not the BOE's fault. It's the kind of when we were looking actually on the blog at last week's jobs report in the US, the level of detail there. You can see how many women have joined the labor force in really kind of niche jobs, and you just don't have that level of detail in the ONS data. You also just, I mean, it's very late. It's about 2 months after the actual month, and it's, how useful it is. There have been criticisms from the BOE itself that it's not really kind of useful data.
So there's differences then across the Atlantic, but they both share this challenge, which is, in an age where perhaps trust as a notion has been eroded, trust in all kinds of institutions, people don't necessarily want to answer surveys, and that seems to be one of the issues that the ONS was running into with its surveys. But that's one that will run and run, no doubt. Really interesting on the London market to pick up on this piece by Javier Blas, our colleague at Bloomberg Opinion, talking about the very real threat for the LSE if it loses some of its energy giants. And this taps into a theme, the London stock market might go out of its way to try and attract new tech listings, but there are many voices who'll say, don't do that, just concentrate on keeping the big names that you've got. And that's what Javier is getting at here.
Yeah, exactly. Concentrate on kind of really kind of elevating the valuations. They're so low in the UK. And this Javier's piece is great. He speaks to big CEOs all the time. He spoke to Shell's CEO. Shell is actually a company that's been doing quite well. The shares rose to a record last week. But still, when you compare the valuations of a company like Shell listed here in London versus Chevron versus ExxonMobil, the valuation gap is just so wide. And Javier is saying, the point that he's making is that people just don't value carbon fossil fuels here in Europe, not just in the UK. There's almost a hostile environment for these companies when it comes to investors, and ESG investing is perhaps more of a trend here than it is over in the US. We also got data this morning from the team at Goldman Sachs that showed more than £5 billion has now left UK dedicated stock funds this year, and that's only this year. And when you consider where that money is headed, a lot of it is in the US, and that's still where the high valuations are. So there's a risk there that companies see this and they think, why are we even here? Why are we listed in this kind of market?
We either relist or we get taken over by private equity.
Exactly.
In terms of the smaller companies, maybe the US private equity industry is better at valuing some of these companies. Sophia, thank you very much indeed. Much more on this on the blog. You can get it on your Bloomberg terminal on the front page of the UK website as well. TLIV Go on the Bloomberg. We've been debating this morning how you say this name.
Yes.
So
I'm going to leave it to you, Guy.
Pooch, apparently,
is
how you say it. So Pooch is planning to raise 1.25 billion in an IPO in Spain. So this is Paco Rabanne, this is Charlotte Tilbury. So there are listings taking place here in Europe, which there have been very few recently.
Yeah, absolutely. And this is the second time we're talking about perfumes listing, isn't it? We had a conversation with the CEO recently. I don't know if there's a trend there. That's a bit niche, perhaps.
I'm sure I mispronounced that company's name as well.
Well, we're all good at that. But this is interesting because it takes us into bank earnings season, doesn't it? Because we're going to be focused on banks at the end of this week.
I'm trying to work out how you go from perfume to bank earnings.
Oh, no, you watch.
I'm sure there's a capital markets kind of...
Yeah, exactly. Investment banking and IPOs. That is going to be something of a theme, isn't it, as we get towards the US bank earnings season, but also commercial real estate. Of course, we'll watch that as well.
Absolutely. I just want to hear what JP Morgan has to say about the US economy, because all the data at the moment speaks to this idea that the US economy is very strong, that US consumers are very strong. They have got higher FICO scores. JP Morgan's got much higher FICO scores, so you're kind of getting a top-end slice of the US economy. But nevertheless, it should be a really useful indicator.
Well, here's something that might apparently boost the US economy. Don't ask me how. Travel is involved, apparently. You've talked about Taylor Swift many times, but there is a solar eclipse coming, and North America gets a great view of this. And I've seen, in a note from Ben Emons, actually, to give him credit, there's a range of estimates that this could add $1.5 to $6 billion to the US economy.
So I'm going to be very British about this. Apparently the weather's not going to be good enough to see it.
You need to be high
most
up,
of America.
and you need a clear sky. Yeah,
exactly.
Apparently, if you're in Wales or some parts of the west of this country, you might get a glimpse.
Again, back to the weather. Always fantastic.
Always back to the weather.
Yeah, but America is going to be in the dark throughout most of this week, potentially.
That's where the focus will be stateside. That is it for markets today. European equity markets modestly higher today. US futures flat to positive. That's Monday. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Monday, the 8th of April. Good morning. Welcome to The Pulse. I'm Guy Johnson in London. Francine is out today. Let's talk about what you need to know, though. European stocks a little higher after that red-hot US jobs report kicked US stocks higher Friday. We're going to take a look at what we need to be watching for the rest of the week. US inflation data Wednesday. That's a big one. Oil retreating, coming off a 5-month high after Israel said it would remove some troops from Gaza. But we didn't get the Iranian attack, which some people were anticipating over the weekend. Traders waiting for a series of reports this week that will provide a snapshot of the supply-demand balance that we're looking at the moment. And the US Treasury Secretary Janet Yellen wrapping 4 days of talks in China, warning that China's banks and exporters should be aware of the risk of sanctions if they support the Russian military. We'll talk about that as well. Let's take a look at what is happening with European equity markets. A little tick higher this morning, a response maybe to what we saw Friday. The US equity markets getting certainly a kick higher on the back of the payroll report Friday. The bond yield story, though, is one I would watch out for. That continues to move higher as well. So a fairly uninspiring story this morning, I would argue, out of European equities. I think we're looking for the next catalyst. The FTSE 100, for instance, very flat at the moment. US futures, they've turned around in the last half hour or so, I would argue. We're a little bit more positive. European equities maybe getting a little bit of a boost, but the S&P is fairly flat, the Nasdaq fairly flat. The Stock 600 up by 0.2%. What else should we be watching? Keep an eye on what is happening with Brent. Brent is a really interesting story. So we're softer this morning, down by 1.2%. We didn't get some of the geopolitical tension that we were anticipating over the weekend in the form of an Iranian attack. So that hasn't happened. So you take some of the oil story kind of away this morning. But the Netanyahu story, I think, is also interesting. He's taking some troops out of Gaza. Is he taking those troops out in order to prepare for that potential Iranian attack? Keep an eye potentially on the border up north into Lebanon. So watch out for that one. I don't think that story has gone away. It's interesting the oil stocks are not lower this morning. Gold's up a little bit this morning. Still some confusion around that. The silver catch-up trade carries on. Copper up by 0.3%. So London miners getting a little bit of a bid in terms of the trade that we're watching out for this morning. This week, in theory, though, and I know it doesn't feel like it this morning, is going to be a macro week. There's a number of key events obviously coming up. US CPI data is going to be one of those key events. Then we get the next day, of course, the ECB meeting. What happens if we get a strong CPI report and then the ECB signals that it could be cutting a number of times this year? That's certainly one interesting scenario. But let's start kind of Friday and figure out exactly the market reaction to what we got Friday. Madison Fowler, Global Investment Strategies at JP Morgan Private Bank, joining me now to discuss. Good morning.
Good morning.
So equity markets liked it. We saw bonds selling off. At some point, those two things are going to start to have an impact on each other. At the moment, equities like the idea that we are in an economy that is good and that should support earnings. But does the higher cost of borrowing at some point start to limit this equity rally? 4.5 on a 10-year, 5 on a 10-year, maybe?
Of course, I think it matters. I mean, we certainly see, the impact and the follow-through effects in some pockets of the economy from higher interest rates. And we've certainly seen some companies during prior earnings season also telegraph some of those impacts. But I think when we think about it in totality, yes, the corporate earnings backdrop remains very important. But I think what we've learned is that overall the economy has been able to withstand those higher interest rates from a broad perspective. And what's quite interesting is that, it hasn't necessarily that strength in the economy come at the expense of restoking inflation. And so much of that, I think, has to do with this, backdrop that we're seeing in the labor market today. And certainly it was echoed in the jobs report on Friday, where you saw a healthy jobs growth number, you saw the unemployment rate tick lower, but you saw labor force participation also tick higher. So really, I think in our mind, that really, I think, meaningful influx of labor supply has gone a long way to rebalancing the labor market. I think really enabling wage growth to cool, ensuring that, growth doesn't come at the expense, again, of inflationary pressures.
Okay, I get all that. Equity markets have been on quite a decent run recently. And that has been based on the idea that maybe we do have a decent US economy. And you can kind of understand the logic between that, but sort of the works behind that. The difference is going to be that potentially higher borrowing costs are going to be perceived as being A, higher, and B, kind of for longer. And is that something that not necessarily changes the overall direction, which is higher, but the rate at which equity markets continue to climb?
Yeah, I think there's an important dynamic there. I think what investors are really trying to tease out is not so much whether rate cuts really start. I think that there's a resounding sense that is true. I think what the debate is really is, what does the path of those rate cuts really look like? Yeah. I think what central bankers really want to do is be able to cut rates in a more measured way. And that, I think, enables consumer and business confidence in terms of having a more stable macro backdrop. I think what central bankers really want to avoid is, to your point, keeping rates too high for too long to where that ultimately cracks something, and then central banks need to cut rates more dramatically. That ultimately wouldn't have a really big boost to demand because it's creating a sense of uncertainty for businesses and for households if you're cutting because things are bad relative to when things are good.
Is the biggest uncertainty, though, for US households right now that things get bad or that inflation continues to remain high?
I think that those are two big risks. I think in my mind there's two tail risks. There's of course the risk that things slow down more dramatically. You see some cracks within some segments of the consumer, which were called out in retail earnings over the last quarter. Yep. I think we're looking forward to the next quarter to see whether that continues. But overall, again, strong labor market, real wages are rising, real consumer spending is also higher. But at the same time, of course, you are also having households call out sticky prices. But I think what's important to keep in mind is that deflation is really rare. Inflation is more of the normal economic environment. And I think starting to think through those price changes that we've experienced over the past few years and the fact that those price gains are now moderating ultimately just takes some time to behaviorally start to impact and set in the minds of households.
A strong US economy, does that continue the trend that we're seeing, the broadening that we're seeing in equity markets?
I think so. Typically speaking, when you have a more cyclically sound economic backdrop that tends to be more supportive for a broadening equity market rally. So while, for instance, the S&P 500 might be starting to look a little bit toppy at the levels that we're looking at today, we expect to see stronger gains from more cyclical pockets of the market. So think U.S. mid-caps, for instance, where earnings this year could, in our minds, eke out around 10% earnings growth relative to a 9% contraction last year. And then you could also look abroad in terms of markets in both Europe and Japan for more of that cyclically oriented exposure.
The ECB is likely to signal at least one cut coming up. The debate now is whether we get 3 or 4 cuts this year out of Europe. The catch-up trade is something that I've read a lot about over the last few weeks, that Europe still has this potential to play catch-up. The US investors are thinking, maybe we're starting to get a little toppy in the States, therefore I look elsewhere, and maybe we see some opportunities that exist in Europe. How sort of predicated is that on the idea that the ECB is actually going to deliver rate cuts? And is that maybe the more significant event here?
Rate cuts are certainly important. I think that, of course, signals that policymakers are even further towards winning their fight against inflation. And I think it also signals that that's not, coming at the expense of the recovery that we're starting to see in economic growth. So I think it's ultimately about what those rate cuts really signify to the market. But from there, again, the earnings backdrop is really important. We've now seen an end to the negative revision cycle for earnings. We're starting to see that inflect higher. You're looking at a 3.5% dividend yields. Corporate buybacks are gaining more traction. So I do think all of those fundamental drivers are in play. But even more important, I think, is where you focus in Europe. In our minds, you really want to be focused on those European national champions, which are multinational companies that are based in Europe, that are very much leaders of their industry. I think continuing to produce really quality earnings growth, exhibiting pricing power.
Are they dollar earners? Is that the narrative here? If the ECB's cutting and maybe the Fed's a little bit more cautious and we can continue with this stronger dollar, do you want to own dollar earners in this kind of environment?
Yeah, I think that's certainly a big component of it, and there is a currency kicker, I think, element to that Europe story.
In terms of, you referenced it just a moment ago, in terms of the kind of the why in terms of central bank cuts, though, this speaks maybe in the opposite direction. Europe feels like it's cutting rates because the economy needs it, not the kind of the mid-cycle slowdown story that maybe the Fed's delivering. We can kind of fine-tune, inflation's coming down a little bit, but we're not seeing economic growth rolling over. So we can take rates a little bit lower and make rates a little bit more restrictive. Europe feels like it needs rate cuts right now. How does that overlay sit on top of the kind of the equity catch-up story? Europe, the economy is struggling right now. Is that a reason to buy European equities? I hear what you're saying about the kind of the big multinationals, but more broadly than that.
So I think you certainly have seen, trailing activity indicators remain quite weak. But importantly, those forward-looking indicators do suggest that the worst is over for the European growth backdrop and that a recovery is underway. So for instance, when we looked at the Euro area composite PMI revision last week, it turned, above 50 for the first time in well over a year. And so I think from that standpoint, yes, ECB policymakers are cutting because you did see the impact of rate hikes, impact their economy more acutely. But I think what I would stress is they're not necessarily cutting into a dramatically weakening growth environment. We are seeing some meaningful stabilization and recovery there.
In terms of what you're watching out for this week, in terms of the surprises, kind of what is the Madison Fowler kind of view of this week? Is it US CPI that provides the shock? Is it the ECB, or is it something else?
I think CPI is really important. I think we need to see how that confirms some of the labor market dynamics that we're continuing to watch. I think from there, what's also important to call out is, we do have a base case for a June rate cut starting for the Federal Reserve. If you do see another, hot CPI print, it's possible that gets a little bit further delayed. And so I do think that's quite important. For the ECB, not expecting anything too monumental, but we would be looking for Lagarde to confirm some of the rhetoric that we've already seen about starting in June as well.
Would a 4.5 on a US 10-year be a shock? Would $100 a barrel on a Brent price be a shock at the moment?
Those are absolutely risks. In my mind, seeing 10-year Treasury yields sustainably go above 5% would necessitate that markets are starting to price in more probability of a hike rather than a cut. I think that so long as we continue to see a cut as the next move, investors should be able to, I think, digest this period of transition.
Great to see you. Thanks for stopping by on a Monday. Madison Fowler. global investment strategist, joining us from JP Morgan Private Bank. What else have we got coming up for you? We'll go back to that oil story. Israel unexpectedly pulling out troops out of southern Gaza. We're going to take a look at what this means for the war with Hamas. That next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So the Israelis over the weekend announcing they're going to pull some troops out of southern Gaza. This is the war against Hamas passes the 6-month mark. The US Senator Chris Coons saying the move is likely a tactical decision in case Hezbollah or Iran attack. They need to have these troops rested and ready. There's also obviously this ongoing conflict in Gaza that is going to be continuing, and maybe they're simply just getting ready for the next offensive. Let's get some analysis on what is happening here with Bloomberg's EMEA News Director, Ros Matheson. This doesn't feel like this is a shift. This feels like it's a tactical reappraisal of a situation they see in front of them. They've got a potential Hezbollah conflict brewing to the north. They need these troops potentially for that, so this could be a redeployment, a rest and redeploy. It's also, we're still watching what's happening in Rafah. We don't understand exactly kind of when that next phase is going to start, so maybe they need those troops for that element as well. Talk me through the kind of the tactical signaling that this decision is delivering.
Well, that's right. There's probably a bunch of things driving this decision. It doesn't signal the end of this conflict. It doesn't signal either that, for Israel that they're winning necessarily. What it means, as you say, is they need to rest these troops. They've got to rotate some of them. They're pulling out a brigade or so. They need to buffer the north of Israel because they're worried about potential for further Hezbollah attacks. Of course, that's another group backed by Iran in the region in the aftermath of that strike on the Iranian diplomatic compound in Syria. They're worried also about a direct hit from Iran, although that's much less likely. We're more likely to see that kind of proxy asymmetric reprisal from Iran. So they need to get their troops in the north. They also want to get them out of Khan Yunis because they want to potentially encourage Palestinian civilians, shall we say, to move north back out of that bottleneck near Rafah ahead of a Rafah offensive. And also removing their troops from Khan Yunis might pave the way, just might pave the way for that hostage deal with Hamas that's being discussed still in Cairo, ongoing, trying to get some sort of temporary ceasefire at least, and the hostage exchange. It might just open the door there.
You talked about the asymmetry of the Iranian response. What do we know about the response that we're likely to get? from the Iranians. They have signaled that it's going to be proportional. They've signaled that it's going to be punishing. But what do we actually know? What are the Israelis doing to prepare for that? Because maybe that gives us the best signal as to kind of maybe what that would look like.
Well, you can see from the Iranian rhetoric, they are preparing themselves for something. They kind of have got to the point where they're going to have to do something because they keep saying they're going to do something. And they viewed this attack on their compound, they said, as akin to an attack on Iranian soil because it was a diplomatic site that was hit. And so they feel obliged to do something. Do they really want to strike Israel directly with a missile hit perhaps on a major capital? Unlikely. I mean, that's going to set off not just a broader confrontation, perhaps draw in the US and Iran directly. And no one really wants that, including Iran. So what you might see again is that asymmetric response that they're often known for. So they use one of their proxy groups in the region and they come through there. So most likely to be Hezbollah, which has already been engaging with the Israel military from the north of in Lebanon since this conflict broke out, and even before that, obviously. But we might see a step up there, which again is why we're seeing Israel, feel the need to bolster their military resources in the region.
Ros, thank you very much indeed. Bloomberg EMEA News Director Ros Matheson. That's the geopolitics. Let's talk about the market response. Oil a little lower. We didn't get the attack from the Iranians over the weekend. Maybe you could argue that the removal of some of these troops from southern Gaza is seen as de-escalation. I think a lot of people are pouring cold water on that idea. This week as well, we're going to get supply-demand stories developed from both OPEC and the IEA. Maybe it's just simply the reason why oil prices are lower this morning is that the market got a little over its skis Friday. Let's kind of put it all together. Will Kennedy, Senior Executive Editor of Energy and Commodities, standing next to me. Oil's lower. Why?
I think I'm going to say it had such a good run last week to go past $90 that it was probably inevitable that we were going to take a breather. People often, as you said, worry about geopolitical risk going into the weekend. Tensions with Iran was obviously one of those risks. As you say, that hasn't happened yet, so it seems like a good day that the market takes stocks of where it is after what's been a very strong run.
So I shouldn't see the numbers on the screen right now as a trend change?
I don't think that anyone's feeling like that. I think that the broader picture remains fairly bullish in that we've got this combination of constrained supply in a number of respects, i.e. that OPEC is sticking to its cuts. We have less supply from other places, like Mexico, for example, and that's meeting a demand side of the equation, which remains pretty strong in most places around the world. The economy in the US especially is doing quite well, and we're about to hit peak demand season when Americans take to the road and gasoline demand peaks.
Okay, so let's talk about that element of this. Oil gets to 100, say. What does that mean for products? What does that mean for US consumers in terms of what they're going to see at the gas station? Is this going to become when does this start to become a political problem, that gas prices are so high in the States that Biden, etc., have to respond?
I mean, I think that may be quite close. One sign of tightness in the global oil market is that refining margins, the profit that people make from turning crude oil that we can't use into products like gasoline and diesel that we can, remains fairly strong. So that feeds through to relatively high prices at the pump. In the US, people tend to see the $4 mark as the point at which people go, oh, I don't like what I'm paying for gasoline. We're not quite there yet, but that may happen in the weeks ahead. And clearly that will be a political headache for the Biden administration as the president seeks re-election. And although gasoline prices don't feed into the measures that central bankers use to take rates, clearly that also has the risk of feeding through the wider economy and complicating the inflation picture as well.
Will OPEC, if we're getting towards 100, does OPEC respond?
I mean, this is going to be the key question for the market going in the second half of the year. Clearly, they said that they're going to keep their current cuts in place until the midway point of the year. I think that we don't know, but it's reasonable to assume that Saudi in particular would perhaps like to put more oil into the market. They're only producing 9 million barrels a day. That's historically very low and probably not where they want to be. Yeah. And given the strength of the market, I think that it may be that they'll want to gently put some of that oil back into the market. But we don't know yet. We'll have to see in the weeks ahead.
Thanks, Will. Will Kennedy, Senior Executive Editor of Energy and Commodities here at Bloomberg. Plenty more still to come. It's going to be an interesting week, macro week. We're kind of starting off quietly, but believe you me, there's a lot still to come. This is Bloomberg.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
So this week starts quietly. We've got a nice, relaxed, easy Monday, but believe you me, things are going to be heating up. It kind of really starts Wednesday, if I'm being brutally honest. You've got the US data, the CPI print. That's what we're going to be watching out for. That's really going to set the trend. Or is it actually Thursday, the ECB rate decision? We kind of know that Christine Lagarde is going to be pointing us at the idea that we're going to be seeing a June rate cut, but is the debate around July going to start to manifest itself in the press conference? Bernanke Friday, pay attention to that. You're going to want to watch out for what he has to say on the Bank of England's forecasting skills and how they should change. In terms of European markets, quietish again today. Keep an eye on bond yields, though. This is the picture that we're watching right now. Not much movement, but as I say, this week is about to kick into gear. Up next, we'll talk about Janet Yellen's trip to China. This is Bloomberg.
Culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called the culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Wall Street, we're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Goods to Russia's defense industrial base expose themselves to the risk of U.S. sanctions.
Jill DeCease joins us now for some analysis on this. Bloomberg's Jill DeCease. Jill, how seriously do you think Chinese banks are going to take the threat that Yellen has delivered on Russia?
Well, I think that at this point, this is actually pretty in line with what the U.S. has warned on these types of issues before. China, of course, in the past said that it's not in contravention or violation of specific sanctions or anything like that. I think that it's really kind of part of this all-encompassing mission that Janet Yellen is on in China, where she's kind of hammering home a lot of key U.S. criticisms of China, particularly on economic policy, or in this case, geopolitical policy. The other one that she was really, really hitting hard over the past couple of days, too, was this issue of industrial overcapacity from China. So China exporting too many low-cost goods elsewhere in the world and sort of creating a lot of economic imbalances. So we did see her really sort of stress some of these issues. I think that, from the China side, it does seem like they've actually been pretty diplomatic, pretty receptive. She's had a lot of closed-door meetings with really, really key officials in China over the past few days. So we'll see what ultimately comes out of that. But, despite some of this rhetoric that we're hearing from Janet Yellen that feels pretty stern, she's generally seen as Washington's good cop when it comes to China.
But let's kind of extrapolate and think about what happens next. Is this a signal that effectively the tariff review that the US administration is undergoing at the moment is going to deliver a tougher message? And extrapolate even further forward into the November election. Is it a message that basically we have to fight fire with fire here? If the Republicans are talking about significant tariffs, we're going to have to do that as well.
Well, look, I think that on the China side, if anything, you probably want to sort of tone down some of the fiery rhetoric heading into that, U.S. election in November. Trump has proposed tariffs of up to 60% on Chinese goods. So I think that's what you're kind of getting out of the Republican ticket here. It's not extremely surprising that, China has actually been, on the whole, fairly welcoming to Janet Yellen over the course of the trip, very diplomatic. It sounds like they weren't actually actually, hitting her extremely hard back behind closed doors. So I think that at this point, it actually makes sense for it to be more of a diplomatic mission on the China side if you're trying to, win over favor with not just Yellen, but the rest of the Washington administration here.
Jill, thank you very much indeed for the analysis. Jill DeCease joining us on this trip. Let's continue the conversation. Janet Yellen has maybe been listened to. Is that the takeaway that we should assume now? Lizzie Galbraith, political economist at Aberdeen, joins us now to discuss. Lizzie, what do you think? What do you think the effect of this trip is going to be? And were the Chinese listening to the warnings that Janet Yellen was delivering?
Well, we've definitely seen Chinese willingness to continue the conversation. So what we've got out of this trip is a promise for more talks. And that's never viewed as a bad thing in US-China relations. The fact that we now have both sides talking on multiple issues more frequently than we were seeing last year is undoubtedly a positive for the relationship. And it's something that Yellen herself pointed out, that relations have stabilized over the last year. That's something that the Biden administration is probably going to want to point to as we get closer to the election as well, that they are able to, while still maintaining a willingness to have these difficult conversations, have a more stable relationship with China than maybe the Republican policy platform offers.
Nevertheless, China's got a big problem. Its economy is not firing on all cylinders. It needs to figure out a way of maybe improving its economic outlook. Its hands are tied in so many ways, and one of the most obvious ways of achieving that economic revival is to use its huge industrial footprint to export to the rest of the world. What happens if it has to do that? What kind of response should we be expecting?
I mean, we haven't seen China make any promises to cut back its production or to reduce its exports. So I think from a Chinese perspective, this is going to be viewed broadly as business as usual. However, we are seeing a number of countries alongside the EU start these investigations into some products supplied by China, particularly electric vehicles. That seems to be the main focus at the moment. And if we do see more action taken to curtail Chinese imports in these areas, then that may, if it's a substantial enough policy, elicit some sort of Chinese response. But I don't think it's actually going to be in Chinese interests to really elicit a very strong response to any of these measures. It's really a matter of neither side really wanting to rock the boat too much, but everyone's got interest domestically as well, where they want to be seen to be taking action against these issues.
How seriously should we take the threat that Chinese banks and businesses could be sanctioned if they continue to support China, to support Russia?
I think it's the US has obviously got to make sure that threat is something that is credible, but it's not something that we're seeing as an immediate problem for China. We're not seeing it's being likely that the US is about to announce, a significant sanctions package against Chinese banks. But it is something that the US is going to want to keep as a credible option on the table as the war in Ukraine moves forward, and particularly as the US gets closer to the election as well. It's going to want to maintain credibility that it can escalate if it feels the need to, but we're at the moment seeing this broadly as a rhetorical threat rather than something that the US is preparing at the moment.
Lizzie, can I just turn our attention to what is happening in the Middle East? We're watching the Israelis potentially pulling troops out of Gaza in response to, well, we don't know yet. Maybe it's a need just to rest those troops so that they can take part in the Rafah offensive. Maybe it's because they're worried about potentially the Iranians using Hezbollah to attack to the north. We're on tenterhooks this week waiting for some kind of response from the Iranians. How are you thinking about what is going on, and how significant do you think the Iranian response will be?
It's been something that we've been monitoring very closely, and we do have an expectation that the conflict is going to continue for a number of months yet. We are seeing it evolve. And it is completely possible that Israel is changing a tactical focus. We've also seen increased activity across Israel's northern border as well, and that does obviously bring with it risks of conflict spillover that would, in our view, amplify the risks to regional stability. So it's something we're very closely monitoring as well. As things currently stand, we see the conflict continuing without any significant spillover for the next few months. But that risk of spillover does remain really quite significant, and we're therefore keeping a very close watch on it.
Should we expect a higher oil price? Is that the most logical response to the kind of scenario that you're seeing in front of you?
Our base case isn't for a significant increase in oil prices as things stand, and that base case still stands even with the current Israeli troop activity. Our escalatory scenarios do include some increase in oil prices, but we have to take into account the other global factors that are maybe weighing down the oil price as well. So yes, this potentially puts upward pressure on oil prices in the event of escalation, but we're also seeing downward pressure elsewhere as well. So we're not expecting a very significant spike.
Okay. There's a lot going on. Lizzie, thank you for giving us some analysis on what is happening here. Lizzie Galbraith, political economist, joining us from Aberdeen. Coming up, we're going to take you through the big take. Can India take China's global growth engine crown? We're going to take a look at the foreign money pouring into the Nifty 50. That's next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is The Pulse. Good morning. I'm Guy Johnson in London. Francine is off today. Let's talk about what's happening over at HSBC. The bank's CEO, Noel Quinn, says he's pushing to improve the bank's wealth management capabilities in China and in India so they're just as strong as in its home market. He spoke exclusively to Bloomberg's David Ingles earlier as the bank hosts its first Global Investment Summit, which is taking place in Hong Kong.
In 2023, the performance of our wealth and personal banking business here in Hong Kong, we saw significant customer acquisition growth.
Right.
We also saw around about a 50% growth in our insurance and wealth business in terms of the new business they were writing last year. So the facts are, wealth management is continuing to develop and grow here in Hong Kong. The liquidity base here in Hong Kong today is higher than pre-COVID levels. So I still see Hong Kong as a vibrant financial center. Capital markets are subdued at the moment, but that's a function of still coming out of COVID, the economy is waiting to recover. What will inflation and interest rates do?
Right.
But we're seeing some early signs of the debt capital markets starting to pick up as well. So the facts, I think, support the fact that Hong Kong still is a vibrant financial market.
Right. Now, I know you're set to report your first quarter earnings in a couple of weeks, so you can't get into the details as well. But we just wrapped up, of course, the calendar quarter.
Yeah.
If you could also indulge us, how do you think the quarter went for you guys, generally speaking?
Well, 2023 went extremely well. Over $30 billion of profit. A record profit. And that's a culmination of the hard work of our colleagues over the past 4.5 years, and also the loyalty of our customers. They've been very supportive of HSBC as we went through COVID and transition. Our returns were the best for over 10 years. And our dividend at 61 cents was the best dividend for 15 years. So I was really pleased with the performance. We're never complacent. We're making sure that we're well positioned for the future, and we're continuing to invest in the business. We're investing in wealth management here in Asia. We've done a number of acquisitions to do that. Right. The most recent one that we announced was the acquisition of the Citibank wealth management business in mainland China. We bought an insurance business off AXA in Singapore, and we bought an asset management business in India. And again, just to put it into context, every region performed well last year, and every business line. In India, we made over $1.5 billion profit. If you put BOCOM and our own shareholding of our own bank in China, we made over $3.5 billion profit. So, well-distributed profit across the world, and all parts of the bank doing extremely well.
We've done some reporting on your plans around your assets in Germany. I was wondering if you could comment on what your plans are for those assets.
We remain absolutely committed to being an international wholesale bank across all of Europe, including in Germany. So there's no change to that.
Okay. So those are not for sale?
Those are not for sale. We have some business lines in Germany that are non-essential to international wholesale banking. And we're considering options for those, and that's what the rumor and the speculation was.
Right.
But that is not about our international wholesale banking proposition or corporate banking proposition in Germany.
Thank you for clarifying. Assets in Russia, I know the bank has also been looking at that. If you could give us an update on whether those are actually up for sale and when you want those.
Well, we have
a price tag for them.
We have regulatory approval to sell that business. We're going through the final stages of trying to close that transaction, but it is our intention to sell the business. We have regulatory approval on it, and we're in the process of trying to close that transaction. That was, of course, the HSBC CEO, Noel Quinn, speaking to Bloomberg exclusively at the bank's Global Investment Summit, which is currently taking place in Hong Kong. Let's focus more on the kind of the India-China story. So India, very much the subject of today's big take, the nation vying to take China's crown as the engine for global growth. This is foreign investment floods into the nation, and its government lines up a number of new trade deals. Let's dig into this story a little bit more. Bloomberg economy and government reporter Anna Broyd joins us now. Let's talk about how far we are away from that kind of that story where India is the most important part of the global economy, that it supersedes China. In what way does that happen? How does that happen? What are the kind of the levers that are being pulled to make that happen?
Yeah, sure. So India contributes to about 16% of world GDP growth now, and China contributes to about 34%. But China is decelerating, and India is growing rapidly. It is the fastest growing major economy in the world. So from 7 to 8% now, if India can grow at 9 to 10%, which is not impossible for a country like India because it has grown at close to 9% in the past. The estimate by Bloomberg Economics is that by 2028, India can be as important as China in its contribution to global growth. And in worst case scenario, even India maintains this kind of growth rate, then probably India will catch up with China as the as one of the most important global growth drivers, equating with China by 2037.
What does India need to do to make that happen? What does it need to do with its population? What does it need to do with its infrastructure?
Yeah, so India needs to do a couple of things right to do that, to sustain that kind of growth. India needs to skill up its population. India needs to focus on urbanization because a lot of people will have to be shifted from agriculture to manufacturing and services sector. For that, you need to house them in urban areas. You need to give them housing, and that is essentially building up infrastructure for this kind of workforce that you will be needing. And then to skill them, urbanization, and you need to ramp up the infrastructure. And then finally, you need to bring a lot of manufacturing companies really to provide the jobs for this kind of population and the continued jobs. Right now, in many jobs are gig economy kind of work, but you need more sustainable long-term kind of growth.
There's a lot of trade deals being negotiated at the moment. How important will they be? You talk about access to the rest of the global economy. How important will the Modi trade deals be?
Yeah, trade deals are very important. If one country has to be one of the global growth drivers or a major player in the world, then it has to agree with several of its trading partners on trade deals, trade terms that are equal to both interests. India is doing good on that part. It has signed a trade deal with a small market, European market recently, and it is in talks with UK for a trade deal that may happen soon. And then it is also in talks with Dubai and other markets to, with Australia. So those trade deals are coming, are falling into place, and then these are very important if India has to be one of the global growth drivers, and it is happening.
We're going to watch the space very carefully. Anup Roy, thank you very much indeed, joining us from Mumbai on today's Big Take. Coming up, it's not a big take, it's a big week for central banks. We're going to look ahead to US CPI data, which is going to inform us a great deal about what the Fed does next. Of course, it's the ECB decision on Thursday. And we get this big report from Ben Bernanke on the Bank of England and its forecasting. We'll talk about all of this next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
So Wednesday, US CPI. Thursday, ECB. We've got a strong jobs number Friday. Which of these two are going to bring us the biggest surprise? Let's find out. Bloomberg Opinion. Marcus Athworth joins us now. Marcus, which one are you watching? Feels like the ECB is just going to tell us that June is going to probably deliver a rate cut, but there's a signal potentially beyond that. And a hot CPI print, what does that do to the market?
Yeah, well, I think the CPI print in the States could be quite mild, particularly on the core number. It could be as low as 0.2, which may take some of the heat out of the recent chat that there isn't enough progress. We've had both in Europe and in the US, January, February was a little higher than people had hoped for because there was such great improvement in most of 23 on the downward trajectory for inflation. But we've seen in Europe, and I think we'll see equally in the UK, that trend's carrying on. But in the US, we cannot say that yet. So obviously we're waiting for Wednesday. If it's a better number than expected, which I'm hoping for, particularly on the core number, then maybe it may take a little bit of heat out of US yields. You're right to mention the ECB on Thursday. I had written that it should be on their agenda to cut rates. However, I am a realist.
Yep.
And I don't think it's very likely at all that they will actually preemptively cut here in April. I hope they do for their own sake, but I didn't expect it.
Let's talk about treasuries for a second in more detail. There's a lot of supply coming through. There's a lot of sort of credit supply coming through as well. People are talking about 4.5 on a 10. People are talking about 5 on a 10. Do you think investors are being paid enough right now in terms of yield?
Yes, I do. And I think that's why credit spreads are doing so well, and investors are enjoying this. They're sitting back for once and know at some point in 2024 that they are going to have a very nice time because yields will start to come down because central banks will have to cut rates. And Powell's made that very clear. You know, it doesn't necessarily mean that a strong payroll number means they won't cut. They will still cut. You know, monetary conditions are tight and getting tighter the longer rates stay where they are. I think that's what people fully appreciate. That if the Fed cuts by 2 or 3 times this year, it'll only bring or keep monetary conditions at the same level. And I think that particularly in Europe and the UK, they need to get ahead of it. The luxury that the Fed has is time. And so I still think they'll cut in June. But obviously, if the numbers continue to be less pleasing, then there is a chance that they'll push it out to July, August.
Marcus, great stuff. Thank you very much indeed. That wraps up this show. The brief is next. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
U.S. futures post modest losses ahead of a busy week that includes inflation data and the start of the earnings season.
Janet Yellen wraps up a high-stakes trip to China. Top Chinese officials gave the Treasury chief a warm reception despite her tough rhetoric.
And the oil rally takes a breather as Israel says it's pulling some troops from Gaza. Meanwhile, no progress is made on the peace talks, according to Al Jazeera. She's back by popular demand, and I'm relieved.
Man, the thing is, you take a week off, you try to relax, and then your dang Bloomberg on your phone keeps popping up with all these headlines.
That's what I like. Bit of productivity out of you. Never far from a Bloomberg on a phone. Okay, let's get into these markets. I would say that the bond market has been singed, not burned, but that acceleration higher in yield continues this morning. 20 basis points last week, and again, we add another 4 basis points this morning. Counting down to core CPI, which the core will have hopefully dropped back to plus 0.3%, but still year on year, miles away from where the Fed wants to be. Peter Cheer and a number of others have said to me, look, 4.5 is where the real money comes in. Well, I'll believe that when I see that. Gold takes out another record high. PBOC buying gold for the 17th month in a row. The Indian central banker also saying we are building our reserves of gold. I wonder why. Is it a question about what happens next to the dollar? Net longs on gold are up 13%. Brent down 0.7%. I mean, the pace, the acceleration in this oil market, up 4% last week, Danny. We understand Israel pulling troops back from Gaza, but of course we have got yet to understand what is the quantum and the significance, that is the word, of the Iran response to Israel. That is the alpha in the oil market. Good morning, welcome back.
Thank you, Manus. And it was those geopolitical headlines as well as a hawkish Fed that really gave this equity market the first scare that we've had this year. We see that continue to filter through today. Yes, we rebounded on Friday, but last week was still the worst week for U.S. equities in 3 months. So we fall lower this morning, marginally down about 0.1% for both these indices. The good news, according to Mike Wilson, is that we are seeing a broadening out because of economic news. Can you imagine that? A little bit of a bullish sound from Mike Wilson over at Morgan Stanley. European equities, they continue to form despite their first fall since January. That was a fun fact from Manus Cranny. Thank you very much for that, Manus. So we're up about 0.1%. The energy complex really carrying things here. Energy, at least when it comes to the U.S. sector, is at a record high. Meanwhile, Manus, you got some breaking news for us.
We have indeed. This is on TSMC. They are going to get an $11.6 billion worth of grants and loans. And the idea, or the project, is to build 3 chip plants. So, of course, take your mind back, Danny, just a couple of weeks ago, we saw Intel, the major beneficiary of the CHIPS Act. Today, it is TSMC. This is the AD, or the American Depository Receipt. The stock up 1.125%. It's going to be made up of $6.6 billion worth of grants and $5 billion worth of loans. So this is about onshoring and building resilience in the chip space.
Yeah, so it's going to support $65 billion in investments, as you say, at the 3 plants by TSMC. We should keep in mind with this, it's not just TSMC that benefits, but they're also the main chip builder for both Apple and NVIDIA.
Yep, $200 billion worth of U.S. investments since Biden took office in chips. And it is, look, that oil market, I mean, it was furiously higher last week, up by 4%, and it was a lot to do with geopolitics.
But I think the interesting thing, though, even with that geopolitical strength, U.S. equities are still 1% away from their all-time high. As Matt Maley over at Miller Tabak puts it, you should price it in, because although supply disruptions are rare, I mean, global pandemics, they're even rarer. So it doesn't stand to defy reason to price something in at this point.
I just wonder at what stage does that spike in yields really begin to challenge the equity market narrative, because it hasn't really thus far. Although last week we ended down overall on the week, we spiked higher on Friday on the jobs report, but overall on the week lower.
I mean, it's still resilience. And let's get more into that geopolitical story, because the Israel-Hamas war, it has reached its 6-month mark. Military officials say that Israel is pulling some troops out of Gaza, with Netanyahu claiming that victory is coming. Joining us now is Bloomberg's Roz Matheson. So, Roz, we have Netanyahu saying this, that victory is coming, pulling troops out. How does it affect a potential offensive in Rafah?
Well, it's interesting because this move to pull some of the Israeli troops out of Gaza really is probably a 4-pronged tactical move by Israel. The first one is they need to rest and rotate some of their troops. They've been fighting in Gaza for the better part of 6 months. They are leaving significant presence there at the same time. They need to buffer their resources in the north of Israel because they're worried about further attacks from Hezbollah, which is another Iranian-backed group operating in the region, especially in the aftermath of that Israeli strike on the Iranian diplomatic compound in Syria. So they think it might come from Hezbollah, so they need more troops in the north of Israel for that. They also possibly may be doing this to try and navigate, finally, a ceasefire with Hamas, part of the agreement of getting hostages exchanged, obviously, also for Israel. But if they pull them out of that major city area, that might just open the door to that conversation with Hamas about a hostage exchange for Israel. So there's that. And also, it gives them room to get Palestinian civilians to go north out of that chokehold area in Rafah, right near the border, ahead of an offensive. So it's not necessarily about a victory for Israel at this point. I mean, eradicating Hamas is a very difficult task. Can you ever actually do it entirely? But it could be a tactical move ahead of this potential offensive in Rafah, and also to try and get some kind of ceasefire deal with Hamas at the same time.
Well, the proposition is that it's an impossibility to eradicate an ideology over the physical. We have heard from Iran over the weekend talking about a significant response and warning to the United States. Where do we think this significant response will come from via the proxies in response to the movement by Israel in Syria just a few weeks ago?
Well, it does feel as though they have to do something. They've been saying for days that they are going to do something, and they've really got themselves to the point where they're obliged to react. And of course, for Iran, what they saw, this attack on the diplomatic compound, as essentially an attack on their own soil. So they are going to be obligated to retaliate in some fashion. But do they really want to come at Israel directly? I mean, a direct missile strike from Iran on Israel would be fairly well, unprecedented. And we're talking about a very big escalation then in a conflict, perhaps drawing in Iran and the US directly. And even Iran doesn't want that. We know from the back channeling that's happening with the US that they don't want that broader conflict either, but they're bound to respond in some fashion. And so what does that look like? More than anything, as you say, it's probably going to be that asymmetric response. So what you get is sort of using Hezbollah, picking up attacks over the border from Lebanon into Israel. That was the most likely response, or via some of the other proxies, including the Houthis in Yemen.
Indeed. Well, I think the language that's being used from the proxies is ready to slap Israel. So let's see what that is. Ros, thank you very much. Great context this morning. Ros Matheson setting the Middle East agenda. And that Middle East geopolitical upsets is having major impact on the oil markets. Our guest this morning is Nadia Martin-Wiggin, Director of Svelland Capital. Nadia, thanks for joining us. Last week we saw this market move higher in Brent by 4%. That was a timid geopolitical response, one could say. Rapid in energy, talking about a 30% probability of an escalation in the Persian Gulf, and that could be $40. Escalation risk, how underpriced is it? How at the money is it at the moment? Good morning.
Good morning. So what we saw at the end of last week was definitely some political risk being priced in, but also it's reflecting fundamentals of a tight oil market that is only going to look tighter in Q3. We had OPEC deciding not to increase production at this point. We expect them to do it in the third quarter. But when we see this geopolitical risk and we see additional potential response from Iran, that reminds the market that maybe OPEC can't just bring back 500,000 barrels per day or 2 million barrels per day of production at the drop of a dime. I don't think the political risk is priced in. We think as Fallon Capital, this is the dip for that buying opportunity because the market is only looking tighter for the next 4 or 5 months.
Nadia, what does it look like to have that political risk priced in? Is it just $100 a barrel? Is it more than that? Where does it go?
Well, it depends on the momentum of who is buying. In the short term, it's very difficult without a U.S. supply response or OPEC stepping in to see an automatic limit. On the other hand, we have refinery maintenance going on in Asia, in China in particular, and in Europe. So that will limit some of that upward buying. So we could start to see some difficulty in the physical market like we saw in October last year. We're nowhere near that in our view right now in terms of the physical market building up. So it's very difficult to say at what level. We've broken through $90. We dipped back this morning. That looks like a strong price point, but in 95 is probably the next target. But it also depends what happens in the rest of the commodities complex. And this is where we had the Bloomberg Commodities Index rise above the 200-day moving average last week. So that is supportive. That's driven by copper, by gold. You've been talking about in oil to bring in that passive money to support oil to that next leg higher.
The corollary to this conversation is, of course, where is demand destruction in the new world? We have the PMIs improving in China. We have things on the manufacturing side here in the United States are improving. Things are improving on a global basis in manufacturing. And if China is earnest in their 5% target, it could certainly add momentum on the upside. Where do you think in 2024, 2025, demand destruction is realistic?
At what price? I mean, it's very difficult to put a number. Historically, we've thought it's more than $100, 110, 120. But of course, it depends where sanctioned oil is. We're now hearing that Iranian oil is going to go $1 cheaper to China because Brent has moved higher. So it depends if sanctioned oil can continue to flow out of Russia. That can increase now because these refineries are out. Iranian oil and Venezuelan oil continue to flow. On the other hand, if all of that is squeezed, then on the Brent and WTI prices, we might start to see some tightness. I think a critical point this week is the EIA is going to report how they think U.S. production is going to be coming back after these January outages from winter storms that took down production 800,000 barrels per day, month on month. So I think that's something to watch in the market to see what that means for communication from OPEC, because more production from OPEC come Q3, that's good for shipping. More out of the U.S., that's great for shipping. And of course, for American producers.
Oh, it's all these sort of incremental things that have started to add up to the supply picture. You have Mexico slashing its crude export. There are stranded Russian cargoes at sea. The Houthi rebels have delayed some of the shipments in the Red Sea. Add those all together, Nadia, what degree of supply disruptions are we actually talking about right now?
Well, we have the potential of losing hundreds of thousands of additional barrels of oil, right? And this is where this force majeure in Mexico that was viewed as very temporary, they have a refinery starting up. So that means that more refined products should be coming out, because ultimately this is about refined products. It's about gasoline being available. You look at refinery stocks, equities, they are still flying, very much so. So we could lose hundreds of thousands more, but right now, in our forecast, we need a minimum of 500,000 barrels per day additional supply coming in through Q3. And then an additional 500,000 barrels per day minimum coming Q4 over Q3. So one thing is the supply shocks. The next thing is about these legs up in production.
Nadia, so wonderful to get your thoughts this morning. As you say, oil is lower this morning, $90 a barrel on Brent crude. That's Nadia Martin-Wigan of Svelland Capital. Okay, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Chinese developer Shimao is facing a demand to liquidate from China Construction Bank. It's been nearly 2 years since Shimao defaulted. The winding up petition is related to a financial obligation of just over $200 million, and it also marks one of the most prominent examples yet of a Chinese state-backed bank trying to claw back money from a distressed developer.
Apple has accepted EU demands to stop barring music streaming services from informing users of deals away from the App Store, but it will still charge a fee on those sales.
David Ellison is closing in on Paramount. The new movie producer and tech heir has had a month to seal a definitive agreement, but first needs to sell Paramount's board on the merger with his production company, Skydance Media. Ellison would serve as the CEO of the combined company, according to the People, who asked not to be identified due to the sensitive nature of the negotiations. His father, Larry, the co-founder of Oracle, is one of the several names being floated for the role of chair. Manus.
And the CEO of Rolex, Danny, says viewing luxury watches as investments is dangerous following a surge in interest from speculators during the pandemic. The CEO sees a slowdown hitting the sales of smaller watch brands a little bit harder.
Wouldn't you want people to buy it? Wouldn't he like that? This idea that it's an investment, isn't that a good thing to sell to potential buyers?
Have you tried, well, I mean, if you just got to look at the second-hand market for
Have
Rolex,
I tried to buy a Rolex? I've not tried to buy a Rolex.
I wasn't going to go down that road. What you want to do is diversify into Tudor. Apparently Tudor's having its own moment in the sun.
Good to know, good to know.
Sober issues coming along. We're talking about the Treasury Secretary, Janet Yellen, wrapping up her trip in China with a warning against the nation's banks. More on that story.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock, yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Continue to be concerned about the role that any firms, including those in the PRC, are playing in Russia's military procurement. I stress that companies, including those in the PRC, must not provide material support for Russia's war, and that they will face significant consequences if they do.
Treasury Secretary Janet Yellen wrapping up her trip in China with talk and a sharp warning. For more, let's get over to Bloomberg's Jill Dissis, who joins us now from Hong Kong. Jill, as we're talking about during the break, I mean, it was a holiday in China, so I guess a few government folks weren't able to enjoy that holiday. So what message was Yellen trying to send on this visit specifically?
Yeah, look, I think, Danny, that Janet Yellen came into Beijing, her second trip in the last 9 months, probably her last as Treasury Secretary ahead of the U.S. presidential election this November. She came to deliver a pretty critical message. One, we just heard her really kind of warning against circumventing any sanctions on Russia. It's a longstanding U.S. Political policy when it comes to China's relationship with Russia, but I think made all the more important by the fact that she's delivering that message in Beijing. And then the other bit of her message really was to criticize China on issues involving overcapacity. So this idea of exporting low-cost goods to the rest of the world to an overextent. It's kind of interesting, though. I mean, this is very critical of Janet Yellen, but ultimately she still is kind of Washington's good cop, and I think has a lot of respect among Chinese officials. And it does seem like overall her visit was actually received very well, very diplomatic, and she had quite a few, I think, pretty pleasant exchanges with a lot of these top officials in China.
How did it go down? If I said to you, what was the reaction in China? I mean, were they robust in their defense about tariffs and sanctions that had been leveled on their economy, as Yellen was in her chastisement of the treatment of American companies? Was there a quid pro quo?
Well, Manus, this is actually the interesting part of it. So it does sound like, while there was, at least a little bit of pushback in some of these private meetings, really not a ton. I mean, look, I think at this point, the U.S. does have more leverage in meetings like this than China does, just because China's dealing with a lot of very, sensitive issues around the domestic economic slowdown, and they do kind of have to play nice a bit with the U.S. ahead of this election in November. Remember, it's Trump, the Republican, presumptive nominee, who's ultimately proposed a 60% tariff on Chinese goods. See how far that would actually go. But yes, ultimately, China does have to play nice here a bit. We saw the strongest response really in Chinese state media, where you got more of that sense of that pushback. But it does sound like, on the whole, her meetings with these top officials actually was pretty diplomatic.
Yeah, well, of course, there's a new note out from Goldman Sachs talking about that very topic in terms of if the new tariff plan came to bear. It would be effective. It would reduce U.S. growth by 1/8 of 1% every time China retaliates. So, it's certainly a lot of political hay to make between now and the election. Jill, thank you very much. Jill, this is in Hong Kong. Snapshot of bonds. We talked about this, Danny, which is sort of the vertical movement last week. It was 20 basis points. Here we are starting the week, another 4 basis points. This is the European market and the Asian market playing the classic catch-up and selling off into that strength on the data that we had on Friday, the jobs report, and indeed the drop in unemployment.
Yeah, it's remarkable to look around the turnaround and what we're pricing in. Just 60 basis points of cuts now priced in from this Fed. We started the year at 158.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking. and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is Bloomberg Brief with Danny Berger back in New York and myself, Manus Cranny, alongside her. What does it take to get back into the heart of Cathie Wood? That's the question. What does it take to be #1 at Cathie Wood's ARK Innovation Fund?
I guess a big dip, and Tesla has had a big dip, as you will know from all the conversations of, is it really the Magnificent Seven? Is it the Mag 6?
Bifurcation, Danny, bifurcation.
Exactly. Well, Tesla falls enough, Cathie Woods will buy. It is now close to the top investment in the ARK Innovation Fund. She has bought the dip. The total weighting of Tesla in it is now 9.6%, Manus.
But of course, you know, I caught up with her at Christmas time when I was filling in on surveillance, and she talked about this moat, and she talked about, you know, what we lacked in understanding about Tesla. I mean, she was selling into that. She was selling for 3 straight quarters. But maybe this is the thesis, which it is the 12-month forward profit estimate for Tesla has dropped by 30%. Is this a base? Is this where you would want to step in? Do you believe that the price cuts in the cars are done?
But it's this huge rethink we've had on Tesla. Tesla was the growth stock. But when you have earnings like they do, it leads people like Nicholas Kolos from DataTrek saying, if you're going to demand a premium on multiple, you need great earnings visibility or a fantastic story for why it will show up in the future. Tesla has neither of those at the moment, Manus.
Yeah, I mean, look, the volatility in this stock, Friday, it plunged on this Reuters report about they were scrapping the low-cost cars. Now they're talking about, Elon Musk is talking about robo-taxi and unveiling those on all.
And he did deny that Reuters report for what it's worth.
Yeah, he did. So, you know, maybe that adds to it. It is the solar eclipse. Danny is excited. She's singing Bonnie Tyler songs. She is.
We need to go shopping for solar eclipse glasses soon, I think.
Jack Caffrey will tell us where and how.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
U.S. futures post modest losses ahead of a busy week that includes inflation data and the start of earnings season.
Janet Yellen wraps up a high-stakes trip to China. Top Chinese officials give the Treasury chief a warm reception despite her tough rhetoric.
And the oil rally takes a breather as Israel says it's pulling some troops from Gaza. Meanwhile, no progress is made on the peace talks, according to Al Jazeera.
I have to say, Manus, it really is this mix of geopolitics, a hawkish Fed trying to upset the bullish mood. Whether it was successful or not is a different question. We did have a decline in equities last week. Let me show you what we're doing this morning, because we are declining. We fell yesterday, okay, decline in equities, I mean 0.06%, so not really, but we had our first decline last week with some heft to it, the worst week in 3 months. So S&P futures, little change, NASDAQ futures, also little change. Mike Wilson says that it is a broadening out of a rally thanks to stronger economic data. But be warned, it is a busy week between CPI, ECB, and the start of the earnings season. We're going to get some of those banks reporting on Friday. So yet again, more chances for volatility with a VIX that spiked on Thursday and then calmed back down with that Friday rally. Meanwhile, European equities up about 0.2%. They had a tough week last week. A fun fact from Manus Cranny of the day, their worst week since January. But it really is the energy complex, which is shining, Manus. The best price for energy right now, the strongest levels ever, a record high for U.S. energy complex.
Well, you know, that's possibly one of the diamonds in the rough. The question is, what does that mean? We'll debate that in a moment. Bonds continue to trade higher in yield, lower in price. They cannot catch a break. Real money was supposed to come in at 430. Real money hasn't arrived. It's 444 in change, possibly 450. I would say that the bond bulls, you know, this was supposed to be the year of the bond. That's simply not happened. The bond bulls are singed. Perhaps not completely burned. What you've got here is rate cuts being pushed out to September. Again, this is about Europe and Asia playing catch-up in the bond right from Friday, and that is why you're seeing the additional 4 basis points there this morning. Gold is up, as we've been talking about. This is another record high, the PBOC in China. 17 months of buying gold. You're also seeing the Indian central banker tell us they are buying gold as well. So there is some kind of an alternative movement by central banks when it comes to restocking the gold cupboard. Oil takes a breather, down 0.5%. We put on 4% last week. Israel pulling troops out of Gaza. But we have yet to understand the gravity, the size, and the scale of the response, the significant response from Iran on Israel. And as well as that, you have this tightening in the market. We just had Nadia Martin at Wiggins, where they're saying $95 is the next target, but you have some significant supply issues. Danny?
Well, she said 95 was the next target, but when we asked her, Manus, what does it look like to have political risk actually priced in? She was really hesitant to give an actual level because she said there's no automatic limit unless the U.S. or OPEC steps in. There might be reason for OPEC not to go through with the amount of cuts that they have. but beyond that, 100, more than 100, there's no limit.
No, and she was sort of very reticent about talking about where demand destruction is at the moment.
Yeah.
OPEC Plus has the ability to turn the taps on 500,000 barrels pretty quickly, and the US's supply being down by 800,000 barrels, and that too can ratchet higher as we come out of this maintenance season. So that there are a number of spriggets in supply that can be turned easily.
Yeah, well, she says still, buy this dip in oil. Now, the dip in oil has meant that, again, energy stocks, as I was saying, Manus, have had a really big run-up, and our next guest writes on that point that at a sector level, energy is in leadership, followed closely by material companies. We're not sure how optimistic we should be on the short term when groups correlated with creating inflation are leading stocks higher. Joining us now is the man himself. It's Jack Caffrey, Equity Portfolio Manager at JP Morgan Asset Management. Jack, thank you so much for getting up early and for coming in. Okay, why do I need to be worried about what energy stocks are doing?
Well, I think we've been talking for, I don't know, almost a year, wanting to see a broader market. And we are starting to see that broader market. The challenge, though, is what's underpinned the market so far has been this belief, if you will, the year of the bonds coming back, the sense that inflation is going to be slayed, and yet sectors that are sensitive to, if not actual causes of inflation, are in leadership. So either growth is really good, in which case bond yields remain tighter for longer, kind of confirmed by Friday, or we're going to just have to see a repricing of companies that have longer durations to earnings cycle versus companies that earn in the here and now. Now, you mentioned, energy at all-time highs. It's still only 4% of the market. So to some extent, you're not actually getting dramatic moves in materials and energy, but under the surface, you're getting some interesting stories underpinning all that.
Do you think this kind of momentum that you see in the energy complex and financials, to be fair, we're counting down to the reporting season starting on Friday, does that momentum build? Do you think that breadth builds? Are you a buyer of breadth and building and growth rather than risk?
Ultimately, I think this certainly sets up value for its much vaunted recovery. It had a very nice year in 2022. Then it sort of gave a considerable amount of that back. Certainly a broader tape would actually be a little bit easier. We could stop talking about the Magnificent Seven, which would become the Mag 5, perhaps. And we'll have to come up with a new acronym, as we start working our way through, the Mag 5 plus obesity, as it works its way through. But ultimately, you kind of want to think about it's a market of 500 stocks, not a market of 5, and you can ignore the other 493.
Right.
So that, I think, speaks healthier. But when you see such a concentrated market struggling a bit, I think it sets up for maybe sell in May comes a little bit earlier this year, and things grind sideways. What a technician would call.
Sell in April doesn't have the same ring to it,
It doesn't.
April showers.
Oh, that's good. April
showers bring us.
I'm Irish. There's 25 variations of rain.
Yeah.
Well, okay. So Jack, hang on.
It's a soft rain.
So I'm trying to get this straight because it's a broadening out, which is a good thing, but it's broadening out into sectors that worry us. So I mean, it seems very nuanced here. So in the long term, if it's a broadening out, but it's a broadening out, which means a short-term dip, when do I actually get the all clear for things to move higher together in this broad sense?
I mean, ultimately, that's why you want a diversified portfolio, because something is not going to be working at any given moment. I suspect that many people are very overweight large cap secular growth. Higher inflation, better growth makes large cap secular growth a little less interesting at the margin. How much do you have to sell of the first or second largest weights in the market when they're at 7% plus, and you've got 5 sectors that are about 5% each? You don't have to see a lot of capital move and effectively start seeing people saying, hey, I'm having a good year, assuming they had leaned into value 6 or 7 months, 3 months, 7 days ago. You mentioned moments ago that the VIX spiked on Thursday.
Yeah.
It went all the way back to where it's averaged over the past year. So, you call it a spike, but it's like, yeah, all right, we've kind of been there.
Yeah.
A VIX with a 20 handle probably suggests getting a little bit more aggressive rather than, at that point, maybe it's never too late to take risk off, but it's later in that particular rewinding of things.
Well, Rick Reeder was excited about volatility. He on Friday when he was with me after the jobs report, was just, yeah, hell, let's have a little bit of volatility. I'm a buyer of volatility. One thing which I'm curious to get your take on is, the diversification story within AI, whether you've got to go global for that. If I look at the earnings of the US companies of NVIDIA, and this is what we've got, this is this morning's story, which is about having to pivot elsewhere to get some returns because the valuations here in the US are so high on NVIDIA, Microsoft, and Meta. I'm not saying you don't have them, but you've got to look at alternative AI options on that. TSMC hitting the tape this morning with a big boost from the CHIPS Act to build in the United States of America. So diversification within AI, how do you do that?
You know, I think ultimately, when we think about technology deployment over in history, everyone goes initially into the obvious choices, and effectively, what the names you were citing are more like the arms merchants. In terms of you don't actually have to figure out how anyone's going to make money off of AI. You can just be certain you're going to need more chips today. You're going to need more memory sooner rather than later. You know, a little bit more challenging when a company is spending 50% of sales on capital spending in terms of, you know, their ability to bring capacity online. Ultimately, for AI to work, other people are going to have to find ways that AI actually makes their business clearer, more profitable, and faster. Those stories remain a little bit more skeptical, a little bit more needing of proof points. A few people that we wind up talking to say, fascinating, running a trial, really prepared to be a fast follower once someone actually shows me how it makes me money. And I think that is going to be the long and fat tail under which AI actually demonstrates its value.
Jack, I can't help but wonder, and I know this is maybe a bit of heresy to ask you this since you do manage a public portfolio, a public equity portfolio, but are you at a disadvantage in AI being a public investor? Because it seems like all the excitement is around private companies.
Well, I'm a public investor, and I'm a public investor who's anchored off of dividends. So in some senses, I lose twice in some portions of the AI trade. But ultimately, I think the early moves are generally captured by private companies and small companies because their ability to talk about AI makes them single points of success. But importantly, those single points of success can also be single points of failure. If things don't unfold as quickly as you wind up looking to, and having earned this gray hair in 3.5 decades of thinking about markets, I come back to, you know, we'll use search as an example. Search, we began with AOL, then we went to Yahoo, then we went to Inktomi, then we went to Ask Jeeves, now known as Ask. We didn't get to Google until about almost 10 years later. So it isn't always clear that the first person who comes up with a brilliant idea is necessarily the person who winds up capitalizing and making all the money. You know, there's a snarky response. It's easy to find the pioneers. They're the ones with arrows in their back. So, you know, I do think that as we think through this sort of massive transition and potentially an expensive transition, you want to be not so convinced that there's only one answer. There's only one company that can solve everything, and then try to work your way through where does the value chain unfold.
Okay, Jack, thank you very much. A very sort of solid, I suppose, reminder of first mover advantage doesn't always deliver all of the profits all of the time. Jack Caffrey at JP Morgan Asset Management. Our guest this morning on the market, setting the agenda right here on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our
way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
In New York. HSBC CEO Noel Quinn says he's pushing to improve his bank's wealth management business capabilities in China and India, so they're just as strong as they are in the home market. Quinn spoke exclusively to Bloomberg earlier today as the bank hosts its first Global Investment Summit in Hong Kong.
In 2023, the performance of our wealth and personal banking business here in Hong Kong, we saw significant customer acquisition growth.
Right.
We also saw around about a 50% growth in our insurance and wealth business in terms of the new business they were writing last year. So the facts are wealth management is continuing to develop and grow here in Hong Kong. The liquidity base here in Hong Kong today is higher than pre-COVID levels. So I still see Hong Kong as a vibrant financial center. Capital markets are subdued at the moment, but that's a function of still coming out of COVID, economies waiting to recover. What will inflation and interest rates do?
Right.
But we're seeing some early signs of the debt capital markets starting to pick up as well. So the facts, I think, support the fact that Hong Kong still is a vibrant financial market.
Right. Now, I know you're set to report your first quarter earnings in a couple of weeks, so you can't get into the details as well. But we just wrapped up, of course, the calendar quarter.
Yeah.
If you could also indulge us, how do you think the quarter went for you guys, generally speaking?
Well, 2023 went extremely well. Over $30 billion of profit. A record profit. And that's a culmination of the hard work of our colleagues over the past 4.5 years, and also the loyalty of our customers. They've been very supportive of HSBC as we went through COVID and transition. Our returns were the best for over 10 years. And our dividend at 61 cents was the best dividend for 15 years. So I was really pleased with the performance. We're never complacent. We're making sure that we're well positioned for the future, and we're continuing to invest in the business. We're investing in wealth management here in Asia. We've done a number of acquisitions to do that.
Right.
The most recent one that we announced was the acquisition of the Citibank wealth management business in mainland China. We bought an insurance business off AXA in Singapore.
I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. we're just gonna change this way. Like, it doesn't work like that. It's a collection of people's habits that's like, again, like a super organism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Top of the hour, Taiwan's TSMC has won a total of $11.6 billion in grants and loans from the U.S. to build out chip factories in Arizona. There's a part of the CHIPS Act. Let's get over to Bloomberg's Edwin Chan, who joins us now for more. So, Edwin, this isn't the first award we've had from the CHIPS Act. We had Intel not so long ago. So what does the scale of what TSMC's received look like compared to other recipients?
I think it's about the second largest we've seen so far. Intel by far was the biggest award recipient. But I think TSMC being close behind is I think, underscores both its scale and the amount of investment needed to keep TSMC at the forefront of advanced chip making. I think we're going to see more to come, not just American firms, but Asian ones like TSMC. I think Samsung and Hynix remain in the running for similar-sized awards.
Edwin, if we put this in context, this is, this is part of the broader Biden administration's ambition about self-building. It's about onshoring, friendshoring, and domestic robustness in the chip industry. Is it delivering, and is there much more to go in this CHIPS Act?
So that's a good question. I mean, it's a very long-term ambition. It's not just a Biden administration one. You could argue it is a broader U.S. strategic objective to onshore not just manufacturing, but also the production of components critical to the economy, to future technology, to, yes, the military and various aspects of national security. There certainly is a geopolitical element to this, and so we're talking about a years-long horizon. I think we've seen since the 2022 CHIPS Act that the administration has moved fairly swiftly, not just in granting awards, but also going back to the geopolitical aspect, to putting in place policies to contain its rival in China. So I guess initial signs are this and other awards are a win for the Biden administration, but we'll have to see, over a longer-term horizon how this plays out.
Well, it's certainly based over a number of years in the ambitions of new factories in Phoenix. It is about scaling up that chip capacity. Edwin, thank you so much. Edwin Chang there on the very latest award to TSMC. Snapshot of what's going on in the commodity market. Brent, which is the global benchmark, has reacted perhaps a little bit more virulently to the geopolitics of last week, Danny. This is this past 6 days. We're opening this morning a little bit lower, but over the past 6 days, you can see we're up 4%. We've just had Nadia Martin Wiggins, where they're saying any dip in this market is worth buying. We need to understand what the response mechanism is from Iran on Israel. That is the next significant moment for this oil market to grapple with, because it's got supply outages, as you said.
Yeah, because it's not just Israel and Iran, which of course is the proximate cause for the rise in oil that we saw, but there are things like Mexico, less exports, slashing its crude exports with a force majeure there. There's still stranded Russian cargo assets. The U.S. may be sanctioning Venezuela yet again, and then of course the Houthi rebels delaying some of the shipments. You put all of that together, and that is supply disruption.
And this is where we had the conversation with Bob McNally from Rapid Energy last week, talking about the minuscule amount of geopolitical price that's in the oil prices at the moment. There's a material, non-material possibility, 30% possibility of a major escalation within the Persian Gulf, and therefore that has the capacity to add $40 to this price. There's Brent at the moment, down 1% this morning, as we just see a small drawdown.
Yeah, and look, equities aren't reacting either to this geopolitical risk, as Matt Maley put it. You should be pricing it in because although supply disruptions are rare, they're not as rare as global pandemics. So there's some perspective to put into use. Okay, coming up, we're going to look at some of the market-moving events for you to watch throughout the week.
way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
It is Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. All right, let's get you set up for your week, for what to watch. And quite literally, we mean that because the U.S. is going to be experiencing a total solar eclipse. It's going to hit New York around 3:18 p.m. Eastern. If you don't have your sunglasses, go get them. I learned today that you can't use normal sunglasses. Anyway, it's another big CPI report. We get that on Wednesday. Traders are going to continue to push back the first rate cut, and big banks' earnings kick off on Friday with J.P. Morgan, Wells Fargo, and Citi all posting results. And Manus, I mean, I was really close to just going outside and wearing normal sunglasses, so I might have come in tomorrow with burnt retina, so I'm glad I learned that.
Go to your public library. You can get them for free. There you go. Fact of the day. Let's talk about Tesla. It's up 3.25%. A little bit of recovery. It's gone back to the top spot in Cathie Wood's flagship fund. So there's a bit of reprieve for it there. And he did deny over the weekend that some stories around delaying production on some of their models was not true. Taiwan Semiconductors up 1 1/8 as they get an $11 billion award of grants and loans from the CHIPS Act. So that's helping Taiwan Semiconductors on the ADR there. And Uber down 1.68% as Uber-backed e-bike startup Lime is planning a global fleet expansion. Danny.
Manus, a quick check on this bond market as we head to the break, because we are at highs for the years for yields. We are nearing 4.5%. As Ira Jersey says, if the Fed is truly data dependent, can they really cut this year?
Well, all the real money is supposed to be arriving in here to buy these bonds. Bloomberg Surveillance is up next. I'll take you through the next couple of hours of programming here on Bloomberg. Good morning.
part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night. Bloomberg, top experts, great questions.
If we see inflation move higher, it really calls into question Powell's willingness to say rate cuts still are coming.
It wouldn't take much, I think, to push back at least the timing of that first potential rate cut.
They're telling you if things slow down, they'll cut a lot more. So they're trying to say that the risks around those 3 cuts are balanced.
It's clear that this is a Fed chair that wants to cut rates and is willing to look through some of the hot inflation data.
I think we will end up with 2 cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, kicking off the week with yields at new highs for the year right across the curve. 2-year, 10-year, 30-year. Here's the state of play right now this morning. Yields higher by 4 basis points, very close to 4.45 on a 10-year. Lisa, going into inflation later this week, your 2-year approaching 4.80.
People are now pricing in basically 2 rate cuts, from 3 rate cuts, from 7 rate cuts earlier in the year in terms of what the Fed is going to do this year. What I'm looking at right now is how much does it matter and how much does this really speak to concerns about inflation or a real yields narrative? And I know it's nuanced, but this is something else. This is basically the Fed fighting inflation in the short term and winning over the long term, which just gives fuel to risk assets.
Post payrolls on Friday through the weekend, there was a dominant phrase in all of the Southside research, non-inflationary growth. How much of that story can we embrace going into this week?
We will find out on Wednesday with CPI. We will find out on Thursday with PPI. We will find out as we hear about the geopolitical backdrop in terms of tariffs and other such things. This really is the key question. Can this growth truly come without inflation? And is it sort of a justification for any rate cuts at all this year? If there are no rate cuts, does that mean that there are going to be fewer rate cuts over 2025 and 2026? Or, as the market is suggesting, does that mean there'll be even more in 2025 and 2026? So, okay, risk on.
You mentioned the geopolitics, so let's take the temperature of that, and we can do that in the commodity market. So let's bring up Brent and bring up WTI. WTI through Friday on a 6-day winning streak. Quite a rally last week, higher by 4.5%. This morning, Anne-Marie, we're lower by about 1%, still 90 on Brent crude.
Yeah, a little bit of cooling off in the oil market, and this has to do with the fact that Israel has taken some troops out of Gaza, but the issue is they're waiting for potentially this strike from Iran somewhere within the region or somewhere on Israeli foreign territory abroad. So Goldman Sachs is talking about the fact that the rally could go to 100 barrels should we still have that geopolitical impact continue, but that remains to be seen at the moment. Then you have a lot of supply constraints around the world, which Amrita Sen talked about a lot this week.
What I find fascinating was over the weekend, the notes that I read had more to do with the Saudi Arabian break-even rate, where they would actually have their positive returns on some of their funds, and it was $85 a barrel. So this is talking about a structurally higher rate of crude going forward, regardless of what happens in the Middle East?
I'm trying to work that out too. For how long will the Saudis withhold barrels? Are they just going to sit there and let this crude move, carry on? For how long will the White House just sit there and do nothing? We know they don't want to refill the SPR. Are they willing at some point to drain it again? That's what I'm focused on going into the summer.
I want to ask Ellen Wald about this. How much capacity do they have to drain this and what that means for gasoline prices, because it has to do with refining as well. But also, Saudi Arabia, do they have some sort of a bone to pick here in terms of who they want to win the election and how they want to sort of put their thumb on the scale?
They're going to do their best to talk about this has to do with supply and demand constraints, nothing to do with politics. But if we go into the summer and we start seeing $4 a gallon of gasoline, we start potentially seeing $5 a gallon gasoline, you better believe the SPR potential tap is on deck, as well as a lot of pressure on Riyadh.
Brent crude right now, $90 and about 30 cents. WTI, $86. Let's get into the market action for you, starting with equities on the S&P 500. Equity futures right now, just slightly softer. We're down about 0.1%. Coming off the back of the biggest weekly loss since the start of the year. Yields climbing through last week into this morning. Yields higher this morning, Lisa, by 4 basis points, 440.60 on a 10-year.
I know that we always say this, but this is a massive week. I have to say, we've got the trifecta. On one hand, you have key U.S. inflation data with CPI on Wednesday and PPI on Thursday. We also get Fed commentary as well as an ECB rate decision. How much do we get them kicking off a potential rate cutting cycle? Thursday we'll get some guidance. Is June still very much a go? And then earnings season kicks off. And on Friday, this to me is possibly the most interesting kind of bifurcation. What matters more, central banks or the earnings? Citigroup, JP Morgan, Wells Fargo, all kicking off. We're also getting Delta earnings on Tuesday, but I'll put that aside. How much is that going to be in the front driving seat versus, say, some of the inflation rhetoric and questions around Fed policy?
I don't know, but I can say this. I think we're all done with the Fed speak, aren't we? I think we are. We're done with the Fed speak and we can move on to Q1 earnings.
You really want to do that?
Yes.
You want to say that? Because somebody's going to come out and they're going to say something and all we're going to be talking about is that Fed speak.
What would it take? Governor Bowman's already come out and entertained the idea of perhaps talking about interest rate hikes later this year. What would you need to see to make that conversation more interesting?
That the neutral rate going forward is something closer to 4%. That kind of idea would torpedo markets. To me, one of the biggest untalked about issues is the fact that in 2025 and 2026, rate cutting expectations are actually greater than where they were at the beginning of the year. This is a long-term kind of structural play where people have complete faith in the Fed. What if the Fed doesn't have complete faith in themselves?
If you want more of that, you're going to get tons of Fed speak this week, and maybe that is what you want. Coming up this hour, Jeff Yu of BNY Mellon, as investors looking ahead to a busy week of data. Former White House fellow Elliot Ackerman, as tensions escalate between Israel and Iran, and Bloomberg's undercurrent as Treasury Secretary Janet Yellen wraps up meetings in China. We begin with our top story. Investors looking ahead to the latest CPI print and the big bags kicking off earnings season. Jeff Yu of BNY Mellon writing this. While flows may remain heavily focused on the US, cross-asset price action last week suggests that not all will be rosy for risk appetite. Markets are vulnerable to surprise outcomes in policy and data amid positioning volatility and shifting correlations. Jeff, I'm pleased to say, joins us now. Jeff, let's start there in the bond market. How much of a challenge are these yields to this equity market?
Well, yield levels are a challenge, but also the pace of the moves will be an even greater challenge. You know, with a bit of my FX hat on, sometimes it's not about levels, it's about the speed at which you get to certain levels. If I compare the move from 4 to 4.5 right now in the 10-year, somewhat slower compared to the rounds of bear steepening that we had last year. But if this accelerates, that tightens financial conditions much more quickly than markets are ready for, then you get the volatility. As you mentioned yourselves, if earnings do not meet lofty expectations, that generates volatility as well. And finally, we've got the geopolitics. So that's why I said it's not all rosy out there.
Well, Jeff, let's start with the data and we'll run with payrolls from Friday. You've got to learn something from the data and how the market responds to it. Are we learning that good news is actually good news based on what happened on Friday?
Well, we actually had this discussion internally today, and let's just say no longer are we saying absolutely slam dunk, good news is going to be good news. At what point do we trigger that round of bear steepening such that good news starts to shift into bad news? So especially given all of the investment that's going into the US right now, not just asset allocation, but looking at the headlines from this morning and last week, in the last 7 days, I count $50 billion in investment via direct or subsidies by Asian chip manufacturers into the US. And that can be inflationary, given the value-added component to the US economy. So how do you offset that? And this should be good news on the corporate front, but if that translates into higher yields and tighter financial conditions, it might not be good news either.
Jeff, just to talk, to put some numbers on this, I'm looking at real yields, inflation-adjusted yields in the U.S., since that typically is what triggers a lot of concern in the risk environment. This is not inflation-driven. We're now north of 2%, once again, in terms of real yields in the 10-year. That is the highest level going back to the end of last year. Why do you think this is happening? Is this basically a belief that the Fed is going to hold rates higher for a much longer period of time? Or is this just idiosyncratic selling from a particular cohort that don't believe that the 10-year is any longer the ballast, the haven type of asset?
I would say it's a combination of factors, but if you look at the productivity element, if you are actually anticipating stronger productivity gains in the US, then in real terms, real wages should be higher, and then consequentially, real interest rates should be able to reflect that, because at the end of the day, what deflator do you use? Do you use a normal PC one or a CPI one, or do you actually use earnings, and what level of real yields do you want to reflect the underlying conditions in the US? I think people are looking at productivity gains, all the investment going to the US, and that's benefiting earnings accordingly. But again, how long can this be maintained? Because one sector may be doing well and continue to generate productivity gains, but that's going to come at the expense of other sectors as well. So I think it's going to be a delicate balancing act, but markets are not questioning the Fed, at least not yet.
When you say is good news, and that was a question that John asked, I wonder for what, right? Is good news becoming bad news maybe for bonds, but still pretty good news for stocks that might also face off with a pretty positive Q1 earnings season? Is that basically your view?
Well, I think right now you need to be in the US market. So it perhaps is good news for US stocks because there are no alternatives elsewhere. Let's look at the guidance from the ECB this week. I think this week is actually a live meeting as far as the ECB is concerned, though probably June is more likely when they're going to cut first. There's no good news coming out of Asia, according to our data, all clients. So every single APAC currency almost is short right now amongst our client base. So you're almost forced into US markets, be it bonds or cash or equities. So in that sense, as long as the US keeps on surprising or even meeting expectations, then it is good news. But then the bar just gets set higher and higher. And then the moment that you see forward expectations on the earnings side start to disappoint, that's when the correlations begin to crack. So I think that's what we need to look out for in Q2.
Hey, Jeff, back up. I heard about 1% of what you just said. And then I was thinking about just that and ignored the other 99. Live meeting Thursday, ECB. Jeff, what does that mean?
Well, going back to my parity call in terms of euro-dollar, which is, in fairness, not super far from where we are right now, you will get voices calling now is the time to act. If I look at wage growth in Eurozone, if I look at where the PMIs are, we need to distinguish in Europe at least. So less bad from a very, very bad environment. It doesn't mean things are getting better, right? And if we actually do get energy prices going, the supply constraints as well, that I think is going to be negative, for European growth as a whole. But the hawks on the governing council could then again argue, oh, inflation expectations are going up again. We're worried about a price spiral. Let's keep rates where we are. So that totally different reading of where the Eurozone economy is right now between the dovish camps and the hawkish camps, I think that's going to come out more into the open. So the decision itself is probably going to be on hold, like all the other 7 central banks due to decide this week. But I think you are going to see much more two-way dialogue, and at the very least, there will be calls, I expect, for cuts as well.
Jeff,
so
I just want to be super clear.
Be a live meeting.
Are you sticking with that parity call on euro-dollar this year?
Absolutely.
How much pushback are you getting from clients regarding that?
So I would say there's sympathy with the view right now, and the broader client consensus is euro lower. Perhaps parity at this point is one of the more aggressive targets right now if you look at options pricing. So sympathy with the direction, pushback perhaps against the target.
Interesting. Jeff, wonderful to catch up with this fantastic call there. Just to have a discussion on euro-dollar parity call this year. Jeff Yu, FBNY Mellon. Jeff, thank you. Just getting some breaking headlines. Jamie Dimon's 2023 letter to shareholders just dropped in, Bramo. What'd you see?
Well, first of all, he talks about his macro call, which is what everybody finds interesting from a lot of these letters. These markets seem to be pricing in a 70 to 80% chance of a soft landing. I believe the odds are a lot lower than that. So speaking to that, of course, we'll see earnings when he probably produces another record gain. So we'll get that sense. He does talk about artificial intelligence and about how over time it could be potentially revolutionary, akin to the internet that has the potential to augment virtually every job. And then he talks just generally about the government deficit and printing a lot of money, and how basically what we have seen is an economy fueled by government deficit spending and past stimulus. So, okay, Treasury Secretary Jamie Dimon, let's hear what you have to say.
Inflation may be stickier, rates might be higher than expected. I think you've touched on the important topic here. Is this a man in a risk management seat? Is this a man making a call on the economy? Is this a man who's sort of leaning towards Treasury in Washington, D.C. over the next 5 years? What is it?
This is the House of Diamond, led by Diamond, with Diamond in the front seat, trying to give off his larger-than-life kind of message, which he does pretty much every year. You can speculate on his tax trade or whatever else you want to do, but the bottom line is some of what he's talking about, he has talked about before, and others are talking about the similar types.
There's a lot of questions swirling in Washington after he made those comments about former President Trump in Davos, and then recently he was at the White House having lunch with VP Kamala Harris, and someone in the White House quipped to me, the days of Davos are long forgotten. They've moved past it. One line that stands out to this letter, the staggering inability of the government to draft and pass a proper budget causes deep and unnecessary damage to our growth. We've been hearing a lot about this on this program and what this means for the Treasury market.
And yet here we are talking about the economy that remains resilient. Even with that, dysfunction down in Washington, best economy in the world right now relative to Europe and everything that's taking place there?
Michael Zizas put out a piece, Morgan Stanley, talking about how the deficit is going to grow with either Republicans or Democrats, probably more under Republicans than Democrats, but it won't matter because people can still chug along. But this is the bottom line, right? How long before it matters? And right now, people can scream about all they want. People can care about the auctions. Doesn't mean anybody else is going to care about them.
The latest from JP Morgan's Jamie Dimon. You'll hear more from him on Friday when we get earnings from JP. Equities right now, equity futures look like this. We're down by 0.1% on the S&P 500 with some stories elsewhere. Your Bloomberg Brief. Back with us is Danny Berger. Hey, Danny.
Hey, John. Chipmaker TSMC is going to be receiving $6.6 billion in grants. They'll also get as much as $5 billion in loans from the U.S. to build factories in Arizona. It's a prelim agreement, and the company will build a new factory in Phoenix, adding to the 2 facilities it already has in the state. Production is expected to begin in 2025 and 28. The newest factory will be building next-gen 2-nanometer chips. Those are essential to building emerging tech, including AI and military applications, too. David Ellison is closing in on Paramount. The movie producer and tech heir has a month to seal a definitive agreement, but first it needs to sell Paramount's board on the merger with his production company, Skydance Media. Ellison would serve as the CEO of the combined company. That's according to people familiar who asked not to be identified due to the sensitive nature of those negotiations. His father, Larry, the co-founder of Oracle, is one of several names being floated for the role of chair. And for a few fleeting moments today, Americans will turn their gaze towards the sun as the path of a total eclipse tracks across cities, from towns from Texas to Maine. The entire event will last for several hours, but this main spectacle where the day turns to night as the moon obscures the sun is expected to last for only about 4 minutes. So get outside, get your glasses. The event has been backed a tourist boom with areas along the path fully booked. Buffalo called it their Taylor Swift, their Super Bowl. Meanwhile, the U.S. will lose more than 30 gigawatts of solar energy as sunlight is blocked during prime generating hours. That's roughly the output of 30 nuclear reactors. And that's your Bloomberg Brief, John.
Amazing. Danny, thank you. Guess who came in this morning prepared with glasses? Guess who? AMH.
And I bought one for each of you.
Thank you. I have.
Are we doing
I'm
a
very
group?
excited.
Are we doing a group
Really?
session? Is
These
that what
are
we're
so
doing?
cool.
Yeah, you can't see
Are they
anything
though?
through them.
Are they?
You're not going to watch?
No.
Well,
It's nap time, isn't it? 2 p.m., 3 p.m., something like that.
Can I just, PSA, don't look at the sun if you don't have the glasses. I have lectured my kids time and time again.
Is this the lecture for the kids this morning?
If you're watching, kids, please, I'm telling you, you will get
Do you
one.
remember former President Donald Trump staring at the sun?
Yes, I do remember that.
Yeah.
Don't do that, please.
Don't do that. Up next on this program, Israel preparing for Rafah.
We have been increasingly frustrated, and again, that was a core message that the president delivered to Prime Minister Netanyahu in their phone call this past week, that if they've got to do more, they've got to make changes.
That conversation up next, live from New York City this morning. Good morning.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Just for the record, AMH thought she bought the solar eclipse glasses. They're actually the 3D glasses for the movies.
No, they're not.
Be very careful about this.
Okay. About Amory?
Yeah, about people like AMH selling this stuff on the streets of Manhattan.
It's free.
You know, 3D glasses
They're
for
real.
the movies. Equities right now in the S&P 500, they're not. Negative 0.1%. Yields are higher by 3 or 4 basis points. Your 10-year 4.43.99. Under surveillance this morning, Israel preparing for Rafah.
We have been increasingly frustrated, and again, that was a core message that the president delivered to Prime Minister Netanyahu in their phone call this past week, that if they've got to do more, they've got to make changes. Now, the Prime Minister assured the president that he would do that. We've seen some announcements in those early hours. That's welcome. We got to see more. We've got to see it over time.
It's the latest this morning. Israel pulling some troops out of southern Gaza, preparing for an operation in Rafah despite growing pressure from Western allies. Prime Minister Benjamin Netanyahu saying Israel is one step closer to victory, but reiterating there will be no ceasefire until the hostages are released. Elliot Ackerman, the former White House fellow, joins us now for more. Elliot, difficult question, I guess, but are you clear on US-Israel policy after the events of the last week?
No, I'm certainly not 100% clear, and I think the U.S. really is running the risk of sounding pretty hypocritical in its warnings to Israel about civilian casualties, given the number of civilian casualties the U.S. has inflicted over the past decade. But even if you look all the way back to the history of the United States and what we've been willing to do in terms of attacking civilian targets in wars that have been really existential to our survival.
When you look at potentially not being clear, we heard from Admiral Kirby there, and he says that what Israel's doing in Gaza with some troops coming out, he says this has to do in direct consequences of their conversations. Yet you hear from Democratic Senator Coons talking about the fact that he actually thinks this is tactical. Israel wants to potentially have a reset or potentially maybe move some troops to the north if they're going to have an issue with Lebanese Hezbollah. What do you make of this specific move Israel made over the weekend?
You know, what we're seeing is Israel's 98th Division is moving out of Khan Yunis in the south. And, you know, the question is, you know, why is it moving out? And the Israelis have announced an operation in Rafah, you know, for some time. They've been telegraphing that move. So it would seem that this is tactical, that you have to withdraw troops to send them into combat elsewhere. And the 98th Division has been in combat for about 4 months now. So they probably do need to rest and refit. I mean, all that being said, though, you know, tactical troop movements can be used to serve as strategic cover if at a certain point the Israelis decide that they're not going to go into Rafah, that they're going to make that type of a concession. So I think we just sort of have to wait and see what this means.
If Israel's going to Rafah, the United States is talking about potential consequences. At the same time, we had hostage negotiations over the weekend. Are they just now for show, for public optics?
I think it's not inconsistent to have two parallel tracks of action going on at the same time. We can have hostage negotiations simultaneously as Israel is reposturing itself for an offensive that may or may not take place based off of the outcome of those negotiations around hostages or even around a ceasefire. So I think, you know, right now we're at a point of really, you know, a lot of uncertainty in the war and a lot of multidimensional aspects of the war, from negotiations to internation negotiations around a ceasefire to tactical operations, the potential of a new offensive opening up.
What message do you take, Elliot, from the fact that we have not seen an Iranian retaliation yet from the killing of their senior military officials?
Well, these things take time. I think we will see that retaliation because just like the United States or any other nation, the Iranians have a domestic constituency, and they have to retaliate in order to show strength to that constituency. But what shape that retaliation takes and how effective it is yet to be seen. So I think the Iranians will certainly at some point claim that they have retaliated.
I guess that the way that the market is treating this is that, especially with the withdrawal of troops by Israel, the fact that we haven't seen yet a retaliation from Iran, that there's a softening in the proposition of a potential escalation to a broader regional conflict. Do you think that that is an accurate way of reading the events over the weekend?
I think it potentially is. You know, whenever you're in a conflict like this, there are always these off ramps, and you know, both sides can choose whether or not they take the off ramp. So, you know, at this moment, Iranian retaliation, you know, it could be something very, very minor, and they claim that they've retaliated, and that creates an off ramp to begin negotiating. I would point out that if, you know, the Iranian retaliation is extreme, that then makes it very difficult for Israel to come to the negotiation table. So we're just going to have to watch and see how this plays out.
That conversation is certainly the epicenter of the crude market this morning. $90 on Brent. We're down about 0.8%. Elliot, always wonderful to catch up with you. Elliot Ackerman there, the former White House fellow and co-author of 2054, a novel of the next World War. Lisa, you're right to point that out. The Iranian confrontation with Israel, how that plays out, if at all, is going to be key to where we go in crude this week.
The fact that we saw the increase in crude prices, and a lot of people are pointing to the potential for Iranian escalation, that we heard about jammed GPS signals in Israel as people really hunkered down, Iran really talking in hard words about targeting the U.S. as well. The fact that nothing has happened and that troops are being removed from certain areas of Gaza seems to have taken some of the temperature down. Whether that lasts, though, really remains to be seen. Again, as Elliot was saying, you can't game this out, which is the reason why it's difficult for people who are trying to.
Iran will go to their Security Council and weigh the options of what they want to do. Is this going to be something potentially in the Red Sea and the Indian Ocean? Is this going to be something potentially in Israel? Or are they going to go to other foreign countries? We've seen this before. Reports, Georgia, India, Thailand, in the past that Iran has tried to use to target Israeli officials. And I think what we need to wait and see, like the GPS that Israel was talking about that was getting spun out of control because they wanted to try to make sure that no drones could attack, we need to look to what the U.S. and Israel say, what embassies to avoid and what places to avoid, and potentially that's what they're concerned about.
For now, at least, some of the heat coming out of this commodity market. WTI is down about 0.8%. Crude this morning, 86 on WTI. Brent crude, $90 and about 40 cents. Coming up on this program, Bloomberg's Enda Curran as Treasury Secretary Janet Yellen wraps up her latest trip to China. If you are just joining us, equities are doing okay, down about 0.1% on the S&P 500, but starting the week with new highs for the year on 10-year, 2-year and 30-year bond yields. Yields are higher by about 4 basis points. From New York, this is Bloomberg.
traditional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Live from New York City, welcome to the program. Equity futures on the S&P 500, negative here by 0.06%, totally unchanged on the Nasdaq 100. Week of losses last week, biggest weekly loss since the start of the year. Still, only the 5th week of losses since the end of October. The underperformance last week, interestingly, and we can talk about this through this morning, small caps. Worst week since the start of the year as well. Really underperformed, Lisa.
Completely tied to the bond market as you saw yields go higher with the expectation that the Fed would not have the justification to cut. I would just want to point this out, though, about how rare it has been to see any kind of decline whatsoever this year. The S&P hasn't had a down 2% day since February of 2023. This is the 12th longest streak since 1928, that according to Citigroup's Stuart Kaiser.
That's amazing. That's quite a stat. It's been that good. That's how strong this rally has been since the end of October. The reasons for that rally have shifted quite a bit, and we can talk about that too. In the bond market, yields look like this: 2-year, 10-year, 30-year. Last week, we had sub 420 to start the week on a 10-year, and we finished it north of 440. And then this morning, we had some weight to that, up by 3 or 4 basis points. A 10-year yield of 443.59, yields up by a couple of basis points and getting closer to 480 on a 2-year, Lisa, 477.39.
So this question also came from Stuart Kaiser. This week on Wednesday we get CPI, and a lot of people view that as maybe the moment that we find out whether the bump idea is just the same as transitory was a couple of years ago, to quote Priya Misra. But is an inline report a beat? Is that how the market treats it? Is it basically the threshold of saying at least inflation did not surprise to the upside? Because that seems to be the big fear that's been baked into the rates market over the past couple of sessions.
Can I say yes, and just say yes a few times? Inline has got to be seen as a beat. At the moment, overwhelmingly on the street, the consensus view is non-inflationary growth. That's the story. Most people look at payrolls from Friday, really, really strong payrolls growth, and then you look at everything else, wage growth comes in line. People are taking a little bit of confidence from that. So if you get inflation data coming in line as well, they can just embrace that supply side story, I guess, even more.
Is it a good enough reason to buy the long end? The long end has been a mystery to me, and that sort of goes to the Jamie Dimon existential angst of the deficit and this question about interest rates longer term. That has been the most volatile area, and one that is most of a mystery to me, because what is the reaction function if you do think that the Fed is going to hold rates higher for longer? Is that positive for the long end? Or if you get the sense that they're going to do these prophylactic cuts, does that mean that you could see that kind of priced into that longer-term benchmark rate?
Informing some of this will be what happens here if you switch on the board and just roll forward to Brent crude and WTI. We've had a big move higher in crude, a move of something like 4.5% last week to the highs that we haven't seen since October on both Brent and WTI. We're just pulling back a touch there, but what happens here is going to be critical to that conversation around inflation going forward and the Fed's tolerance of it, and that's how I think things develop at the long end off the back of that.
And it's not just commodities. I mean, it's not just crude, it's also broader commodities, whether it's gold or chocolate or a lot of other things. So this is sort of the reason why they have to take it into effect a little bit more, especially with the driving season, and especially given the fact that it's going to be a political hot potato and all of that jazz.
So you drain the SPR around September time?
I don't know if they have the ability to.
August?
I don't know if they have the ability to. I mean, honestly, they've gotten to such a low level. I've heard mixed things. I know you know this better than I do, but honestly, I've heard so many people say to me, we're kind of bumping up against the edge here.
We are definitely well below the peak we had under the Obama administration, but yes, they can drain it. They can drain it for a bit. It's not going to be the same levels we saw previously under the Biden administration, but they can make a few moments, and a lot of that would potentially be jawboning as well.
Brent crude back to about 90 so far this morning. Under surveillance this morning, a busy week ahead. US inflation data on Wednesday, the ECB with a decision on Thursday, and the big banks kick off earnings season with JP Morgan, Wells Fargo and Citi set to report on Friday. So let's set the scene for you. Let's do Apollo versus Morgan Stanley. Ellen Zentner and Morgan Stanley, the data point to a non-inflationary expansion of the labour market and do not alter the Fed's course to a June cut. That's Ellen Zentner, Morgan Stanley. Here's Torsten Slock over at Apollo. The economy is re-accelerating. We're sticking to our view that the Fed will not cut interest rates this year. That's how divided things are at the moment.
Right now, I keep saying, what's going to be more important, the Fed and the macro or earnings? And what it all points to me is that there's bigger risk in bonds and there's less risk in stocks, especially if the earnings come in better than expected. That all flips on its head if suddenly you start to get this weakness, but it just shows that there is no consensus whatsoever on Wall Street about how to read some of this data and what it means for the trajectory going forward.
And a lot of that no consensus on Wall Street and how to read the data is because it almost is a different economy in the sense. Jay Powell talked about this. It's a bigger economy, not a tighter one. How much is immigration playing into, say, the jobs market, and is that helping to keep a lid on wage growth, thus inflation? And everyone is now going to be looking towards CPI because now that we have jobs out of the way, this is potentially the next data point, could really point to what the Fed is going to do, say June or July.
As Lisa mentioned, CPI on Wednesday, then bank earnings on Friday. Getting a flavour, a preview of what Jamie Dimon thinks about the world in his annual letter to shareholders. Dimon devoting a large portion of the letter to AI, saying it may be the biggest issue the company is dealing with. Dimon also issuing a warning on the economy, writing, quote, "These markets seem to be pricing in at a 70% to 80% chance of a soft landing. I believe the odds are a lot lower than that."
So how is he handling his business, right? We're going to find out about that hopefully on Friday. When he talks about artificial intelligence, aside from the macro calls and sort of, the Treasury Secretary light that's coming to the fore, there is this issue of how much AI is going to transform just his staffing levels, where they're hiring, where they're cutting back, who they're putting their money into. Those are some of the things that I'd like to hear from him. I mean, these kinds of big proclamations, he's talked before about 7% 10-year rates. At this point, it actually looks less far-fetched than maybe a year ago, but these are some of the things that he's come out with and with some of these warnings in the past.
Doing more with less. Let's roll back 2 weeks. Brian Moynihan, Bank of America. I thought the conversation with him about AI was quite revealing. Each additional dollar of revenue at these banks every single year from here is going to become less and less labor intensive. So it's not that you may see, I don't know, 10, 20,000, 30, 40, 50,000 people being laid off. What you'll see is these companies will get bigger and they'll do it with fewer people relative to that expansion in revenue. That's going to be of some concern, I think, to younger age groups coming out of college looking for jobs, because the grad schemes at these banks, which a lot of people are dependent on coming out of high-flying colleges, worked very hard at their degrees, sacrificed a lot of time, this is the career they want. The hiring relative to the size of the business is just not going to be the same. That's going to be a big change we could see.
And the grunt work that typically people come in and they have to be sort of the assistant to a banker or someone else, and you sort of learn through all that grunt work, is going to be done by a computer, right? So at what point does that eliminate the opportunities to learn? It's a great point. The silver lining might be, as Brian Moynihan said, fewer people, but they're all paid a lot more. So maybe, the upside.
You get the golden ticket, right?
Exactly, right. It's just sort of getting it as
if you have the golden ticket to be that one person that makes it on the desk. But I think it's interesting that he almost led the letter with it. It feels like this is what his bank is grappling with at the moment as one of the top issues and how it transformed the business.
I've got to say I'm far more interested in the actual numbers on Friday than I am sort of the stuff about AI in the future in the next
I just want to hear
5, 10 years. That's what you want, broad proclamations.
That's all I want.
I'm sure that's what they want you focused on as well.
I'm very focused on it.
Yeah. Treasury Secretary Janet Yellen wrapping up her latest visit to China. Yellen pushing leaders on the country's output, saying excess production and subsidies will lead to significant risk to workers and businesses in the United States and the rest of the world. I'm pleased to say that weighing in on this with us is Enda Curran of Bloomberg. Enda, it's almost like the self-discovery tour of Janet Yellen, a change of thought over the last 10, 20 years for her. How is this pertinent to policy shifts from the US administration anytime soon?
Well, look, Ms. Yellen certainly has travelled a journey on the China relations story. During her trip, it seemed to be full of both criticism and there was plenty of cordiality as well. On the critical side, as you mentioned, Ms. Yellen rolled out some of the familiar complaints that we now know about it, which is basically China's manufacturing too much stuff and exporting into the rest of the world at very cheap prices. Interestingly, she said that's not just a threat to US workers, but she mentioned global workers as well. So maybe a hint there, or trying to build up a bit of a global alliance as she tries to beat the drum on the overcapacity story. And then Ms. Yellen also raised complaints about China's support for Russia, of course, and she made the point that China needs to drum up its own domestic demand and buy more of their own stuff than send it overseas. But the cordial side, the old Miss Yellen, the sort of the kind of Miss Yellen that China would like in the past was also there. There was a cruise on the Pearl River Delta, and there was an exchange of gifts between Miss Yellen and Chinese officials. So it was on the one hand delivering the hawkish message that we've become used to, and on the other hand playing the old Yellen card that we know well also.
She's talking about the cost of steel a decade ago and that overcapacity we saw from China. Many are equating that to what we're seeing potentially now in the EV space. And she says, the president and I will not accept this. They have gone out of their way to showcase that tariffs are set to come. Enda, do we have any timeline on when we would see these tariffs?
I don't think we have an explicit timeline on it yet, Anna-Marie, but you're absolutely right. Ms. Yellen was certainly delivering a message to China that they are not happy with their economic growth strategy, and all the implications are that the US will respond. And the Xinhua response, by the way, from Beijing, even though there was somewhat of a cordial tone around the meetings, the Xinhua hit back and said that really Ms. Yellen has come to deliver what they consider to be a preemptive warning that more tariffs or some kind of export controls are coming down the line. So certainly China is bracing for it. But China also seems to be playing nice during this visit. I mean, typically, given the amount of criticism that Ms. Yellen levelled, you would have expected a more robust rhetorical response. That doesn't seem to have been there in the state media reports that we've carried so far. So maybe there's a feeling as well that China expects something coming down the pipes, but they're also willing to play the waiting game a little bit because they know what's coming up in November. There's going to be the election, and this may well be, of course, Ms. Yellen's final trip to China as Treasury Secretary.
And there was a lot there to unpack. I do wonder if there's the economic appetite to withstand some of these tariffs without retaliation on the part of China. Is that what you're saying, that basically they're willing to wait, just grit their teeth and bear it if there are additional tariffs?
So there's one interpretation out there that China's economy, as we know, is not as strong as it could be. It continues to be hobbled by the real estate sector, in particular. Manufacturers going strong and exports, but real estate is hitting it hard. At the same time, that the US economy continues to beat all expectations. So there is a view that China's willing to lie low a little bit during this wave of criticism because it wants to put out the welcome mat for FDI. It wants to get portfolio flows coming back into China. Remember that meeting Xi Jinping had with the US CEOs only a few weeks ago? So they're clearly trying to dial down their rhetoric. But then on the tariffs in particular, again, China knows full well there is the election coming up in November. There could be a potential change of administration that could lead to even a sharper change of approach on China policy. So I think a lot of analysts watching this do feel there's a bit of time out in this. Both sides are trying to stabilise relations, but China's more than happy just to run down the clock and wait and see what comes out of that November vote.
And thank you, sir. Appreciate the update. And Karen there of Bloomberg down in Washington, D.C. I think a lot of people on Wall Street have sort of got August, September circled as the next move potentially from this administration. Why do it now when you can wait until right before the campaign starts to really pick up going into November?
Yeah, and a theme I heard was potentially that they don't want to turn this into infrastructure week. Every week becomes tariff week when reporters are asking them, is it done, is it done? But obviously, if you have an election in November, you're going to hold your biggest arsenal till September, October, maybe even August. So if the rhetoric on China is going to ramp up, potentially that's when we'll see those tariffs, when they would matter for the domestic audience.
So what's in the arsenal right now? Drain the SPR around August if you need to? Go forward with big tariffs on Chinese EVs?
Tariffs on Chinese EVs. The Commerce Department is also looking into connective vehicles. This has to do with Chinese EVs as well, potentially more export controls on some of that technology, the tariffs, and yeah, of course, the SPR. To Lisa's point, it is not at the level that it was when Biden came into office, but they could still drain a few millions and potentially that will help the market. They're going to need to if we're seeing $4 or $5 gallon of gasoline. Every American consumer, even if you walk, you pass a gas station, that is a reminder of higher costs. And inflation obviously has dogged this administration.
And it talked about China waiting it out. Waiting it out for what? Writing it out for who?
Well, that was exactly what I was thinking. At this point, given the fact that this is sort of a campaign tool, it gives you a sense of what the temperature is and sort of the general population and what you can expect with either administration.
More on this a little bit later. Equity futures right now on the S&P, negative about 0.1%. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs says that European stocks are likely to outperform the U.S. over the next year. Sharon Bell and team cited factors like global manufacturing and a global PMI upswing. And the ECB cutting rates, they say, in June. Financial, energy, and consumer discretionary will be the best performers, they wrote. Shares of Boeing and Southwest Airlines lower in the pre-market trade. The FAA announced that it's investigating yet another in-flight incident. This time, it was an engine cover that fell off. It struck the wing of a Boeing 737-800 during takeoff from the Denver airport on Sunday. Then the Houston-bound flight returned safely, and the plane was just towed to the gate. Boeing is still under regulatory scrutiny after a door panel blowout on an Alaska Air flight earlier this year. The South Carolina Gamecocks are national champions. They defeated the Iowa Hawkeyes 87-75 in the women's NCAA title game. This is now South Carolina's third national title in just 7 seasons. It's also the 10th D1 team in history to complete an undefeated season. But the real highlight, it was Iowa's Caitlin Clark. She ended her career with 3,951 points. Now she leaves as the all-time leading scorer in both men's and women's college basketball. Really remarkable, and that is your Bloomberg Brief, John.
Hey, Danny, thank you. What a phenomenal athlete. What she's done for sports, for women's sports, has been absolutely incredible over the last few weeks.
People have watched her over a lot of male athletes. She's been the draw. I mean, honestly, all the jokes about going to a bar to watch women's NBA and sort of this question of whether college basketball will get anything, all went out the window.
Shaquille O'Neal, I'm not watching the boys. His words suck. I'm only following the girls. That's where some real incredible athletes are. This was him the other day on a podcast.
I can't name one. I can't name a single male athlete from college basketball. I'm just your average observer, of course. What do I know? But that's been the story over the last month.
She's the star. So here, where does she go next? And what does she do for the sport?
That comes with ratings. That should come with money as well. And it's well deserved. Up next on this program, inflation, testing the Fed's patience.
What we're hearing from the Fed is patience on inflation. But, you know, they can only be patient for that long. They're trying to say this is a bump in the road. Maybe bump is the new transitory.
Love that line from Priya. That conversation coming up next.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities on the S&P 500 negative here by 0.05%, just a little bit softer to start the week. Yields a bit higher, up 4 basis points, 4.44 on a US 10-year. Earlier in the session, new highs for the year on a 2-year, 10-year and a 30-year. Crude pulling back just a touch. We're negative here by 0.7%, $86 and about 32 cents. Under surveillance this morning, inflation testing the Fed's patience.
What we're hearing from the Fed is patience on inflation. But, you know, they can only be patient for that long. They're trying to say this is a bump in the road. Maybe bump is the new transitory. But what they're telling us is, you know, this is not suggesting that inflation's not moderating. But how many months can they be patient? If service disinflation doesn't continue to slow down, I think that's where this Fed patient narrative is going to run thin.
Here's the latest. Investors looking ahead to March CPI data on Wednesday for clues about the Fed's path forward. FS Investments chief economist Laura Rain writing this. Markets are on edge as the upside surprises for inflation keep coming. Under the hood, the mix of inflation remains a problem. Services prices are just too high. Does the Fed need to cut rates? No, there's an exclamation mark, and she's going to scream that for us in a moment. There is no urgency for a rate cut. My forecast is for surgical rate cuts, starting possibly Q3 or Q4. No, Laura Rain joins us right now for more. Laura, you can do that in a moment. I want to start with Priya Misra of JP Morgan Asset Management, who asked the question, maybe a bump in the road is the new transitory. Does that resonate with you?
I think that's well phrased because it's starting to feel a little bit like deja vu. Month by month, we're pointing at just one factor or one or two small one-off sub-indices that are giving an upside surprise and giving us a 0.3% monthly gain instead of 0.2. Well, if you get 12 months of those, it adds up to 3.2% inflation, not 2% inflation. And that whack-a-mole sense is come back in just like it did. It's not a massive reacceleration story, but it certainly is not pushing inflation back into that convenient 2% lane that we occupied for so long before the pandemic.
Laura, let's dig a little bit deeper into that as well. The consensus, I think, on Wall Street at the moment is that you can surprise, or rather you can embrace the supply side story, that growth is non-inflationary at the moment. I think Chairman Powell shares that too. Laura, what's the biggest challenge to that view right now?
I think the challenge is it's not just CPI. We're starting to see, it's been a month and a half now of inflation upside surprises from producer prices, from commodity prices moving higher. The ISM manufacturing price sub-index hit the highest in 2.5 years. So it's not just consumer prices. It's really sort of seeping and bubbling up from a lot of different places. And listen, services prices are stickier. I think that's the issue. And again, it's not just rent. So, you know, you're seeing a nuanced story around inflation. I think unlike the growth side of the economy, everyone, you know, there's more consensus around the fact that we're in good shape. On the inflation, there's still a wide range of consensus. And what is surprising is Powell, interest in dismissing the latest data. Again, there's no urgency to cut rates. So the fact that he still seems so intent on that path, I think, is causing a bunch of us to wonder what the conviction behind the rate cut is at this juncture.
Maybe this is a reason why, Laura, you said also not higher for longer, but a renormalization of interest rates to the 1990s and 2000s. The 10-year retests 5% at some time this year. What do you think is the trigger for that, given that everything we've seen so far, we're still quite a bit of ways from that?
We're still a ways from it, Lisa, but I think that we're on that trajectory. It's the higher inflation numbers. It's this very strong growth numbers. It's the productivity numbers that look fairly solid. And then I think there's this supply side issue in treasuries that's just not going to go away no matter what you change with the mix of funding. At the end of the day, if we're not going to have a recession, the yield curve should normalize, and it's still deeply inverted. I see that as more of a twist, some surgical rate cuts later in the year, but long-term rates drifting up. And if we have a healthy economy with 3% inflation, there's no reason why long-term interest rates shouldn't align with nominal GDP. That puts you in the 5% range at least. I don't think we should be as worried about that as we were with the rapid rise in rates that we saw in 2022 and 23.
I'm old enough to remember the last time we got 5% 10-year yields and people were talking about something breaking and bank failures and commercial real estate falling out of bed. Are we basically taking that off the table now and saying this is an economy that can handle that with no problem?
That I am, because I think that This time last year, when we touched 5%, it was the speed at which interest rates moved up so fast. I make the comparison, if somebody from warm weather moves to New York in the middle of winter, there's going to be a very unpleasant shock and you're going to kind of freeze up. But the second winter, the third winter, you kind of get used to it and you're out and about doing everything that you would be doing normally. I think that's the right comparison here. The longer that we're at these interest rates, the more that we'll price in this into the cost of refinancing, the cost of buying a home, and the cost of M&A activity. I think, all of that will normalize. It was just the shock of the speed of the move. We're moving there gradually now. I don't think it's going to be as much of a problem for markets to digest.
If the economy is fine and well and good, and these surgical rate cuts, you have about 2 or 3 priced in. Are you actually prepared to pare them back to potentially 1 or none?
I am. And I've been sort of, on the fence about saying that I don't think 2 or 3 rate cuts are needed. I just think it's what the Fed seems to have conviction they will deliver. I think that look at markets today, financial conditions, credit conditions. I don't think that we need these rate cuts. At the end of the day, you're looking at a world with higher interest rates offering a rich suite of alternative investments away from traditional equities. I think markets have digested these higher interest rates just fine.
Laura, can I just say that it's winter 8 or 9, and no, I have not adapted. Laura Rain, thank you, of FS Investments. Maybe I'm like office vacancies in that analogy. Is that what I am?
Okay, so you haven't adapted. Public service announcement. Just say this: get the right equipment. You don't have the right equipment. That's all I can say.
What's wrong with? Hang on a minute. You're so aggressive about this.
He's got the Montclair.
Pause. What's wrong with the? What's the equipment? Let's just start there. What do you mean by the equipment?
You need to commit to the cold weather and then get the sufficient. Whether it's a warm jacket, whether it's warm gloves, whether it's a hat, commit to going out there and experiencing the cold.
Winter.
But it's about experiencing the experience of it all.
Like ugly boots? Is that what you're talking about?
I've seen it. He's got all Loro Piano. He's got the Montclair.
So critical of me.
I'm not critical. I'm just saying.
I have the equipment.
If you want to enjoy the winter, you have to have the right equipment.
What does that mean?
You have to have the right types of warm-producing things.
Okay.
Use hand warmers if you need to.
Also, England's cold in the winter. I'm not sure how you haven't adapted.
Look, the only reason I get through it in New York is because you promised a summer. And the summer arrives, and I can live with that. In England, it's tough. It's like this damp cold all year round that never goes away, with the promise of maybe a week or 2 in the summer of the sun shining, sort of like 2 weeks max. And every now and again, it's a heat wave. It's like 24 degrees.
Damp is worse than cold, just saying.
I totally agree. The equipment, okay. Coming up next on this programme, Jimmy Chang of Rockefeller Global Family Office, Terry Hayes of Pangea Policy, Subhatra Rajappa of SocGen. A note in my inbox just dropped in from SocGen, recession delayed indefinitely. We'll have that conversation in just a moment.
Very much so. I can't wait to hear that, because that's really ultimately what people are pricing in. Again, what does that mean for the Fed's commitment to cutting rates this year? Because we've still heard that commitment, even though perhaps they've tempered it just a little bit on the edges.
And we'll check in with our guests to see if they have the right equipment to get through the month.
I actually do. I want to know.
That's
mean, it's April's kind of week.
Equity futures on the S&P just about unchanged on the S&P 500. In the bond market, yields creeping higher right across the curve, up 4 basis points on a 10-year, 444 from New York. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat, And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
If we see inflation move higher, it really calls into question Powell's willingness to say rate cuts still are coming.
It wouldn't take much, I think, to push back at least the timing of that first potential rate cut.
They're telling you if things slow down, they'll cut a lot more. So they're trying to say that the risks around those 3 cuts are balanced.
It's clear that this is a Fed chair that wants to cut rates and is willing to look through some of the hot inflation data.
I think we will end up with 2 cuts this year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Never insult the English weather again. Brutal feedback, sort of instantaneous.
How do people defend it? I'm just curious.
I would love to know as well, and I'm about to ask, and hopefully I'll get a reply for you. From New York City this morning, good morning for our audience worldwide. Big week ahead, CPI on Wednesday, bank earnings on Friday, lots to talk about. Let's start with the bond market on a 2-year, a 10-year, a 30-year. Earlier on this morning, new highs for 2024. Your yield right now, Lisa, on a 10-year, 444.
And this really raises the issue that we've been grappling with all year. At what level, at what point do bond yields create a real problem for stocks? So far, we have shrugged that question off again and again because it's been rising for the right reasons. Is the bond complex still losing value with yields rising for the right reasons for stocks to keep rallying?
The question is when. The answer is now, according to Jeff Yu of BNY Mellon, who was on this program 60 minutes ago. We'll see. Based on Friday, really strong data point. Payrolls growth, really, really powerful stuff, around 300K. Non-inflationary growth, that supply side story, driving equities, breaking out again. And that relationship is just evolving day by day between treasuries and stocks. And I think we're all still trying to figure it out. It's good news, truly good news for stocks.
And a lot of that has to do with the Fed pivot, this idea that the Federal Reserve came out and essentially indicated that they were biased to cut, whether it's just sort of insurance cuts or, you know, beautiful cosmetics cuts, whatever you want to call it. The question here is, are they sufficiently challenged in that thesis and that desire to reduce benchmark rates, given the data that's strong, but not necessarily inflationary in the same way? And that's the reason why CPI on Wednesday is going to be such an important day.
Is the data cooperating? Need to talk about commodities too. Gold recently breaking out to new all-time highs. Silver with a big run as well over the last week or so, up again this morning by 1.3%. And crude, new highs for the year. In fact, the highest since October. A move of close to 5%, Anne-Marie, last week. Just pairing those gains this morning by 0.7%.
On Brent, we've passed to the psychological level of $90 a barrel. Next, everyone is talking about potentially, can we get to 100? You see Goldman, you see Bank of America, you see a lot of notes coming out, potentially in the summer, peak driving season, these supply concerns, can we see $100 a barrel? And this is going to be very tense, given the fact that we're in this moment right now, geopolitically, where we're still waiting for Iran's response, and then you have all the supply and demand constraints.
Does that derail the happy talk at the Federal Reserve in any way, shape or form this week in the Fed speak?
They will say no. They will say that they don't look at oil prices. Oil prices are transitory, just as bump might be transitory, and transitory was transitory. But there's this real question about how that feeds into some of the consumer sentiment and consumer expectations of inflation. We see that pretty religiously. The University of Michigan Sentiment Survey, I know you have issues sometimes with the fact that they haven't called you. Just call John, and then he'll really like the survey. But the question that I have is, you know, at a certain point, is that going to feature in to some of the Fed prognostications?
I've looked into that before. Not to get the call, just the questions they ask.
Oh, yeah?
And I just want to speak to the people that put together that report.
You're prepared for it. You have
I've
very
got
thought-out answers.
1 to 5 year inflation expectations, I'll be like 10.
So you're going to single-handedly skew the results. So the results are going to come out Wednesday, and it's going to say longer-term inflation expectations, 6.3%. Jonathan Farrow.
I walked past the garage the other day and saw gasoline at like $4, and that's it for me. 10% from here.
Okay,
is that how it works?
Okay, I understand that it's arbitrary. There's sort of an arbitrary nature. How do you sort of survey people and have this really specific number that's actually pretty relevant to the last month's number? That said, it's a good gauge of sentiment, and it sort of does feed into, I mean, this is one of the reasons why the Fed was concerned about inflation one particular Fed meeting.
The Fed moved on this once, which I thought that was absolutely ridiculous at the time. They've moved the goalpost how many times now? How many times have they moved the goalpost? The data that matters, the data that doesn't matter. Are we on quits now? Is that the data that matters?
Look, yes, they're also inflation, et cetera. Can I just say, I feel a little bad for them. I feel bad for them. I know you're gonna rake me over.
No, the floor is yours, please.
But this is a difficult economy to understand. I don't understand exactly which pieces are moving. So how do they communicate that in any kind of comprehensive way?
We all feel bad for them. Equity futures right now on the S&P just about unchanged. The price action is shaping up as follows. Who are you feeling bad for the Fed?
Well, I'm just saying. I understand. I empathize with the challenge.
Okay, yields up 4 basis points. 444.60 on a 10-year. Crude 86.16. Coming up this hour, Jimmy Chang of the Rockefeller Family Office ahead of a busy week of data. Terry Haynes of Pangea Policy as Congress returns to Washington. And Subhadra Japa of SocGen on Wednesday's CPI report. We begin with our top story. Investors bracing for a busy week of data. Jimmy Chang of the Rockefeller Family Office weighing in on the Fed's path forward. The case for rate cuts in 24 is low-quality job growth and elevated real rates, while the case for no cuts is what's the rush when growth is still above trend, markets near all-time highs, and junk bond spreads near decade lows. I'm pleased to say that Jimmy is around the table with us. Jimmy, good morning to you.
Hi.
Which case is the stronger case from your standpoint?
I believe there's really no rush to cut at this point.
So you think we will get no cuts anytime soon?
I suspect there will be probably 1 or 2 after the election. For the first cut to happen, they really need a unanimous decision. And I think that's difficult to come in June or even July based on the current set of data.
You'd push it back all the way to November of this year. What would that mean for the stock markets? Because so far this year, it's handled things pretty well. We've priced in a ton of cuts and stocks are up still year to date by something like double digits. Do you think we can continue trading in that fashion?
I think the road ahead gets more difficult, probably higher volatility ahead. Part of it is also the liquidity. The liquidity support from, for the market has been extremely strong. But we're gradually drawing down the overnight reverse repo, which is the source of excess, the excess liquidity entering the market. So as you continue the QT program, continue to draw down the overnight reverse repo after the tax season, I do believe the liquidity drop gets more challenging. And this is why the Fed has signaled that they would like to start to reduce the pace of QT fairly soon.
Well, just to sort of bleed that out into the long end of the yield curve, because this has been one of the big questions. Why has that been an area that has been so difficult to gauge? If the Fed holds rates steady until after the election, does that lead to a rally in the long end? Does that lead to more conviction that this Fed can get inflation and rates back down to a level somewhat akin to what we've seen in the past?
Probably. Indeed, there's that thesis that if the Fed were to pivot too early, that raises the fear that inflation could make a comeback. So by staying tighter for longer, that's probably building more credibility to the market. But a lot also depends on the supply of bonds. I think we're always at the risk of just one more bad auction that can send yields a lot higher. And then at what point you wonder at what level is it 4.5% that start to trigger the equity to pull back. And it's not just this relationship between bond and equities. It's also between bond and gold, right? Because historically, when yields start to climb higher, real rates move higher, gold prices are supposed to come down. And yet we have been seeing this strong rally in gold price.
What do you make of that? Because there have been a number of articles trying to explain it. They all disagree with one another. What's your explanation?
I think it's a combination of the market front-running the potential geopolitical problems in the Middle East, potentially stickier inflation, and also this recognition that we just have so much debt to be issued that at some point the Fed will need to start easing aggressively with QE. The question is, how will the Fed restart quantitative easing without bringing interest rate down to zero? I think that's the question. In fact, the biggest question that reporters should be asking of the Fed at the post-FOMC meeting is that the CBO actually projects that over the next 10 years, the Federal Reserve will purchase $5 trillion of treasuries. So that's the assumption from the CBO. Someone should be asking Chair Powell, what do you think?
Yeah. Are you going to engage in another round of quantitative easing sometime soon? I think a lot of people are asking those kinds of questions, and it's a really good one. What does this mean for the traditional 60-40 portfolio? That basically the bond portion is now gold and oil and maybe chocolate and not really bonds?
Well, if you believe that the secular interest rates are somewhat higher or maybe a lot higher than what we're used to over the last decade, and potentially more volatility ahead in interest rates, then that 60-40 portfolio will not work as well. So I would suspect that you will need more diversification to get that hedging effect, looking into real assets, precious metals, alternative strategies.
What about foreign equities? Where do they fit in to all of that?
Foreign equities get more interesting when you have synchronized global recovery. We're not there yet. Foreign equities work better when the dollar is weaker. And at this point, if we believe that the ECB is going to ease imminently and the Fed may choose to stay somewhat higher for longer, then the dollar potentially will move even higher, which argues that at least in the near term, it's probably not yet time to overweight overseas equities.
Help me just make sense of this. You would expect a stronger dollar, and at the same time, you think we could get a breakout in commodities in places like gold. How unusual is that?
That's why it's been very interesting year to date. You see the breakout in gold. I think that's pointing to the market's concern with the longer run fiscal unsustainability in Washington.
Can you just help us, because we were talking earlier today about the Jamie Dimon letter of JP Morgan and how AI is this huge theme. I know you focused on technology your whole career and just some of these technological advancements. How much do you think that that's going to reduce staffing at some of these companies? How is it going to transform some of the financial centers, given your vast experience in that area?
Initially, it's going to make us more productive. So it's augmenting, it's increasing productivity. But over time, companies will realize, well, if I can get more throughput per employee, maybe I don't need as many people. So even with expansion plans, you may not have to hire as many additional employees. So I do think over time, that raises some big issues about social benefits. Should there be universal basic income if we see more displacement caused by AI? So, but those are probably 5 years out.
So before we talk about universal basic income, when it comes to stock investing, I was going to ask a stock market question, but it really does raise some bigger social questions. Does that mean that the U.S. benefits from all of these things that much disproportionately just because we haven't been the same kind of industrial center as some of these other areas, these areas that might get sort of depopulated in terms of jobs because of artificial intelligence, that the U.S. stock market will benefit the most from some of these advancements rather than international?
We are ahead of the rest of the world. But that said, there's also the open source movement in AI, and there are a lot of smart programmers elsewhere. So it is just the competition over time, and it's also how you apply AI to each industry verticals, right? It's the business applications that will come out in the coming years. At this stage, we're just looking at the infrastructure. Who makes the chips, the computers, the servers, the software? Well, the basic level infrastructure software. But over time, it's going to be individual business verticals, and that is still yet to come.
You talk about the sugar crash in 2025. What's the catalyst for that?
it's just exhausting all the unusually high sugar, high stimulus from the COVID era. I mean, we're still benefiting from it. So just look at the overnight reverse repo as a source of excess liquidity. I mean, we have been getting net liquidity injection into the market in 2020, 21, 23, and so far in 24. 2022 was the only year with a net withdrawal of liquidity, and that's why we had a bear market. But I do suspect that if the Fed continues with QT and we deplete the overnight reverse repo, starting in 2025, the liquidity backdrop will be very challenging. At the same time, we will run out of other stimulus, such as, for example, the resumption of the employee retention tax credit. That may happen this spring. That gets paid out for the remainder of the year. Then what do we do for an encore in 2025? And also, you're looking at a potential debt ceiling negotiation in January of 25.
You describe a lot of messy things that could take place. I'm just going over everything you've said in the last 8 minutes. Stimulus exhaustion, potential for stickier inflation, go to precious metals, later start for rate cuts, UBI in 5 years. How is this Federal Reserve going to balance financial stability and price stability, given everything you've just told us in the last 8 minutes? How are they going to do that?
I don't think anyone really knows. We're really in somewhat uncharted waters. And this is why many of the traditional market indicators, the yield curve, the leading economic indicators, have not worked in this cycle, just because we have been overwhelmed by so much monetary and fiscal stimulus. We're still benefiting from it. So I think everything may be okay into the election. But beyond that, who is going to be in control of the Congress and White House? What will the policies be? So there's just a lot of uncertainties.
Do you think we could be close to this market rejecting a policy effort from this administration or the next administration sometime soon? Lisa's been talking about this for a while, the prospect of a Liz Truss moment in the Treasury market. And I think a question, we phrased it in the following way. Does Washington still have the privilege of behaving recklessly? Or are we very close to that being challenged by fixed income?
I think ultimately it will take revolts from the bond vigilantes to push Washington to be more fiscally responsible.
Jimmy, thoughtful stuff. A lot to chew over. Thank you, sir. Jimmy Chang there of the Rockefeller Global Family Office. Equity futures right now totally unchanged on the S&P 500. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. For a few fleeting moments today, Americans will turn their gaze upwards to the sun as the path of the total eclipse tracks across cities and towns from Texas to Maine. The entire event will last several hours, but the main skeptical is, of course, where day turns to night with the moon being obscured for the sun. That's only expected to last for about 4 minutes. The event has sparked a tourist boom. Areas along the path are fully booked. Meanwhile, the U.S. will lose about 30 gigawatts of solar energy with the sunlight being blocked during prime generating hours. It's roughly the equivalent of 30 nuclear reactors. The CEO of Rolex has warned against viewing luxury investments as luxury watches as investments. The CEO, Jean-Frédéric Dufour, said, quote, "I don't like it when people compare watches with stocks. It sends the wrong message and is dangerous, an interesting signal for someone who wants people to buy his watches. He sees a slowdown hitting sales of smaller watch brands the hardest." And it's a battle of the #1 seeds. UConn faces Purdue tonight in the men's NCAA championship game. The UConn Huskies are looking for a win of back-to-back national titles. The Purdue Boilermakers have a chance now to win their first ever championship. And that is your Bloomberg Brief, John.
Boiler up, Danny. Boiler up. Thank you. Up next on this program, Treasury Secretary Janet Yellen's tough message to China.
When the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
That conversation up next, live from New York this morning. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Stocks on the S&P 500 this Monday morning, and good morning to you. Welcome to the programme. Just about unchanged on the S&P. Yields are up by 4 basis points. The 10-year, 444.60. Under surveillance this morning, Treasury Secretary Janet Yellen's tough message to China.
China is now simply too large for the rest of the world to absorb this enormous capacity. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
Here's the latest this morning. Treasury Secretary Janet Yellen expressing concern over China's manufacturing capacity, urging top leaders to focus on domestic demand. Her meetings were reportedly cordial. However, China's premier advising Yellen against turning, quote, economic and trade issues into political matters. Terry Haynes of Pangaea Policy joins us now for more. Terry, in what way aren't economic and trade issues political matters?
Well, they always are, John, of course, and good morning, everyone. You know, the thing is with this administration, I think the through line is that you can judge the ability to lecture is inversely proportional to the ability to actually achieve the result you want. So, you know, everybody understands the drill over there. Yellen goes over, complains about all these policies, and essentially wants to tell the Chinese to redo their entire economic program, which they spent a couple of years coming up with. She knows they're not going to do that. They know they're not going to do that. They call a lot of the charges that Yellen made groundless, and that's a quote when it comes to flooding the world with EVs, for example. So, you know, everybody, you know, nobody expects a different result, firstly, not even nor in the political nor in the economic sphere.
The result seems to be tariffs, and they've been signposting it now for months, especially from the Treasury Secretary. What do you view as the timeline for these tariffs?
You know, I'm with you all. I heard your previous discussion. I'm with you all that they try to do something closer to the election to produce a bigger bang for the buck, and they'll probably try to fold that in if they can fit with additional evidence of China helping Russia and Ukraine, which everybody knows is happening. I mean, and you know, not just economically, Russia is effectively a client state of China, I think. So what you're going to get is I think, a heightened and sharpened Chinese rhetoric just about the time we go into the general election campaign, partially in the hopes that it actually makes a difference in the election. And I don't see that much at all, frankly, but they do.
And then what would be the tit for tat that Washington should potentially be preparing for from Beijing?
Well, there's a lot of things. You know, they will absolutely tit for tat on sanctions and a bunch of other things, and they'll probably ramp up their plans to flood the United States market with EVs and all the rest, and you know, maybe even take additional steps in places like the South China Sea in order to rattle the geopolitical cage some. I think markets continue to forget that we're in the highest geopolitical risk for 50 years, and I think they think Taiwan's gone quiet. The Taiwan issue has gone quiet. It hasn't. It's just that China is now threatening the Philippines instead of directly threatening Taiwan, so it seems quieter to markets.
Well, Terry, this is exactly the reason why I found it so interesting that President Biden is holding holding the first trilateral summit this week on Thursday between Japanese Prime Minister and the leader of the Philippines to talk about some sort of alliance to really counter China. How much is this directly tied to preparing for any potential retaliation to tariffs placed on China?
Oh, 100%. You know, there are broader geopolitical issues here, and the idea of adding Japan to the AUKUS umbrella has been around for a while, and they're trying to move on that. And, you know, it's not just limited to Japan either. You know, the Biden administration has been spending a lot of time cozying up to India. I'm not suggesting India is about to join AUKUS, but the idea here is that there is there's a pushback in Asia against Chinese hegemony in the region. That will continue. The economic sanctions will continue to be a part of that, but there's the broader geopolitics as well.
Not exactly an embrace of U.S. hegemony, though, is it, Terry? And I just wonder to what extent U.S. policy is being rejected by the region.
You know, I don't think it's being rejected by the region, but there's you know, there's a lot of tensions there. If you're any unaligned nation, you know, the idea of working with the country that's closer to you to get some immediate economic benefits always is tempting, and they're under a lot of pressure to do so. At the same time, though, you've got a situation where China's been pushing the Belt and Road for some years, and that has very mixed results. And because of those very mixed results, it seems like the pendulum is moving back towards the United States and the Western alliance when it comes to wanting to establish a more independent, less China-centric position in the region for a lot of these countries.
How difficult is that kind of message before the election? I narrow in on what's going on with Nippon Steel. The president has said he doesn't want this deal to happen. The Japanese have come out and said, well, this actually means that we are stronger against China with this deal. And the U.S. is using national security concerns about China to want to block the deal, but really it's about domestic jobs. So when I talk to officials abroad, they sometimes feel that the U.S. is speaking out of both sides of their mouth. How does the U.S. combat that?
Well, you know, how they ought to best combat it is stopping speaking out of both sides of their mouths. I do think this is something that gets the Biden administration in trouble. It's not limited to them, of course, but they do it a lot, and they do it a lot in foreign policy. You saw this in the run-up to the Ukraine war. You're seeing it now in Israel and Gaza. You're seeing it in a lot of places. What they ought to be focusing on is whether or not it convinces anybody politically, frankly. And, you know, I don't think it does. You know, Western Pennsylvania, for example, which is one of the big battlegrounds of the election, Biden's people think they're helping their cause by being much more pro-union. But on the other hand, you know, they're engaging in LNG bans and pauses and the like that just leave people on balance more cynical about them. So I don't think the strategies are very well thought out, either politically or economically, frankly.
You're implying there is a strategy, Terry, and I'm not sure there is one right now. Terry Haynes of Pangea Policy. Terry, thank you. Just seems to me that you do one thing to try and please Pennsylvania, another to try and please Michigan, and this is what 2024 is going to be about, Lisa, going into the election.
Which is a reason why the real litmus test, as Anne-Marie was talking about, is really the international allies, and them sort of saying, okay, guys, what are you doing?
And if there is a strategy, I mean, that's kind of it. Coming up, Jamie Dimon out with his annual letter to shareholders with a warning about AI. That's next.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the program. Equities on the S&P 500 totally unchanged. On the Nasdaq as well, pretty flat this morning, going absolutely nowhere. Trying to bounce on a Russell. Ugly week of losses for the small caps last week. The Russell this morning positive by 0.1%. The equity market of the S&P 500 coming off the back of the biggest one-week loss since the start of the year. If you turn to the bond market, I'll go through some levels for you. The high of the year on a 2-year this morning, 478.23, just off those levels at the moment. The height of the year on a 10-year, again, this morning, which is where we are right now, 445.41. Yields up by Lisa, 5 basis points on a 10-year maturity.
And this is directly derived from the idea that the data is not cooperating with the Federal Reserve that seems to want to cut rates. What I find interesting is where the yields are rising. It's not inflation expectations. It's real yields. It's when you strip out inflation expectations going over the next 10 years, you're seeing that north of 2%. This is the expectation the Fed's going to have to remain higher for a lot longer. And at what point does that really start to bleed more significantly into risk assets?
It's what happens when payrolls comes in at 303,000. But Betty talked about it. What on earth was that number on Friday?
Okay, we also didn't get downward revisions. The amazing thing, and the reason why we're not talking about it, it was a perfect kind of response. The idea that you also did not get any kind of wage growth that caused real concerns or alarm bells. This is the sort of disinflationary growth that's just perfect in all sort of counts. The question's going to be on Wednesday. We get CPI, then we get PPI. Does that hold, or suddenly do you have to rethink that thesis?
Immigration means the U.S. can expand without overheating. This is what Jay Powell talked about, although I caught up with Acting Labor Secretary Julie Su, and she really didn't want to say it was immigration. She did a lot of, verbal gymnastics to say it was teenagers. That is what is driving this capacity.
They'll say things like bigger, not tighter. That's what I heard from Alan Zentner of Morgan Stanley. The economy can get bigger without the labour market tightening. I do wonder, Lisa, if it is all immigration, they're not going to spend money elsewhere, given the jobs they've got. And I think it's a very tricky thing for this administration to embrace, hence the verbal gymnastics, because what's the message you're going to send? We've got a supply-side story that we're embracing because we've got a load of immigration coming across the southern border, and that's keeping wages down. Well, is that politically palatable?
Not really, if you're not getting the wage increases in low-wage jobs that you previously would have because of an increase in people who are coming in who will take those jobs for lower wages. It's a difficult moment for the administration, for the economy. From a lot of investor standpoint, it looks like an economic nirvana. For how long? And does that last? Because honestly, you are seeing a certain level of strength with consumer spending staying in there that leads to maybe a slightly different reality.
One nugget in this jobs report that I thought was interesting was the number of multiple job holders increasing. So you have to hold multiple jobs in order to keep up with your bills. It's up 27% since the former president left office. And that is why you saw Trump come out and say, well, there's things in this jobs report that you need to look out for. That's concerning.
Things for the Federal Reserve to look out for, politically agnostic. They look at the situation right now, the market. I would say the market's got this constructive view because it believes that Chairman Powell can respond to weakness and basically ignore strength. Is there anything about the discussion that we just had that changes that?
Well, if it is people getting multiple jobs, that means that they're concerned about their well-being and their ability to pay for their bills. So that does not speak to a screaming confidence that speaks to
strength, which is the reason why there is some caution, right? That, wait a second, things are going to slow significantly, the Andrew Hollenhorst view of the world. This is why the Fed is being so cautious, and the reason why Mohamed El-Erian is saying they should probably cut rates in July, even though you are getting economic data that's coming in strong.
Mohammed with us here in New York tomorrow morning, 7 a.m. Eastern time, so don't miss that. I want to turn to foreign exchange in the euro. Just quickly, the euro against the US dollar this morning looks like this. It's negative by about 0.1% at 108.25. Just want to use that as an excuse to talk about this from Eric Nielsen of UniCredit. The difference between the Federal Reserve and the ECB. Fantastic note from Eric over the weekend. The Fed says it doesn't know when exactly it will start the rate cut cycle, but it sends a clear signal about the expected pace of cuts once it starts and a view on the expected endpoint. In contrast, the ECB has all but pre-announced the first rate cut more than 2 to 3 months ahead of the formal decision, but insists the path thereafter remains virtually invisible. When you compare and contrast what's happening between the ECB and the Fed, there is a very big difference emerging right now, and just how they're approaching communication on policy.
Especially given the fact that, Jeff, you said earlier that this is a live meeting on Thursday with the ECB as they come out, which raises this question whether the market is ahead of the game right now. The market is doing the job for the ECB and saying, your rate cut path is a lot more concrete than the Fed's. You have a lot more to go because you've got a weaker economy, and frankly, you have a more sort of economic weakness filtering in to a more significant disinflation.
Jeff is looking for parity right now, 108.25. Under surveillance this morning, a busy week of data on tap, starting with CPI and Fed minutes on Wednesday. Thursday, we get PPI and jobless claims. UMich consumer sentiment and bank earnings round out the week on Friday. Lisa's question of the morning so far, bank earnings or data? Take your pick. Which one?
I think bank earnings, actually. CPI, if it's in line, will be treated as basically a beat, but really bank earnings might give a sense of just how much consumer pushback there is, whether Jamie Dimon is speaking as a concerned American or whether he's speaking from some kind of concrete sense of real worry that he's seeing in the actual numbers.
But for the Fed to be able to cut, given the strong support we have in the jobs market, they need to see softer inflation. So I'm looking at the data, and Bank of America is not with the consensus. They're slightly off. They say it's 2% month-to-month rise in core inflation. And they say this is much more important, this print, than last week's jobs report.
The week really begins on Wednesday with that economic data, then picks up through the week onto Friday when we get those bank earnings. Let's turn to our next story. Paramount Global is nearing a deal to merge with David Ellison's Skydance Media. Ellison and his backers have agreed to pay $2 billion for the media giant that owns CBS, MTV, and Nickelodeon. The two sides agreeing to a month of exclusive talks to work out the details. Plenty of moves in this sector right now.
I'm actually surprised there hasn't been actual more consolidation. There's been a lot of talks upon talks upon talks that get broken up. Are they really going to be stronger together? Is it really just going to be the bundle that we're going back to, essentially?
Haven't we already returned to that?
Have we?
Would you like my Hulu complaint?
Please, I've been waiting all morning.
I don't get the algo. The algo is absolutely terrible. I mean, you know me. What do I want to watch Sunday? I want to watch the basketball. I want to watch the sports. What should be at the front page?
Sports.
Not there. Not there. I then have to go to a separate thing and click on the sports and then find the basketball and then watch the game. I don't get it. I have to do the same thing with the golf sometimes. It's just not there.
But what is there? That's my question.
The farmer who wants to find a wife comes top of the pile.
It's because you love also rom-coms.
You seen that?
So your algo is skewed.
My algo is confused.
It's confused
because that I'm multiple people.
Yes, because you watch a lot of those Lifetime movies.
That might be that.
Yeah.
You watch a lot of Lifetime movies.
Only at Christmas I watch Hallmark movies.
Yeah, but you do a lot.
Shouldn't they know that it's now April and it's not Christmas anymore and you don't want to watch that stuff?
Hulu algorithm, public service announcement.
Shouldn't they know that?
Sports on Sunday.
Sports on Sunday. This is easy. Want to watch the golf? Great golf over the weekend.
Maybe it's a good show.
Fantastic finish going into the Masters this week. Let's turn the story to JP Morgan CEO Jamie Dimon. Great show, by the way. Out with his annual letter to shareholders, all about how we're moving away from urban stories to sort of stories about rural America.
And it's almost
you actually watched it.
Yeah, absolutely.
So Hulu was correct.
Just to learn. Devoting a chunk to artificial intelligence. We're moving on, guys. Saying it could be a transformational steam engine for the economy. Over time, we anticipate that our use of AI has the potential to augment virtually every single job. Shonali Bassett joins us now for more. Shonali, it could be as transformational as the steam engine for the US economy. Walk us through the logic from Jamie Dimon this morning.
Well, there are a few things. We know that JP Morgan has been talking about this in their annual letter for years. We know that he has thousands of people devoted to the cause of AI. They just elevated somebody in their investment bank to play a broader role here to look at data and technology across the whole firm, when they look at artificial intelligence, they do use it in a lot of businesses already. Everything from financial advisors are figuring out how to incorporate it in a more generative way to figure out how to dole out investment advice. Remember, trading desks already use AI at scale. Now, what does generative artificial intelligence mean for the trading desks as well? Data centers, investments in data centers. So you kind of look across the entire spectrum, and certainly AI has a huge role, not to mention anti-money laundering and security concerns within a bank. If you have AI actors out there that can cause harm, as a bank, you also need to have that defense properly in place to ward those actors off.
You've been reading Jamie Dimon letters for a very long time and then covering the earnings that come out shortly thereafter. What's the relationship between the two?
So there's a few things in this letter in particular that does speak to the business moving forward. You think, for example, what he says about the expectations for First Republic. They had said earlier that $500 million worth of earnings annually would be added, and now they think that's closer to $2 billion, Lisa, if you could believe it. And on top of that, too, he also draws out his concerns. We always look on Friday, this Friday coming up, on what he's going to say about the forward look for the economy, and he gives a little bit of that in the letter today. A lot of concerns about persistent inflation and the idea that inflation could stay higher for longer. It's interesting, he balances that out in a very interesting way. He talks about persistent inflation relative to federal spending and worries about geopolitics, but he also talks about economic growth, and not only in the vein of AI being kind of as productive as a steam engine, but also when you think about how much money economies have to spend for a green economy as well. This idea that, you know, he puts specific statistics, 70,000 electricians needed to really boost the electronification of the United States, for example. So how much productivity is needed to offset those forces, I think is a big question.
We were asking earlier, is this Jamie Dimon as Treasury Secretary, or is this Jamie Dimon as CEO of JP Morgan?
You know, that's been the perennial question, hasn't it? This letter has always been kind of a swan song to the world. It has been Jamie Dimon's way of really weighing in on a lot of issues that impact JP Morgan, its customers, but also remember they bank clients and governments around the world. There's a whole section in the back of this letter that talks about what it's like to be a good leader, and you have to wonder if that's the handoff story. Is that the note not just to people who are looking at the qualities for the next CEO, but also his own little letter here to whoever his successor may be?
He was a little bit kinder, and he said Trump was kind of right in Davos. Then recently he went to the White House and had lunch with Kamala Harris. What is he doing in terms of politics? He's walking a fine line purposefully.
He always has, and there's a part in the letter as well where he says something I think we already know about how he's like a cold-blooded free market capitalist. And it's important to remember his economic thinking as we think about how he deals with politicians. He's always straddled the line. It's really interesting to watch him go to Congress. Now they have that annual grilling of the bankers now. They don't ask them the same political questions they used to ask about green energy financing, for example. These things, the balance has swayed one year or another, frankly, for these banks. And so he has been able to step up on things like energy financing in a way that has been unpopular at times. But guess what? A few years later, it's less unpopular, isn't it? And so you see that he kind of stands the test of time when he's fighting back on these issues.
JP Morgan shares are up 17%, more than 17% so far this year. I find it fascinating what you pointed out about First Republic and how much they've gained from that. How much are we expecting them to just consolidate their gains as the world's biggest bank, as the U.S.'s biggest bank, and really dominating a lot of areas that previously were more open maybe to some competitors?
Yeah, this whole beginning of the letter starts about the history of bank mergers from JP Morgan to Bank of America. And this idea here that JP Morgan in and of itself, by 2004, JP Morgan represented the consolidation, he says, of 4 of the 10 largest U.S. banks from 1990, if you can believe it. You remember that it had been born off of consolidation, but you forget exactly how much. And now when he's talking about bank rules as well, he's making the case for the whole banking system to keep consolidating, to ward off, this is another favorite one that I had from this, the idea that even Apple effectively acts as a bank. He's talking about all the competition they're facing from the non-bank system, and he calls out one big tech player by name.
Interesting. Apple's a bank, the airlines are credit cards. Everything's changing.
The whole idea, though, it's sort of what's your biggest competitor? Big tech is sort of the banking industry. That was sort of 3 years ago. Yep. Now it's just basically Apollo and other firms stealing their lunch. Let's hear about it.
Thank you. Great to see you. Sonali Basak there of Bloomberg. Lisa mentioned the year-to-date performance of JP Morgan. Stocks up 16%. Cities up by 20%. Bank of America up by about 10. All three of those banks having decent years so far, year to date. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief. Let's catch up with Danny Berger. Hey, Danny.
Hey, John. Crude oil is declining to start the week. It comes off of a 5-month high. Israel said it would remove some troops from Gaza, but it's still preparing an offensive in Rafah. Chipmaker TSMC will receive $6.6 billion in grants. It'll also get as much as $5 billion in loans from the U.S. That's to help it build factories in Arizona. It's a prelim agreement, but the company will build a new factory in Phoenix. That adds to the 2 facilities in the state, which are expected to begin production in 2025 and 28. The newest factory will build next-gen 2-nanometer chips. Those are essential to emerging technologies like AI and military applications. Spirit Airlines has reached an agreement with Airbus. It will defer all aircraft scheduled to be delivered in Q2 2025. Deliveries will be pushed through to the end of 26 through 31. It should improve Spirit's liquidity position by about $340 million over the next few years. Spirit will also furlough about 260 pilots effective September 1st. That's your Bloomberg Brief. John.
Danny, appreciate the update. Thank you. Up next on the program, traders trimming their rate cut bets.
The policy mistake would be to go after 2% inflation too quickly. If this Fed is continuously overly data dependent, then maybe we don't get cuts.
That conversation up next.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The S&P 500 negative by 0.1% on the S&P. We'll talk about that another time. In the bond market, yields are higher by 5 basis points, 445.41 on a US 10-year. In the commodity market, we look like this. We're just about negative by 0.7%. Crude at the moment, WTI $86, Brent crude $90 and about 50 cents. Under surveillance this morning, traders trimming their rate cut bets.
There is a slow but sure migration in markets to the view that, yes, we're not going to get to 2%. We're going to get to above 2, closer to 3, and that's going to be stable. And the policy mistake would be to go after 2% inflation too quickly. If this Fed is continuously overly data dependent, then maybe we don't get cuts. But I'm hoping that they will see through the backward-looking data and look forward. And I think we will end up with 2 cuts this year,
Here's the latest this morning. After a blowout jobs report, traders cutting rate cut bets for this year from 3 to 2. All eyes now on March CPI. SocGen Subhadra Rajappa writing this: less is more. The market is on the cusp of looking to Wednesday to further price out a June rate cut. Strong fundamentals and sticky inflation bring into question the need for 3 rate cuts this year. Subhadra, I'm pleased to say, is with us around a table here in New York. Subhadra, good morning to you.
Good morning.
Get this question all the time. Equity markets are at all-time highs. Credit spreads are tight. We've got jobs growth at 300K. Why are we even having this conversation about reducing interest rates? Why are we?
Well, I think it's a tricky year. Coming into this year, I think the Fed thought that the economy would slow down more dramatically than what we actually saw in the first quarter. In fact, we saw a decent amount of momentum. Growth is tracking anywhere between 2 to 2.5%. And I think that they were also somewhat eager to at least start the rate adjustment policy ahead of the election so that they don't appear to be partisan. And that's what leaves them in sort of this really tough spot where the data has been performing a lot better than their expectations. And now, if anything, they might, an optimal time to cut might be in the fourth quarter, but that comes in line with the elections.
So we're taking out the cuts, we're pricing in stronger growth and maybe hotter inflation, stickier inflation. And the bond board looks like this. If we can bring it up and just go through it, Subhadra, 2-year close to 480, 10-year getting closer to 450, 30-year basically at 460. How much potential is there for high yields from here?
I think it's going to be tricky for yields to continue to rise from here because I see this current environment as being very different than what we saw in the fourth quarter of last year. Fourth quarter of last year, the Fed was biased towards hiking more by the end of the year. You were also looking at an environment where Treasury supply was in the forefront. You saw a buildup in term premia because of the increase in coupon issuance sizes. And now we're in a different environment where the Fed's bias is clearly towards easing. So they've told us that they're thinking about rate cuts sometime in the second half of this year. So that, I think, kind of mechanically puts a cap on how high yields can rise from here on. The supply picture hasn't really changed meaningfully, but that said, I think that the market's going to be biased towards lower yields from here on.
Are you saying that there isn't any data point that could come out, or cumulative data points, that would sway this Federal Reserve from cutting rates this year?
No, the Fed could very well end up not cutting rates this year if the data continues to be strong. But the bias in the bond market is going to be towards lower yields, given the fact that the market's always going to be looking towards something in the data that breaks that would cause the Fed to need to pivot and cut rates. So I think that that's really where the market's focus is going to be on.
Is it more bullish for the 10-year yield if the data underperforms or outperforms this year in terms of, this week I should say, in terms of inflation data? If the inflation data comes in hotter than expected and it forces this Federal Reserve to hold rates higher for longer, is that more positive or negative for the 10-year?
That's actually a very interesting question because if you think about the reaction function in the bond market or even on Friday, the wage print was actually pretty benign. So that would kind of argue perhaps for the Fed to be able to adjust policy. But on the other hand, you got a very strong headline print, and it was really, really hard to see any sort of weakness in the employment picture. So the employment picture overall is extraordinarily strong. And then you're looking at an environment where if inflation actually starts to tick lower, will the Fed need to cut rates at an environment where everything else is really, really strong? And that's really where it gets a little bit tricky. You really need to see employment crack. You really need to see some weakness in manufacturing or other indicators that would suggest that the Fed would need to cut rates in an environment like this.
So you're predicting that the 10-year yield ends around 4%, ends this year around 4%. Are you rethinking that? Are you getting a little bit nervous as you see the strength that you just described?
The longer the Fed keeps policy higher, I think that there's a potential that that's going to feed through into the broader economy. Our call is that 10-year yields will probably start to decline towards maybe 375-ish or 380 by the third quarter as we head into the elections if the Fed hasn't cut rates. Beyond that, I think once we get past the elections, just the certainty of that should cause 10-year yields to rise. And then you start looking at things like debt ceiling, the increase in coupon issuance sizes coming into the first quarter of 2025. That should again see a rebuild in term premiums. So higher yields after the election is our call.
Andrew Balls of PIMCO just saying because of that there are better places to take duration risk at the moment. Look beyond the United States and look to, say, Europe. Is that something you'd agree with?
Yes, because of the fact that you look at the sequencing of policy adjustments. The ECB's basically told us that they're going to be adjusting policy in June. This was not what we expected coming into this year. The expectation this year was that the Fed would go first and then the ECB would follow suit after. But now it looks like the ECB and perhaps even the Bank of England might cut rates sooner than the Fed. So in that sort of environment, I think it probably makes sense to go long bonds in other G3 countries as opposed to treasuries.
Sooner and further at the ECB? Do you think they will take rates lower than, say, the Federal Reserve?
Probably not. Again, the situation there is very tricky. Unit labor costs are starting to rise. Inflation is still very much a concern. I was actually quite surprised that they suggested or started communicating that they would cut rates as early as the June meeting. Now the market's saying, well, they'll cut in June, but then they might not have to cut that frequently thereafter. So it's really a communication, game, if you will, at this point.
This is what we're all grappling with. Are we truly in this new regime? When they start to talk about the ultimate destination, how much higher is that destination than the previous rounds of rate cutting cycles we've seen over the last decade or so? What's it going to look like?
So the destination definitely looks like it's a lot higher. We raised our terminal forecast for Europe higher to around 2.5% terminal rate in Europe. It's the same in the US. I don't think the terminal Fed funds rate is going to be anywhere close to the long run Fed funds rate, which is around 2.5%. So when the cycle ends, I think that the Fed funds rate might end up around maybe anywhere between 3 to 3.5%. And the path to getting there might be a lot slower than people anticipate.
You talk about the rising oil and commodity prices. Who's more vulnerable to that, the ECB or the Fed?
It's got to be the ECB because of the fact that they are much more dependent on energy. The ECB also looks at headline inflation a lot more than the US. The US, for the most part, is energy independent. So if anything, there are some positives that come out of higher oil prices to certain sectors of the US economy, capex spending as well. So I think for the most part, the focus is at least for the ECB is going to be not just on core inflation, but also headline inflation. And to the extent that you have higher oil prices, higher geopolitical risks, I think that that's going to weigh more on European bonds than the US.
Interesting. Subhadra, great to see you. Just fantastic to catch up. Subhadra Japa there of SocGen. On a morning where we have new highs for 2024 across the curve, the 2-year out to the 30-year, the 10-year right now at 5 basis points, getting closer and closer to 450. What was the line of the sand for equity pain last week?
It was 450.
556.
556. Well, with one person, yes, it was 556. Other people say 450. We'll see, right? We're not necessarily seeing it completely derail the equity rally, but we are seeing it in certain pockets and certainly questioning whether the rotation can persist.
The 30-year at 460, that's what got my attention last week. The small caps underperforming last week. Remember, we started last week by having a conversation about broadening out, small caps doing better, then they got absolutely hammered, even though we had better economic data.
Because basically, those are the companies that more leveraged and that potentially could feel higher rates where they are. It's still a mystery about how resilient this economy is, whether the long and variable lags are still in existence or whether they just don't exist anymore.
Super long is what some people might say.
30 years.
Super long. Jack Manley of JP Morgan, Ellen Wald of the Atlantic Council, Kathy Bosjancic of Nationwide, and Gina Martin Adams of Bloomberg Intelligence, all joining us in the next hour. The third hour of Bloomberg Surveillance just around the corner. Equity futures on the S&P, totally unchanged. Massive week ahead. CPI on Wednesday. Q1 earnings kicking off Friday morning.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time, and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart, too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
Ingredients are there for the bull market to continue in a healthy way.
We are still technically in an uptrend. Maybe there is more of a growth story at play.
We're seeing a lot of economic strength, I think more than the Fed had predicted, more than most economists had predicted.
That debate is pushing more on the side of, no, this is actually a stronger economy than we thought.
The U.S. is an economic exception among the advanced economies.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide, alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market is totally unchanged on the S&P 500. Let's get straight to the agenda this week. Top of the pile, CPI coming up on Wednesday. We'll get the Fed minutes released on the same day. PPI Thursday, together with jobless claims. And then on Friday morning, bank earnings just around the corner. You started this conversation, Lisa, earlier on today by basically asking a question on that screen. What are you focused on? What's more important?
Honestly, it sort of depends on how it all comes out, because you can make an argument for why earnings are going to tell more of a picture that could keep this rally going, and you can make an argument that if CPI comes in hotter than expected, all of a sudden the bump has become the new transitory, and suddenly we're talking about higher inflation, a Federal Reserve that doesn't have the ability to cut rates as much.
I think given the fact that we have the jobs data behind us and that unemployment rate, a stellar unemployment for over 2 years below 4%, the biggest issue this Fed has been fighting is inflation. And we've had these upside surprises. What does it mean this week? And that's what I'm going to be really focused on.
Let's push this conversation through the bond market. Let's get to the board. Look at the 2-year, the 10-year, the 30-year. If you're just joining us, new highs for the year. on every single maturity you're looking at on the screen at the moment. We're approaching 480 on a 2-year Lisa, up by 5 basis points on a 10-year.
Are higher yields still higher for the right reason for stocks? And I think that that's ultimately the key question that maybe we'll get some answer from if we get Q1 earnings that come in strong, and that if we get the response of good news being good news for at least stocks. This has been the key question. People have shrugged off rising yields, but they're rising a little faster, and they're rising with the idea that the Fed's going to respond. And if that persists, all of a sudden, that will be the narrative, the level at which bond yields become punitive.
2 case studies, one on Friday, one on last Monday. Let's go through them. I think they sort of speak for themselves. Monday, we had ISM manufacturing with a really punchy prices paid number. Equities didn't like it. Bond yields up. Friday, we had a really punchy payrolls figure without the corresponding punchiness in wage growth. The equity market can deal with those kind of yields. So we had 2 very different sessions where yields were up for, let's say, the wrong reasons, and yields were up for the right reasons.
Basically, if you get this sort of disinflationary growth, well, that's fantastic. But do you really have that conviction that the Fed can avoid cutting rates in the face of a jobs print north of 300,000, and this idea that there were no downward revisions that were substantial, and the fact that we are seeing people talking, Laura Rame, talking about the stickiness and services side inflation?
Just a long series of upside surprises on payrolls over the last year, the last 18 months or so. Equities on the S&P 500 this morning, just about unchanged on the S&P. We've talked a lot about the bond market. Let's talk about crude. Just backing away from the highs of the year, the highs that we haven't seen since October. Crude is lower by 0.75%, $86 and about 27 cents. Coming up this hour, JP Morgan's Jack Manley on why he sees equities broadening out. Ellen Wald of the Atlantic Council as oil falls from a 5-month high. And Nationwide's Kathy Bostjanczyk looking ahead to inflation data. We begin with our top story, looking ahead to a busy week of data and earnings too. JP Morgan's Jack Manley saying this: things are still looking pretty good for the equity market. The US economy is doing so well that investors should be exuberant. Maybe things are a little too rich now, but I think it's entirely possible that the market sees right the way through that. Jack, I'm pleased to say, is with us around the table. Jack, good morning to you.
Good morning, John.
Why can this carry on, and why can it broaden out?
Well, we're talking about, like you said, Lisa, right, the economy doing well for all the right reasons, the rate environment changing for all the right reasons. That employment report was pretty significant, John, that you had mentioned. Very strong gains, very low unemployment rate, but not the pop in wages that we would have feared. I think this week, to answer that question that you guys were talking about earlier, inflation is probably the most important thing to be paying attention to. At least that's how the market's going to interpret it. I don't think any individual inflation report sways the Fed's narrative, but inflation will kind of further this story that the economy is doing pretty well, because if the pop in inflation comes from a pop in energy prices, what we're sort of looking at right now, that is by definition outside of the control of central banks. The Fed can't do a whole lot about it, and so hopefully they see right through it. That's how I'm thinking about it.
So this is not because you don't want to talk about JP Morgan results on Friday. It truly is inflation. We'll talk about inflation. CPI. Do you buy into this non-inflationary growth story that so many people are embracing, not just last Friday, but over the last few months?
I do buy into it, frankly. I mean, I think a lot of what's going on with inflation today can be linked very closely to the level of interest rates. You slice and dice inflation, whether you're looking at the headline number, you're looking at the core number, you're removing the goods equation. So much of it has to do with the rate environment. It's shelter on the headline side of things. It's automobile insurance on the sort of core services side of things. Both of these things are going to be direct reflections of the interest rate environment. I think we're in this really kind of funny, peculiar chicken and the egg type situation where you're not going to see meaningful downward pressure on inflation until you see meaningful downward pressure on shelter costs. And you're not going to see meaningful downward pressure on shelter costs until the Fed lowers interest rates, mortgages come down to a more reasonable level, and supply comes back online because people are willing to step into that market. So I see through a little bit of that stuff. I don't think the inflation is something to be worried about right now.
Just to underscore what you just said, do you think that the rates where they are inherently inflationary?
I think so. I mean, it's so funny because if you think about where inflation was 2 years ago, right? We're talking about 2022. We're looking at scarcity issues. We're looking at shortages of energy, shortages of food, shortages of finished goods, all of these things related to Russia, Ukraine, China still embracing zero COVID. We crushed inflation from 9.1 to 3.0 in a 12-month span, and it had literally nothing to do with interest rates, purely to do with supply chain issues getting better. Now the stuff that's here right now, that's the stickier stuff. That's the more complicated stuff. That's the stuff that's tied directly to interest rates. So I think the path from 9 to 3, easy. The path from 3 to 2, That's a lot more complicated, and hey, we've seen plenty of evidence over the last 6, 7, 8 months in those prints.
So does this leave you buying bonds and buying stocks because you think that ultimately the Fed's going to cut rates and that's going to be positive for yield since it's inherently disinflationary to cut rates because higher rates are inflationary?
Weird environment, right? Yeah, it's like a tongue twister right there. You know, when I think about fixed income, I have to acknowledge there is a lot of short-term uncertainty about the direction of interest rates right now. We just don't really know how the data are going to continue to play out. The Fed elected to not course correct at its most recent meeting. They held on to that 75 basis point cut narrative this year, but they may change their tune a few months from now. I'm not sure. In bonds, I like the upside-downside sort of risk-reward profile there, where even if I am a little bit too early and even if yields do back up a little bit more, as long as I'm not way out on the curve, I don't really have a whole lot to be worried about. So from a fixed income perspective, it is very much a 3 to 5 year kind of sweet spot from a duration side of things, and I like the higher quality assets. I like the sovereigns. I like the higher quality corporates. I'm not really worried too much about high yield. On the stock market side of things, valuations are clearly stretched right now. I think even if you don't believe in reversion to mean, 21 times forward earnings at an index level is probably a little bit too high. But we are looking at this sort of broadening out of the recovery as the earnings story gets better for the have-nots of 2023. And I think that makes me constructive on equities too.
What does broadening out mean to you? Some people think it's sort of within the S&P 500, away from the dominant 7 stocks of last year. Others say it's look abroad. Other people, it might be going from large to small. What does it mean to you?
I'll tell you of those 3, John, it's the first one. You know, when it comes to the broadening out of the recovery, it's sort of overly simplistic perhaps, but I think it is important that investors remember that there are another 493 plus names in the S&P 500 that no one's really talking a whole lot about, that have only just now started to pick up from a price perspective, that are trading at reasonable valuations, that are punching above their weight class from an earnings contribution perspective. And as the interest rate environment gets better this year, as inflation continues to sort of normalize this year, all of these things are going to be tailwinds for those laggards of 2023. Not a big fan of stepping down in the market cap space. I think particularly when you're looking at small cap names, the debt situation there is not particularly good. The profitability situation there is absolutely abysmal. And then from an international perspective, I like the ex-US story as long as you are really careful about what you're buying out there. You know, if I buy the European index, I'm buying European banks. I'm not particularly interested in that. If I buy the EM index, a third of that's going to be state-owned enterprises. I'm not particularly interested in that either. So if you're going there, you got to be very specific.
We have a huge upswing in commodities. How do you want to potentially expose yourself to that?
The huge upswing in commodities could result in short-term outperformance from those commodity-producing emerging markets, but that is not why I own EM. I don't own EM for the commodity play. I own EM for the manufacturing play, for the growth of the middle class, the demographics, all of that leading into consumption, into production of physical goods and even services. The commodity story is not what's exciting for me about EM long-term. So if I'm looking for commodity exposure, I want to clip that coupon and maybe get a little bit of price action in there as well. I like the higher quality stuff. I even like U.S. energy producers. I think it's a shorter term play there too, because there's not a whole lot of CapEx. We're eventually going to have to drill more if we want to pump more of this stuff, and I'm not quite sure if that's in the cards right now. But for where things are at the moment, energy companies are making money hand over fist, and they are returning a lot of it back to you, the shareholder. So it's a pretty good environment.
Before we let you go, Jack, you said something that was pretty radical. This idea that high interest rates are actually inflationary for the economy. How many people agree with you?
I get a lot of questioned looks when I say that when I'm speaking to clients, but I think if you break it down, it starts to make a little bit more sense. I mean, in particular on the shelter side of things, you know, the Fed has raised interest rates notionally to crush inflation. That's the whole point of this thing, right? But by raising interest rates, they have made borrowing costs across the curve higher, which in turn has made mortgage rates go up considerably, which has forced any sort of would-be home buyer who can no longer afford to purchase a home into the rental market. And rental inflation has actually stayed quite robust. And rent is what feeds through into CPI. It's not home prices, it's rent, and then it's owner's equivalent rent. And so I think if you kind of tease out the connection there a little bit, it starts to make more sense. But first blush, I get a lot of, huh, you sure about that kind of views?
We heard that from Solfus as well, from over at Oppenheimer. He was talking about the idea that that is really the key to bringing home prices lower, is potentially lowering mortgage rates.
He was telling us about his 10% mortgage, wasn't he? $200,000.
Really bad for
Two-bed
him.
with a terrace in Manhattan.
Oh, poor guy.
In Manhattan, yeah, exactly.
Seriously. Jack, good to see you.
Great
Thank
to
you,
see
sir.
you.
Jack Manley of JP Morgan. Equities right now on the S&P, just about unchanged. Let's get you some stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. For a few fleeting moments today, Americans will look up to the sun, hopefully with glasses on, as the path of the total eclipse tracks across cities and towns from Texas to Maine. The entire event itself, it's going to last for several hours, but the main spectacle is when the day turns to night and the moon is obscuring the sun. That will last only for about 4 minutes. The event has sparked a tourist boom, and areas along the path are fully booked. The South Carolina Gamecocks are the national champions. They defeated the Iowa Hawkeyes 87-75 in the women's NCAA title game. It's now the third South Carolina national title in just 7 seasons. They're also the 10th D1 team in history to complete an undefeated season. The real highlight, though, was Iowa's Caitlin Clark. She ended her career with a whopping 3,951 points, leaving as the all-time leading scorer in both men's and women's college basketball. Now, on the men's side, it's a battle of the #1 seeds. UConn faces Purdue tonight in the men's NCAA championship game. The UConn Huskies, they're looking for back-to-back national titles. The Purdue Boilermakers now have their first chance for their first ever championship. And that is your Bloomberg Brief, John.
As many of you know, manager is a Purdue grad, which means boiler up, boiler up. I think we just said that repeatedly, right?
Every time you
get
say
extra,
that, I'm
extra
just
points
thinking
for
to
that.
myself, does that actually work? Please write in and let us know.
Something like that. Great weekend of sports. Liverpool dropping points. What's better than that?
Really?
What's better than that?
Okay, let's
What's
move on.
better than that?
That's terrible.
Up next,
You're mean.
the oil rally, taking a breather.
The Saudis would love to have a $90 price, not going to 95 or 100, and not going much below that. But you can't really manage a market to that degree. $90 would be the perfect number if it would be stable for a long period.
That conversation up next, live from New York. This is Bloomberg.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
That was good. That was good. All right. Equities look like this on the S&P 500. Equity futures just about positive by 0.05%. Yields up 6 basis points. The 10-year 4.4581. Under surveillance this morning, the oil rally taking a breather.
The Saudis would love to have a $90 price, not going to 95 or 100, and not going much below that. But you can't really manage a market to that degree. So they have a much better, not cynical understanding, but a real deeper understanding now of the dynamic effects between financial flows in and out of markets and the balances. $90 would be the perfect number if it would be stable for a long period.
Here's the latest this morning. Oil falling as Israel removes some troops from Gaza, but still above $90 a barrel on Brent. Ellen Wald of the Atlantic Council writing this. For OPEC, the $90 a barrel level can be a difficult spot. It's high enough that consumer nations get upset with prices and want them lower, especially during periods of high demand like the summer. It's also harder to maintain adherence to quotas because producer nations have the opportunity to make more money with higher per barrel prices. Ellen, I'm pleased to say, is with us. This line that came from Ed Morse, Ellen, $90 would be the perfect number if it would be stable for a long period. Ellen, you're making an interesting point. How difficult is it for that number to be stable for a long period?
Yeah, I think it's very difficult to be stable for long periods because once that number seems like it's here to stay as opposed to just a spike due to, say, a geopolitical occurrence or an environmental occurrence, you've got, you start to get really, really uptight and antsy consumer nations. India is going to be upset. China is going to be upset. Not to even mention the Biden administration, which is going to be very upset if we see this going on all through the summer. That could damage their election chances so much because for some reason, American voters really associate gasoline prices with the political party that's in power currently. There's really there isn't really a reason for this, but it's really a really prevailing element amongst the American electorate. And so if the $90 stays, it really could become a problem. And OPEC is going to have a very, very hard time resisting the pressure both to put more barrels on the market, especially Saudi Arabia, that's already got these extra voluntary cuts beyond what they're required to do under their quotas.
So we're going to have to, at some point, it sounds like you're saying, see supply either come from the Saudis or potentially an SPR release. At what price level do you think the kingdom steps in?
I think that they don't step in necessarily at a price level, but they respond to pressure. I think if they see prices going much above $90 a barrel, then I'd see them step in. I think that they are also looking at their demand. They're going to want to see what kind of orders they're getting from Asia, especially because they don't want to see that drop off. And if it looks like their oil is getting too expensive for their Asian customers, I think we would see them potentially start to put together a price increase at the next OPEC meeting.
Okay, so let's talk about the potential.
I'm sorry, a production increase.
Let's talk about the potential use of the SPR. We are well below the highs during the Obama administration, but we're still at, I think, 360 million barrels that this SPR holds. The Biden administration could have a meaningful tap of the SPR before the election, no?
Well, I think that's a really difficult thing to do because, first of all, they've already tapped into the SPR earlier, and there was a lot of pushback, especially because a lot of that oil got exported to China or to other countries, and it wasn't necessarily used domestically. And the purpose of the SPR is not to just lower gasoline prices because they happen to be too high or they happen to be too high than what they prefer for an election. The purpose is really to have this in store in case there is a geopolitical event that is preventing oil from getting to the United States or to other countries, or there's a hurricane, for example, that could take out production in the Gulf of Mexico. We saw SPR releases after there was a significant time where production in the Gulf of Mexico was out due to a hurricane. And if the Biden administration starts releasing the SPR just because gasoline prices are a little too high, then they're setting both a difficult precedent because then when are they going to refill this? They've really got to refill it constantly if they're going to be using it. Plus, the summer months are coming. Hurricane season is coming, and hurricane season is strongest in September and October, which is going to be right before the election. They may want to save the SPR, basically, in case they need it for that time.
Ellen, when you are a net energy exporter, what is the appropriate level of the SPR? What do you think it should be?
That's a really good question. I think that That question is kind of not so relevant because we're technically members of the IEA, and the IEA has a certain, in order to be a member, you have to maintain a certain amount in your SPR because a certain amount of your consumption. So I think it's a tough call. You really should maintain, I think, more than you would think, because you don't want to screw up all your exports by suddenly deciding, oh, hey, we got to halt exports because we need this domestically. You don't want to have to do that. And so it's a good idea to maintain a good amount in your SPR to be used in the event of some kind of embargo, stoppage, natural disaster, and not to just use it because gasoline prices are 50 cents per gallon higher than you think they should be.
It reminds me of the conversation about the Fed, Ellen. We talk about what the Fed should do. We need to talk about what it will do. At the end of the day, you and I could talk about this. We probably agree on the same things regards to the SPI and how it should be used. It's how it is being used that I think is more important here. Do you anticipate they will be draining that SPR going into the election?
I think that really depends on where oil prices go. I think if OPEC decides to increase production at the June meeting, there's a lot less likelihood that they'll drain the SPR. They're not going to refill it until it's below, I think, $75 a barrel. But if OPEC does increase production, I don't think we're going to see that. They'll also probably try to push American oil producers to increase production, which is something that I don't think they're going to be very receptive to, given how much pressure they've had basically on every other respect and how much vilification they've had at the hands of the Biden administration. They're going to do what they think is best for their business at this point, regardless of what the administration says.
There are 2 points in there. Saudi Arabia's response to oil prices, especially heading into the election, and U.S. producers. Let's start with Saudi Arabia, since you wrote the book on the Saudi family. How willing are they going to be to help President Biden heading into this election?
That's a good question. I think that they're not going to be that willing, and they're going to want a lot in response. That doesn't mean that they are totally unwilling, especially if they think it's a good idea for the market. So if they're getting pressure from the Biden administration, and they're getting pressure from Iraq and Kuwait and other producers that want to increase output, plus they see, look, $90 a barrel, well, if it stays that, if it goes above that, if it looks like it could be heading to 100, which I do think seems unlikely, but is absolutely a possibility, then they're definitely going to want to increase production to stave that off, because once you hit higher than that, you see demand destruction, and that's definitely something they don't want to get. They want to keep their Asian customers happy. They can also keep the Biden administration happy and get new defense treaties, new, military equipment sold to them. If they can get concessions on other things that they want, then I think it would be a win-win for Saudi Arabia, especially if they can portray it as a kind of big PR coup for them.
When it comes to the domestic picture, how much more can the U.S. produce? How quickly can they act as a swing producer after already pumping 13 million barrels a day?
So that's a really good question. I definitely think production could be higher. The question is that something that they think is a good idea? Now, the U.S. isn't really a swing producer because its oil production is not centralized. We've got all sorts of different companies doing what they think is best, and what they've been saying is best for them for a while is not to drill that many more wells. Yes, each well, they're getting a lot more productivity out of those wells, but they're not interested in spending a lot of money drilling new wells, especially if interest rates stay high and inflation continues. They're not going to want to spend more money. They may try to get something out of the Biden administration, like approvals for new drilling in the Gulf of Mexico, for example. It's possible that they could use that leverage, especially if they think that Biden is going to be reelected.
Interesting. Ellen, thank you. We've got to leave it there. Ellen Wald there of the Atlantic Council and the author of Saudi Inc. Crude this morning down by, let's call it 0.75% on Brent, $90 and about 50 cents. WTI, 86.31. Just got a fascinating note from Goldman Sachs on the economy. Take a listen to these numbers. Recent immigrants are disproportionately young or prime age and come mostly from Latin America. Here are the numbers. We estimate that net immigration surged to roughly 2.5 million in 2023 versus about 1 million per year before the pandemic, boosting labor force growth and potential GDP growth as well.
That's what we keep hearing from every economist. Torsten Slok over at Apollo put out a chart showing just how much of the new jobs, how much of the employment has come from new arrivals to this country.
We'll talk about the economics of that in just a moment. We'll catch up with Nationwide's Kathy Bosjanczyk, looking ahead to inflation data this Wednesday. Live from New York, this is Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equities on the S&P 500 positive here by 0.1%, 60 minutes away from the opening bow, just around the corner, just a little bit of a lift on the Russell by 0.4%, more than a little lift in the bond market. I think we're up something like 60 basis points year to date on a 10-year, close to that level, up another 6 basis points this morning, 445.81 on 10s. If you are just tuning into the price action this Monday morning, new highs right across the curve for 24, including at the front end on a 2-year lease, so getting closer to 480.
And people pushing back just how much the Fed can cut rates this year, given the incredible employment picture that we're seeing. It is still viewed, though, as positive. I want to just sit on the fact that we're seeing yields at the 2024 highs, and yet stocks still eking out a gain, that the downdraft last week was so difficult. Okay, we haven't seen a down day of more than 2% going back to February of 2023. This is a completely entrenched kind of feeling of optimism, and this bond market hasn't been able to stymie it.
303 was just a blowout number on jobs on Friday. And does that sound consistent with rate cuts? Well, Mike Gapen of Bank of America says it is. While exceptionally strong, the employment report is consistent with the Fed starting to ease this year in June. The Fed has embraced the supply side. A jump in labor supply can allow for stronger growth without overheating effects. That's the story they're all embracing on the FOMC.
And then you had Jack Manley of JP Morgan coming on and saying, actually, maybe higher rates are actually inflationary, not deflationary. Maybe the Fed is actually contributing to inflation with rates where they are. And he is not alone. People looking at this and saying, John Stolfus, that if you lower rates, then actually more supply is going to come onto the market in terms of housing, and you'll have prices go down. This is how uncertain the moment we're in. We don't even know what restrictive rates means at a time where some people are saying it's actually stimulative.
I think Jack's just in my camp and just wants to buy a property here in Manhattan, wants some supply, wants rates to come down.
Yeah, is that what you think?
Yeah, I think so.
And you think that it's
I think a lot of people from a certain demo, from a certain generation, are all thinking the same way about interest rates and housing prices.
Yeah, but it tells you something. But do you think it's going to lower prices for you? Are you going to get that $280,000, two-bedroom apartment with a deck?
With the roof deck.
With the roof deck.
With the roof deck for 200K?
In Manhattan.
God, don't the boomers drive you nuts? on this issue?
Well, it is a different
friends
time.
with a lot of boomers, best friends with TK still, but on this issue, I get really wound up.
Although he still rents.
He still rents, yeah.
So,
Yeah.
You missed the boat on that one.
I know, big time. Can you imagine? He's got stories about that. He can share them with you when he wants to. Let's look at commodities. Brent crude and WTI, they look like this. Brent crude is negative by 0.8%, $90 and about 50 cents. AMH, Ellen Wald, great, just 10 minutes ago. What stood out for you?
What stood out for me is this line in the sands almost. She's talking about this $90 a barrel where, especially as we potentially have more upside risk with the geopolitical concerns, the pressure she's talking about that's going to come on Saudi Arabia. And she made a great point. It's not just from the United States of the world. It's from China. It's from India. And potentially, if more pressure is coming from Asian countries, maybe that gets uncomfortable for the kingdom.
Crude down 0.75%. Under surveillance this morning, Treasury Secretary Janet Yellen delivering a direct message to China. Focus on domestic demand. Yellen framing China's excess production as a risk for the global economy, saying it poses, quote, significant risk to workers and businesses in the United States and the rest of the world. These complaints aren't new. They're old. They're really, really old. And I just wonder what the purpose of them this time around is, if it's not to just lay the groundwork for more moves on tariffs later this year.
Well, and Anne-Marie can get into the tariffs, and that's what a lot of people are expecting. The data, though, behind it's fascinating. And Brad Setzer of the CFR came out with this chart showing how exports from China of electric vehicles and lithium-related batteries have skyrocketed. They've grown exponentially since the beginning of the pandemic, and it highlights how it's shifted. It's moved away from computer parts to these areas where the tariffs are likely to be put on. So there is this new urgency that suddenly they feel like they have to get ahead of the election at a time where there's already a growing sense of unease without China.
They just keep signposting this, and Yellen's line here, I've made clear that Biden and I will not accept that reality again, talking about decades ago when it was cheap steel coming on, overcapacity of steel on the U.S. market, what that meant for U.S. jobs. But they are going to wait, I think, until right before the election, the best bang for your buck. But interesting, Goldman has a note out today about actually how high inflation can go if we get even more tariffs on China, not EVs, a blanket 60%, if the election goes the other way and it goes to Trump.
Complaining about the loss of American jobs is politically maybe the right move. Complaining about cheap goods right now, given how everyone feels about inflation in this country at the moment, I'm not so sure about that path politically, not economically, going into the election.
People want things to come down, prices to come down, inflation. But this is the reason why it's so difficult to have a real conversation, because all of these issues are nuanced and they all have multiple parts, and there isn't a level of consistency where you can say, look, we're going to have to accept higher prices if we want more made domestically and if we want to have a concrete policy of self-sufficiency on the industrial side. If they want to make that argument, it is going to come with higher prices and it's going to come with certain other sacrifices. That's a conversation people don't want to have.
I know it's tough to do the counterfactual, but on this issue, they don't want to talk about this. Let's imagine that union membership was level with where it was in the 1970s. Can you imagine how different this inflation story would be? You had Jack Manley sitting there moments ago, and Jack was talking about how quickly inflation's come down from, say, close to double digits to around 3 currently. Do you think that would have been as easy if we had union membership where it was back in the 70s? And the pass-through from headline inflation would have been direct right into wages? Right into wages. Can you imagine what that would have been like?
It's an interesting question because it also speaks to the globalization that led to a lot of the disbanding of some of those unions, the lack of industrial output by this country. Honestly, it's a lot of questions, and a lot of people are thinking really big. What kind of new era are we entering? Is it one that's more weighted to labor? Is it one that's more headed toward industrialization, but with a heavy component of automation and AI?
Be careful what you wish for. It's easy to say I'm the president of the unions and go there and sit with them and campaign. But if you had membership levels where it was in the 70s, the cost of doing that would have been a lot higher for this economy. And this time around, of course, membership rates are a whole lot lower. The pass-through, of course, less obvious. Anyway, you understand the story. Let's turn to JP Morgan. The CEO, Jamie Dimon, out with his annual letter to shareholders, devoting a large part of it to AI. Dimon saying the technology will have wide-reaching impacts across all industries. Dimon also issuing a warning on the economy, writing, quote, these markets seem to be pricing in at a 70% to 80% chance of a soft landing. I believe the odds are a lot lower than that.
Let's hear what he has to say on Friday. That's what I have to say. Is this typically
record
the type
numbers?
Right. Well, this is exactly it. I mean, how often do you hear the sort of gloom and doom, and then it's sort of, we just, made $2 billion with the acquisition of First Republic. So,
but a lot lower than 70-80%. So what? 50%? Is it?
I think we get confused with Jamie sometimes. When I listen to Jamie Dimon, I hear a risk manager talking about a range of outcomes, a range of possibilities, and I think we're too quick to compare them sort of like, this is the economist, this is his base case, and it keeps changing. I think from a risk management perspective, what would you worry about? That it's not going to be a soft landing, that maybe rates have to stay higher for longer because inflation's going to be stickier. If you're a bank CEO, I can imagine they would be things that you spend a lot of time thinking about.
And you know what? People want to hear what he has to say. He runs the biggest bank in this country, and people want to understand his view on things, which is the reason why we're hearing a lot of major executives talking about the debt, talking about the deficit, talking about concerns about a Liz Truss moment, not in those words necessarily.
Ramo's concerns.
But, part of this is because of dysfunction in D.C. So who's going to take that home and actually have the rational business case for things other than the business leaders? I mean, at a certain point.
Yep. Who's the business-friendly party at the moment? Had that conversation just last week with a lifelong Republican who had his doubts as well.
There isn't a consistent policy because of the protectionism on both sides of the aisle and the fact that there is a sort of populist bent. If you think of a business perspective, they're getting concerned about the deficit, and it's real. When I talk to different investors, this is what keeps them up at night. It's not just lip service. It's the auctions.
Couldn't agree more. It's the auctions. Big, big auctions. as Bramwell repeatedly says on this program. Coming up, we'll be talking about this, a busy week of data. US inflation data on Wednesday, the latest ECB decision on Thursday, and the big banks kicking off earnings season with JP Morgan, Wells Fargo, and Citi set to report on Friday. Kathy Bosjancic, the chief economist at Nationwide Mutual Insurance, joins us now for more. Kathy, I want to talk about this supply side story, which is almost like code at the moment for immigration. I want to talk about these numbers from Goldman Sachs because they are just stunning numbers on immigration. We're talking about millions of people coming into this country, 2.5 million in 23, net immigration. That's the number that Goldman have got versus about 1 million per year before the pandemic. Kathy, how important is that as a theme to ensure that we see numbers like the numbers we saw on Friday?
Well, good morning, John. Happy to be with you. It's critical, right? I was saying a year ago, you can't continue to have, 300,000 per month job gains with the labor force we had, right? How low could the unemployment rate go? We just don't have enough available workers, and immigration really changes that story completely. If indeed we're having, closer to 3 million, which is now estimated by the Congressional Budget Office for this year, compared to 1 million, as you said, that's a huge game changer. And that means that employment gains can be, 100,000 more, right, per month than we thought before. So it's a really big game changer. It does increase the supply side of the economy and helps explains why this expansion just continues.
Don't we have to think about how sustainable this actually is, Kathy, that if you get a change in the White House, that this might change quite quickly?
Indeed. It's something that we are, looking at when you ask and try to, handicap the election and the different outcomes. That could be a big game changer. We know that if there's tough talk on immigration, it could also, under the previous Trump administration, it also deterred legal immigration. So maybe some of what, we're seeing could be reversed. And we'll have to watch that right as we go forward. But for now, we are seeing that at least through this year. The immigration numbers look very, very high.
Kathy, there's an argument to be made that because of how big the numbers are and how much of that is being taken up by new arrivals to the country, that it's masking an underlying kind of stasis in the labor markets, that it's masking sort of churning that is slowing down. Do you buy that argument that potentially it's masking the idea that this economy is going to slow substantially in the second half?
So I think it's less likely now. I think, what you're seeing is the companies are backfilling jobs they would have otherwise filled, right? It's not just getting back to the pre-pandemic level, but it's getting back to the pre-pandemic trend. And the fact that you have more workers and you're generating more income, that means more consumption. So it can continue to support itself on the upside. So we see it less likely that we see this big downturn in the second half of the year. Earlier, we were seeing signs of that, right? If you went back, 4 or 5 months ago, we were seeing a big concentration of jobs. What I would say is in more the non-cyclical sectors, but that has really changed over the last couple of months. We've seen it broaden out quite nicely. And I don't think at this point the momentum's so strong. I don't see that happening now the second half of the year.
So let's fast forward to Wednesday, Kathy, this idea of immaculate disinflation or growth with disinflation ongoing. What would you have to see in Wednesday's CPI numbers to challenge that concept?
Yeah, so we're, everyone's going to be, very focused, right, on the core number particularly. But we're coming up with our estimate 0.3, both total and core. I think it's not so, as long as that number isn't 0.4 or higher at the core, I think you could still have the narrative because we have 4, in addition to that, you're going to have 3 inflation reports before July. The Fed meets at the end of July. I think if you get start to get 0.2 prints on months going forward, that still leaves the door open for them to cut rates in July. But we really do need to see that slowdown. I think there are factors underneath in that, with housing you spoke about. I mean, our models still suggest rental inflation should slow. And then if you look at other categories in the supercore, transportation services, we think some of that real frothiness starts to slow. So we're still encouraged, and I do think that, the Fed, they, get this. They may get that supply side increase and still see inflation slow.
I like to marry these two stories. We had an uptick of multiple job holders, individuals who have to have multiple jobs to just pay their bills. How much are we seeing higher inflation keep fueling a stronger and even tighter labor market?
Yes, so great point in that there is a dichotomy still, right, in our economy, and you could argue it's gotten worse. If you're reliant on, let's say, variable rates, right? Like we're seeing in the housing market, the existing homes market is still stalled. It's completely paralyzed. And then if you look at the workers, yes, if interest rates are facing higher credit card bills, and they have to take multiple jobs, that only adds to the pressure there on them. But they can continue to spend and borrow, but there is pressure there. There's vulnerability. And let's put it this way, many consumers are not prepared if we get a labor market slowdown. Looking ahead, again, I think that's more 2025 story at this point.
What do you think of JP Morgan, Jack Manley's point that because rates are so high, that this is putting so much pressure on the housing market, and shelter makes up the wide swath of the inflation number that's been hard to come down?
I think there's a good point there, although what we have seen is the new housing market and housing starts construction has been stronger than the existing market. So I would say that, builders somehow are finding a way, either they're buying down the mortgage rate or there's other incentives going on, or maybe we have more cash buyers, but we are seeing new supply come on. That's what we really need to see. Now, it's not great the existing home market is stalled because I think that restricts mobility across the country. But that said, I think that overall, yes, all else equal, we need to see lower rates to get the housing market up and running. And I think even on the new housing supply would do better if rates were lower.
Kathy, Jack Manley's point was also that high rates are actually inherently inflationary. Do you believe that?
No, not. I can see the argument for the housing market. I think other than that, no, that's not. I don't think that's true. I think higher rates do depress activity, and when that happens, less orders, right, for companies, and they're going to feel the pinch, and they're not going to be able to raise rates as much, and it tends to be disinflationary.
Kathy, can we just finish on immigration? I'd love your thoughts on this, and let's stay clear of the politics because I know you want to focus on the economics. It's welcomed in the labour market for the following reasons. You embrace the supply side, and somehow it keeps a lid on wages and more people come into the workforce. And we can talk about this another time, whether that's actually a good thing because it keeps a lid on wages. What I struggle with, from the perspective of this being non-inflationary growth, if we're talking about net immigration of 3.5 million versus 1 million, aren't those individuals getting jobs and spending money elsewhere? Aren't they competing for houses, pushing up rent? Kathy, can you really say that's non-inflationary growth away from the labour market?
Excellent point. And I do think it's the housing market where you have the largest issue, right? I think that there has to be a response on the supply side. And you're right. If they're working and spending and have jobs, they need housing, and that will put pressure. I think eventually, you get that supply side response on housing. I think away from, that will help greatly, but we need that, and that takes time. But I think away from housing, I don't necessarily see it as inflationary. As you said, wage growth has been moderating because of the supply side. But we are in I agree with you, John, very unique period in that we lack the housing supply. And that really goes back to the great financial crisis, right? Pendulum swing so far the other way. We've seen a restriction and depressing effect on housing supply, and it's catching up with us right now. So for now, we're in that conundrum, but I would suspect that away from housing, you see a pretty disinflationary effect still in place.
Interesting. Kathy, thanks for the update. Appreciate it. Kathy Boschansky there of Nationwide. Going into inflation data on a Wednesday. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs strategists say that Europe stocks are likely to outperform the U.S. in the next year. A team led by Sharon Bell cited a lot of factors that included a manufacturing upswing, a pickup in global PMIs, and the ECB rate cuts that they say will begin in June. Strategists are also expecting to see a better performance for financial, energy, and consumer discretionary stocks specifically. Chipmaker TSMC will be receiving $6.6 billion in grants. It's also going to get as much as $5 billion in loans from the U.S. to build factories in Arizona. It's a prelim agreement, and under it, the company will build a new factory in Phoenix that adds to the 2 facilities in the state, and production is expected to begin in 2025 and 28. The newest factory will be building next-gen 2-nanometer chips. Those are the ones that are essential to technologies like AI and have heavy military application use as well. Spirit Airlines has reached an agreement with Airbus to defer all aircraft scheduled to be delivered in the second quarter of 2025. Deliveries now will be pushed to the end of 26 through 31. That should help to improve Spirit's liquidity position by about $340 million over the next few years. Spirit will also be furloughing about 260 pilots effective September 1st. In that, they cited aircraft deferrals and grounded aircrafts due to engine availability issues. And that's your Bloomberg Brief, John.
Danny, thank you. Up next on this program, looking ahead to Q1 earnings.
Our attention is really shifting to the earnings season, which is upon us. Ingredients are there that even though we might see some, breather here and there, that ingredients are there for the bull market to continue in a healthy way.
A conversation up next.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The opening bow 39 minutes away to kick off a brand new trading week. Equities trying to bounce by 0.2%, attempting to bounce from the biggest one-week loss on the S&P since the start of the year. Yields are higher by about 4 basis points, 4.44 on a US 10-year, 4.44.60, and crude pulling back by 0.9%, $86 and about 15 cents. Under surveillance this morning, looking ahead to Q1 earnings.
Our attention is really shifting to the earnings season, which is upon us. Reality is this higher for longer interest rate environment should be positive for financials too, and tech is still holding in there from an AI demand. And so we think that the ingredients are there, that even though we might see some, breather here and there, that ingredients are there for the bull market to continue in a healthy way.
Earnings season kicking off this week with big banks leading the way. JP Morgan, Citi, Wells Fargo, all reporting their latest results before the opening bell on Friday morning. Gina Martin-Adams of Bloomberg Intelligence joins us now to discuss. Gina, great to catch up with you going into those numbers. What are you and the team looking for Friday morning?
Yeah, I think it's going to be a really interesting earnings season, but not necessarily because of financials. So I hate to throw cold water on the sort of financial story. The group has been in a pretty consistent, slow earnings recovery, but there's just more exciting things happening in the rest of the index. So if I were to say what to look for the earnings season at large, financials usually set a pretty positive tone. They have for the last several quarters. But really what we're looking for is revenue growth overall to surprise expectations. I think that revenue growth has gotten sort of a bad rap, and analysts have been somewhat scared, frankly, to increase numbers for revenue expectations, but revenue continues to beat expectations. Volume sales even continue to beat expectations despite the on-again, off-again macro weakness. Analysts have really not adopted the revenue trend. So I would say overall, expect a beat on top-line revenue growth for the S&P 500 at large, in particular driven by tech and communications, but also generally driven by consumer sectors. Yeah. I think we might also see a pretty big surprise in the commodity sectors where we've seen stabilization in commodity prices, but analysts are still expecting double-digit declines there.
Just quickly then, are we looking then at Wednesday, really the earnings kickoff with Delta earnings that are coming out before the opening bell?
Yeah, I think the most important part of earnings season, Lisa, I know that we're all anxious to get it going with this week, but I actually think the most important part of earnings season will come for a couple of weeks. We'll start with a slow roll into industrials and financials. Then we really move into some of the tech, communications, and finally at the end of the season, you get the bulk of the commodity sensitive space. So as much as we're all excited about the next week as we enter the season, the real ramp up and probably the most
NVIDIA.
I actually am interested in Wednesday. We get Delta earnings, and that's the perfect intersection of consumer discretionary plus commodity space. I mean, it's going to be incredible.
Okay, May 2nd Apple, if you're interested.
April 10th.
April 10th. I think it's May and tech, right?
Yeah, May and tech.
All the talk of this broadening out.
Sure.
The focus is elsewhere.
Can they deliver the same kind of gangbusters projections? Is the AI hype all that it's made out to be at a time when people are saying it could take a while to actually get rolled out?
Wednesday's the only thing that matters. March CPI is going to eclipse, pun intended, by Subhadra in her note, all other data this week.
Will that eclipse Delta earnings?
Yes.
Yes? No?
Who knows?
Okay.
I mean, honestly, if it's in line, then we're going to be talking about the thing that never happened.
I guarantee we barely talk about Delta earnings on Wednesday.
Is that basically what you're telling me? You're just trying to telegraphing in advance. You mentioned that.
Unless they've offered you discounts of some sort.
It'll be like a sort of hinge on my seat. I'll just get shoved backwards.
It's not a game show, Ramo. Real deal, this. Really serious stuff. Coming up tomorrow, Stuart Kaiser of Citi, Mohammed Al-Aaron of Queen's College, Cambridge. He'll be joining us around a table. We'll speak to Megan Draper of Barclays and Seth Carpenter of Morgan Stanley. Fantastic lineup for you tomorrow morning. Going into the opening bell, about 34 minutes away, equity futures attempting to bounce with bond yields at new highs for 2024. Your 10-year 4.4480 higher by 5 basis points. Live from New York City, this was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Crony in for Jonathan Farrow. Despite the rise in yields, 24 basis points in 6 days, these equity markets have a sense of immunity. Will it last? Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, Treasury yields rise to their highest levels of 2024. Jamie Dimon warning of stickier inflation and higher rates. And Secretary Yellen wraps up her high-level talks in China. We begin with the big issue. Global bond yields keep on moving higher.
Yield levels are a challenge, but also the pace of the moves will be an even greater challenge. With a bit of my FX hat on, sometimes it's not about levels, it's about the speed at which you get to certain levels. If I compare the move from 4 to 4.5 right now in the 10-year, somewhat slower compared to the rounds of bear steepening that we had last year. But if this accelerates, that tightens financial conditions much more quickly than markets are ready for, then you get the volatility.
It's not the destination, it is the speed at which we get there. Let's have that conversation now with Morgan Stanley's Caterina Simonetti and Peter Sheffick of RBC Capital Markets. Peter, I put it to you that the bond bears, they have been singed, but they have not been burnt. This acceleration in the bond market, 24 basis points in 6 days, is this the beginning of a more significant rout to come in the bond market? Good morning.
Good morning. Well, first of all, I think the risk is clearly there because it's interesting also to see on where it came from, because initially when it started, it basically came from nothing. So there was no real data out there. There was no real macro catalyst to sort of spark it. Clearly, towards the end of last week, we had the non-farm release, which was pretty strong. But by and large, the start of that came out of nothing. So, and that in my mind is also indicative that there is sort of some underlying probably imbalances in terms of positioning. And if I may add, one of the other things that potentially could accelerate it, it has been driven predominantly out of the US. Our markets over here in Europe, yes, they traded high on yields as well, but not to the same magnitude. We outperformed. If we were to share in, I think there could be another push higher in yields.
Well, I think Asia and Europe are the additional 4 basis points that you've had in the overnight session. Caterina, good morning. I like what you say, which is take advantage of the higher yields, scoop them up, coupon clip, make hay while the yield spike shines.
Well, that's exactly right. You know, S&P 500 is up almost 10% for the year, and this is after being up 24% in the previous year. So investors are getting concerned, rightfully so, given the geopolitical environment, given the, you know, the charged political environment here in the U.S. So they absolutely should take advantage of the higher yield if they want to take some of that risk off the table, because you can see the interest rate environment that is conducive of these yields in corporate bonds, in treasuries, in high yield. So this is the time to build a diversified fixed income portfolio, and now is absolutely the time to extend the duration and position the fixed income portfolio as the pivotal, important part of the total diversified asset allocation.
Okay, and we could indeed, you know, investors sort of smell maybe 5% could be on the table. We can talk about that in just a moment, because we're bracing for another busy week on the inflation front. CPI will be in focus. Mike McKee is with me. Again, we expect, Mike, a drop in the core, but the year-on-year could still be quite a distance from the Fed's target.
We will end up quite a distance from the Fed's target by the end of the week after the inflation numbers. The question is, where will the market be? Let's look at where we are right now, Manus. The Fed's effective Fed funds rate, 5.33%. Now, by the end of the year, we're expected to be just above 470. So what we're looking at is only 2 rate cuts priced in by the markets right now. We shall see if that does play out over the week as we get this kind of data. We have 2 Fed speakers today. Then Wednesday, the CPI and the Fed minutes. That should play a lot into it. On Thursday, we get PPI, jobless claims, 3 more Fed speakers, and then Friday, import prices, another inflation look, Michigan sentiment, what do people think inflation is going to be, and finally 2 more Fed speakers. So a lot to look forward to. In terms of the CPI, you're right, we're expecting the headline and core month-over-month numbers to drop, but for the headline, the year-over-year number goes up in part because of base effects, basically. The core goes down a little, but still would finish at 3.7. Remember, the Fed's looking for 2. Now, this is not the Fed's indicator, but it is still what most people think about. Will it affect the market? That's an interesting question, because we have seen a lot of CPI volatility in previous months. On the day that the CPI comes out, the 2-year note yield has adjusted by quite a bit, except for the last couple of times. Now, this volatility coming out of the markets, and you have to wonder if people are just getting used to the fact that inflation isn't going to move much, and so they're already pre-positioned. We'll find out after the number.
Okay, Mike, thank you very much. If we take that, Peter, and you say the flow would be that this move in the bond market pretty much came from nowhere, but I put it to you that the oil markets are really quite aggressively punching higher, over $90. They rallied by 4% last week on Brent. Now, that doesn't dislocate inflation expectations, but it certainly can begin to seep into the bond psyche, can't it?
One of the upside risk or potential upside risks for inflation. In fact, when you look at sort of the most recent, so what we quite often look at, we look at where the actual outcome is relative to where the market was positioning beforehand, where the market was expecting it. In the last couple of releases, we've seen an upside surprise to those consensus forecasts that were out there. And we think that the risk going into this week's release is probably tilted in the same direction. And as you said, oil price is probably one of the reasons for that as well. And if I may say, again, I want to repeat the point for emphasis. One of the things that we haven't really seen sort of in this latest bond market rout is sort of a global share-in as we had sort of late last year. And I think this is also where another source of risk potentially comes from, that it sort of spreads out and is more broad-based.
If I flick it over, Katerina, to the equity side, I know that you've upgraded your equity sector to overweight. And I was looking at the S&P performance over the past month, and it is down to all the commodities, the gold. I know it's Freeport-McMoRan in splendid isolation, but there is a robust, let's say, momentum behind the commodity components within the S&P. Is that breadth reaching, or is it inflation hedging, do you think?
We think it's a little bit of both. We've upgraded our outlook on energy 2 weeks ago. And we also like the materials and industrials, both on the fundamentals and commodity support. But we also are seeing that flight to safety per se, because, you know, when you look at the uptick in gold, energy, industrials, materials, they're all defensive asset classes. You know, we also like the sectors of the market where the companies are being responsible with the costs and, you know, are competitively positioned, are showing the operational efficiency, you know, in healthcare, in financials. You know, all of this, I think, it's that flight to safety, you know, considering that the performance in the market has happened in this very few equity names and, you know, just few sectors. So this is an absolutely great time to rebalance the portfolios and go back to basics, where investors should be looking at their, you know, total allocation. And if any of it is skewed to any one sector or individual name, this is certainly the time to rebalance, because as always, we hope for the best, but we have to prepare for the worst.
And as part of that rebalancing going for the mid-caps in your view, I mean, we don't know when the Fed will go, and there has been a severe paring back of the scale of this cycle of cuts. So the timing of going for mid-caps and small caps is perhaps harder and becoming more difficult as we price out rate cuts this year.
Well, absolutely. And when we look towards the rate cuts, and we know there are going to be some rate cuts this year, historically, large caps perform well right after the rate cuts. But this is followed by mid and small caps, although that might be a delayed performance or a delayed effect. So what we tell the investors is that overall positioning, you have to think not just few months out or even a year out. There has to be a long-term strategy, you know, that we employ when we put together these strategic, you know, asset allocations. So, you know, mid caps and small caps absolutely play a role in the portfolio, although we should not expect that immediate effect, you know, just following the rate cuts.
Peter, obviously, you're centered back in Europe, and the view this week, we have the ECB. You talk about the lack of a global bond right thus far. Do you think that that will accelerate at a global level? And what do you think we get from the ECB?
Well, I mean, first of all, there's obviously not going to be any rate cuts coming this week. And the question really, in my mind, is how they're going to prepare for the most likely outcome, which is a June cut, because most of the speakers from the ECB have indicated that much. But when you look at, particularly over here in Europe, we're now pricing significantly more rate cuts than, for instance, in the US. It seems questionable in my mind that if we continue scaling down some of these expectations in the US, that Europe can stay with basically 3.5 to 4 cuts for this year. So in my mind, that is sort of the risk that we're facing out of Europe. And particularly if on Thursday they're not really sort of endorsing, let's say, a back-to-back rate cut, I think we could also be seeing a negative market reaction after Thursday.
Okay, well, let's keep an eye on those spreads. Just one other thing which caught my mind, this is to both of you, is gold. We've got the PBOC buying gold for the 17th month in a row. We've got the RBI confirming that they are deeply involved in the gold market. So, Peter, let me put it to you from the bond perspective, first of all, which is if central banks of China and India are bountiful and buying gold, we run closer and closer risks of some kind of a moment of where they're not buying US treasuries in the same volume. Is that just a very, very small tail risk, or is there something else that you take away from that very significant buying of gold by other central banks?